Good morning, everyone, and welcome. My name is Steve Torsa. I'm the founder and CEO of Wholesale Investor. Just like to say welcome to coming today. Now, just a couple things I want to start off with. Apologies for the 6 a.m. invitation for our event on the calendar. I hope you got that clear now. It was for 8:30 and 9 a.m. And also, just want to make sure, one of the reasons what I love about this venue is it's just such a beautiful, spacious spot for everyone. So, you know, for me, as we go throughout the day, we want to make sure that there's opportunities to network, to engage with everybody, but also make sure everyone has that opportunity to do that in comfort as well. So thank you for joining us. Now, for me, just to start the actual event, it's hard not to acknowledge what we've been actually fed into our brains over the last sort of few months. And when you think about it, this has just been indoctrinated. In fact, you could probably go into your local news right now and find these types of headlines sort of filtered throughout. But actually, one of the things I love about this space is that typically this is the attitude that we approach it with, which is be fearful when others are greedy and be greedy when others are fearful. And to me, this basically echoes the whole sentiment which comes around innovation. And what's beautiful about today is like a bubble of optimism in the sense that every single person in this space, be it investor or also be it founder, is very opportunistic about the innovation and the potential that it has. The other part that I think is really interesting about today as well is that we've had something like 750 to 800 registrations for the event, and 40% of those are actually online. So I'd like to welcome everyone watching on the live stream as well for today's session. And I'll go through how to use the conference software for the event. But for me, this has been described by, billionaire Ron Barron as a once-in-a-lifetime generation buying opportunity. And I think that does summarize it really quite well, because there's a lot of factors that are taking place right now, both from a technology perspective, from a generational trend perspective, and from an innovation perspective, which makes it an incredible opportunity for investors. And I suppose the key thing is, That's what happens when you lose your throat the day before a conference. So one thing that we all know is in the GFC, and Wholesale Investor as a company, we actually launched in the GFC. It was actually October 2008, right? Literally October 4 to October 8 we were launching. But it created an incredible opportunity. And some of the companies have now gone on to become the dominant market leaders. The other thing that we noticed that when COVID took place as well, that also created an incredible opportunity for investors and also for founders as well. But the key aspect that we notice is that fundamentally it accelerates innovation and it accelerates change. And that's what I love about this space, because it embraces diversity and then turns it into an opportunity. And we started this event series for venture and capital. We actually started it in the UK. And of course, I'm not going to do a UK event without showing a picture of Winston Churchill. And I think this actually summarizes the best in that never let a good crisis go to waste. Now, typically this statement's used for politics, but I actually think it's just as purposeful when you think about it from an innovation and an opportunity perspective. Our focus as a company in everything that we think about, everything that we do, is about empowering innovation, capital, and ambition. And we do everything that we can possibly do that from countries, globally, locally, etc., educating and empowering in that direction. And you'll see that when you go and look at the Venture and Capital website, just look at all the different areas. Like in our Sydney conference that we did for this, we actually had a 3-day event. It was segmented into day 1 was Web3, day 2 was deep tech, and day 3 was property and funds and innovation in sort of that area as well. And for me, that's what I said. I love that ability to have that sort of diversity of opportunity. And then same with today. Today, the companies presenting come from both not only Singapore, but also Australia and also the UK as well. So throughout the day, you're going to be provided with access to over 25 CEOs that are going to be presenting throughout the day. Obviously, they're innovative. They're typically startups, scale-ups, and also some small-cap listed companies as well. And then the other part is, obviously, we have some alternative fund opportunities for people to participate in. So typically, when we're actually going through the build-up and the setup for this event, there was 6 common questions that investors were consistently asking us. And I list these questions as part of it because for us, this is the role of the panel sessions, this is the role of the companies presenting, is to help in answering these questions. The first one is the biggest one is, is this the bottom and where to from here? Well, I can tell you from a sentiment perspective, it's interesting to see how the money flows, over the last few months have already, even in the last 4 weeks, have actually started to come back with a vengeance. And I find that as an interesting signal for our space. But also to understand, the other key area I'll focus on, because we do have a lot of Web3, is that what is the, there was obviously a lot of hype last year. What is the opportunity going forward? And we've got some incredible panelists and speakers to actually talk about that as an area. And as I mentioned, the speakers and panelists, we're very fortunate to have, have not only just come from locally, but also from Australia as well. Said our intention is to provide as much perspective as possible to give you insights into what people are thinking, how they're looking at, and also so then from there you can form your own investment thesis and obviously to engage with the companies that are participating. One of the parts I'm most proudest of for the event is actually our conference software. So what I suggest everyone do, and I'll give you a quick demonstration in a section, just go to app.crisp.io. As part of your registration, in building this event, we also built conference software to actually streamline your entire experience in the event. So you can have access to an up-to-date agenda whenever you go on that, but most importantly, the networking zone. As we know with conferences, the most value you can extract is not only the information that you get from the panelists and the keynotes, also the information you get from the companies presenting, but it's from the networking aspect. So the reason for that networking zone is to facilitate the connections between everyone here, whether it's in person, online, etc. So make sure you use it to your advantage throughout the day. So yeah, go to crisp.app.io, right? Sorry, app.crisp.io, should be the other way around. Sign in with your Google account or your LinkedIn account, and then set in your preferences from there. It literally takes seconds to do that. Once you do that, from there, basically the preference matching and the app matching and the AI ML will take over from a recommendation perspective. So just put the app in the front, app.crisp.io. And let me just give you a, sorry. And I'll give you a quick demonstration of it. So basically when you go in, just simply go into the settings area. From there, you can just scroll down and you can just update your details and set your preferences. There is, most people in the GICS classification area, you can just set it for like internet software, for example, right? Then you can set the keywords for the areas you like. That recommended for you is the combination of the preference matching and also the AI ML. And then what you do is you go through the overview aspect. So what we've done in the companies that are presenting today, we've made it as seamless as possible for you to get access to the overview of the company. Obviously, a lot of them typically have a video inside there as well. You can request access to their pitch deck and to their documentation, but they also typically have their frequently asked questions. And also you can rate the relevance of that deal for you as well, right? So it's really for us, everything that we think about is how to actually help save time, save money, and improve the efficiency of the deal-making aspect. So the agenda for today, as I said, it's actually in the app. So if you just go to app.crisp.io, you'll be able to see there's a big red button which says for the Singapore Venture and Capital Conference. You click on that and you'll be able to take you through it. So from a formalities perspective, as an organizer of today's event, one of the hardest parts for us is actually bringing people back in after the breaks. So today, this is where all the presentations will be done. On the other side of the venue is where we've actually got the exhibition area and where all the companies have got their exhibition tables set up, right? That is also where we'll be having breaks, lunch, and so forth in that area as well. At the end of each break, we'll be ringing a bell. That will be the sign to actually come back into the room for the next round of presentations, right? So just all I ask is when you hear that bell, please make your way back in because it really helps us is keeping on time and making sure they run an efficient conference. So 3 ways to get the most out of the conference. Number 1 is obviously use the conference software. Number 2, network with the CEOs. One of the beautiful things about events like this is one conversation can completely change the trajectory of a business. And my encouragement to you is, whilst you may be one person at today's event, there may be 5 to 10 people in your network that could be relevant for some of the companies that are featured or for some of the other people that you meet. Said everything that we do is about bringing people together, so I want to make sure that gets facilitated. Network with the CEOs and then also connect with your relevant networks as mentioned. So apart from that, enjoy your venture and capital experience. I'm going to kick off with the first presentation for today, and this is specific to my area. So what I'm passionate about is the vision for this space, what the vision of future capital raising and also venture investment looks like. And we've given this a lot of thought, and that's why a lot of you, just out of curiosity, who's been to our events before, out of curiosity? Okay, so quite a few of you. We've invested since COVID, and actually what's exciting for me, this is the first time being back in almost 3 years, right? But since COVID, we've invested a lot from a software perspective because this is for us leading to what we see. You know, we've built a database now of over 32,000 high net worths across Australia, Singapore, and also the UK. Everything we think about is how to actually engage them with basically bring together, and then our vision is creating opportunities for tomorrow. And the way we do that is by, as I mentioned, empowering innovation, capital, and ambition. And effectively, all we think about is how to bring together emerging growth companies and also investors via technology, platforms, and partners. And then the other part is how to enable cross-border deals as well. So as I mentioned, there's international opportunities from Australia, also from the UK. We want to make sure we facilitate that trade for it. Our track record, 10 of the companies that we've featured have now gone on to become unicorns, which is, for me, I think is an impressive track record. And we've had over 65 companies go through an exit process, be it by M&A or via IPO. You know, some strange noise. Okay, so typically when most people are dealing with us, the common thing they say to us is, from an investor's perspective is, I want you to introduce me to the good deals, right? And then my question is, well, what is your version of a good deal? Because everyone has their own version. All of you have your own different investment theses, right? Then what companies always say to us is, I want you to introduce me to the good investors. And then I always say, I can do that, but how do I know that those investors are relevant for you? The question that we're always asking ourselves is, how can we help scale capital raising and remove friction from the actual process? And then how can we do it globally? So hence when you see the software aspect, that's one part of that. Now, from a business perspective, if you know us from the event space, obviously it's limited in what you can do from an event perspective. That's why we started investing 3 years ago into the software aspect to create for ourselves the exponential opportunity. And I say that because I want to invite more people to help us in that mission from a perspective. And really the way I see us is we're right at that transformational stage now, and everything we do going forward is from a product-led, software-driven perspective and utilizing AI and ML as actually part of the process. Because the problem that I see for capital raising, it is super fragmented. Right? It's still working like it was sort of 100 years ago, where it's mate who knows mate introduces to other mate. When I said, for me, this should be global. Innovation is global. The opportunities are global. The markets all of us are dealing in are global. Therefore, the investor that's sitting in the UK right now could be relevant to one of the companies that's being featured today and could help that company expand into the UK. Likewise, the UK companies that are presenting here today could be relevant for ASEAN. Therefore, you investing in them can help them set up their foundations in this region and expand globally as well. That's, to me, the way innovation should be. But it's crazy how fragmented everything is. So when we look at our vision, obviously it should be software driven. Obviously it should be ecosystem enabled. Obviously there should be investor access, but it should be based on relevancy, not which mate knows which mate, right? And said from that perspective, it becomes improved efficiency. Because one of the strangest things is how much money gets invested into innovation, but yet very little gets invested into this from a perspective. So our core belief is that software will actually lead this space into investor aggregation, but also will become over the next, from an adoption curve perspective, over the next sort of 3 to 5 years, will now start to be more adopted in the actual drive for capital and also in venture investment. Because the other beautiful thing about software is you can actually build in other tools, which we've done as well, whether it be for secondary sales, whether it be for syndicates, whether it be for book builds, and then obviously the matchmaking aspect is another important function. So typically, what are some of the frustrations that investors talk to us about in sort of dealing with this space? And this pretty much covers all those different areas. Right, so when we've actually thought about this, we've thought, how can we actually solve these sort of one by one in the actual process? And really the other thing is that from your perspective, you want access to opportunities, you want to make sure that deals are actually relevant, You want to actually streamline and standardize process, because most of you, when you're looking at deals, you get documents from one side, you get every information comes at you from all different angles, right? But for me, it's really about how do you actually standardize that? And then this is what we've sort of thought to ourselves, how to make it as powerful for investors. So one of the things that people that get to know me is I'm a natural matchmaking machine. Spend any time with me, let me know what you're interested in. I'll end up knowing someone that could be relevant for what you're doing. But obviously I can't scale myself, which is why when we've thought about how to do this is how can you create personalized deal flow at scale? And that's what we've done from a software perspective. So as much as I encourage you to use the software for the conference, you'll see that when you actually go into it a bit deeper, it provides a whole lot more value than just for today's conference. And whenever you're doing AI, it obviously gets thrown around a lot, the AI ML aspect, but effectively where it starts with is obviously preferences, because we need to understand that as a first step. And then over time, one thing I've learned about dealing with humans, there's what you say you're interested in, and then there's what you actually invest into, and then there's what you become interested in over time. And so that's why we built it from a software perspective to combine those two factors of preferences and also AI ML. And in our testing, the AI ML had a 130% increased click-through action. The other part is that when you see a deal, we want to streamline the way to get it and what is expected from an industry standard from an information perspective. So it's investor-friendly, streamlined, and then standardized. And then for you as an investor, we've encouraged every company participating today to put in their most frequently asked questions, right, that they get from investors. That way you don't need to ask the questions that other investors have already asked the companies. And from their perspective, they get some intelligence on what's important to you as an investor when looking at their opportunity, right? Because they get to see, set in their own data dashboard, they get to see the most consulted questions as part of that. But you also get to see that as well, because the FAQs are auto-sorted to be the ones which are most viewed. And to me, that's important, right? Because as I said, it's all about how do you save time in this actual deal discovery process. Then, obviously, as an investor, when you set up, you can actually pre-fill share applications, and the companies can also upload their own share applications to the software as well. Stored online, secured, and also simplified. Then the other part is what we've realized that what we've actually built is more of a capital engagement platform. Because one of the biggest challenges is once companies get invested into, then communication can often become difficult. So we encourage companies to communicate at least once a month, right? And we've automated it for them inside the actual platform to streamline and simplify that for them. And then also, companies have a lot of news that typically takes place, or they have product updates, demonstrations, and so forth. So once again, we've simplified in how it gets automated and then communicated to people. And then the last part's my favorite, or second last part, my favorite part is the messaging software. So throughout today, I highly encourage you to use the messaging software to either connect with the exhibitors that are presenting or to connect with other attendees during it. So we've designed it so it's super easy, very simple, and obviously that's where I want you to extract value from. And then obviously I've already mentioned about the conference software part. So from us as a company, some of the things that we're working on from a development perspective is we're integrating our two sites of WI and CRISP. That may not mean much to some of you. To some of you, you may have found that a frustration, but you'll understand what I mean shortly. But we're integrating the two sites, and that will be done in the next couple of weeks. Obviously, we're going to be investing over the next couple of months into AI matchmaking for founders. So that way it can simplify their discovery process for relevant investors from their side, so they can proactively connect. And then if you wish to engage, you can accept that. And then Project X, I won't talk about too much, but that is a game-changing thing for us where basically we'll be making available to our clients investor access to global VCs, PE, family offices, etc., so that they can proactively engage with from the platform. And then the last part is we're working on an enterprise version of what we're building, because For me, once again, what I see our role is creating opportunities for tomorrow. I want to facilitate, whether it be ecosystems, whether it be co-working spaces, fund managers, whatever it may be. I want to facilitate this deal discovery and this standardization process of accessing opportunities. So people always ask, what are some of the opportunities with Wholesale Investor? Obviously, collaborate with our team. If you're an advisor, we'd love to have a chat with you about some of your deal flow. Obviously, investors, we work with a lot of investors who refer us their investee companies. And then obviously directors, we work with a lot of directors for some of their companies that they're on boards of. And then also as a company, as part of our expansion, we are also raising capital for ourselves over the next few months. And that's really to expand our mission of creating this global opportunity via the software that we've actually built. So that's it from me. Now, as the next stage, there's my contact details. Feel free to add me on LinkedIn. Now, to introduce the first speaker for the session, this is someone that's really, I suppose, inspired my thinking in a lot of different ways. And to be blunt, some of the stuff that I'm implementing going forward, I originally got the idea from John and let him know that I was doing it. But I said, what I love about John is I mentioned to you, everything I think about is how to scale capital raising. Everything John thinks about is how to scale investing. And we've basically got it's funny, we've got two similar but very, very different approaches into the way we actually do it. And he said, and obviously we're fortunate enough to also be business partners together through the HWI Fund in Australia. But I want to encourage, this presentation I've now seen twice. For a lot of people who don't understand the mission that John's on, I said, I've watched him grow and expand over the last 18 months. Incredible insights into this space. And I think a lot of what, when he talks about moving venture to venture 3.0 is actually incredibly exciting. And you can see the results starting to tick over for John now and some of the impressive metrics they're able to produce. So on that note, I'd like to introduce our keynote for today, Mr. John Sharp.
Hi, everyone. Let's make sure our clicker's working here. Great, thanks everyone. It's great to see you all, and it's great to be here at another Wholesale Investor event. I just wanted to pick up on something Steve just said about how one investor meeting can change your life. As someone who's had occasionally 200 meetings for one good outcome, I think that's probably about the truest statement you can make about the most important thing founders can do, and that's have lots and lots of meetings. So I encourage all of you here today, especially the founders, to meet with as many people as you can, because you really don't know when that next meeting will change your life. I'm here to speak about Venture 3.0, and I'll be talking about machine learning, artificial intelligence, and as Steve mentioned, some of these things get bandied around a little bit. AI is variously seen as evil or good, depending on who you speak with. And I was watching the BBC yesterday, and I saw a couple of guys talking about AI and its use in very sophisticated weapons. And the interviewer said, aren't you worried about the fact that AI connected to nuclear weapons could cause all of our devastation? And the guy said, no, I'm actually far more worried about the dumb weapons than I am about the AI-powered weapons. Now think about that statement for a second, because I think that's a very, very smart statement on what AI can do. AI in itself can add intelligence to any situation. And what we're going to talk a bit about today is how we can move from legacy systems of investing to systems that are informed by intelligent systems, process automation, and other ways that we can make venture better. First thing I want to note is that there's some family offices I can see in the audience here, and some investors that are not traditional VCs. And these investors are starting to get a bigger slice of the pie. I was just at a family office event in Monaco a few weeks ago, and it was almost entirely family offices, and there were maybe 20 20 founders that came to speak to that conference. And I asked a couple of them, I said, why are you coming to meet with, essentially a family office conference? And they said, well, family offices we think are really patient capital. We think that there's going to be some guys that are in our space, and the guys I was talking to are in digital healthcare. And I think that's broadly true. Some of the angel groups that we power with our Hatcher VAAST platform contain a lot of doctors, dentists, people in healthcare. So if you have a digital healthcare startup, it makes sense to interface with these family offices. But the point I want to make with this graph here is that there's a lot of people entering the investor space here that weren't here 10 years ago. 10 years ago, they were doing 129 deals. Now they're doing 2,000 plus deals a year just in the family office space. And they're responsible for increasingly about 10% of the deal flow worldwide. And as you can see here, the family offices themselves have gone from allocating 1 to 2% to around 20% plus of venture. And at a meeting with UBS recently, they told us that some of their clients are at 50% allocation to venture and private capital. So if someone comes up to you and they show you a card that doesn't say VC on it, don't automatically reject them out of hand. They may be your best bet today for an investor that you want to meet. So look, this is all great. The rise of venture, there's a lot of people entering venture now. What I want to talk about is what is happening within venture that may not be obvious to many people in the room here, and that is the transition that we're seeing towards what we call at Hatcher Venture 3.0. So let's talk about the three phases of venture as we see them. The first Venture 1.0 phase is very well known. This, by the way, is a picture of the very, very first VC deal, 1960. Someone puts, ARDC put money into DEC Computer, and 10 years later they had an IRR of 100%, massive IPO, and everyone went, oh my God, what is venture? This stuff sounds pretty good. And that was really the first thing that took off. Sequoia happened in 1972. You had Kleiner and NEA and other firms pop up in the next 10 years after that. And leading up to 1990, it was still pretty much a boys' club, still pretty much centered in Silicon Valley. And of course, it took a long time to get a deal done then because everything was bespoke. Everything was a brand new thing that they were pulling together, this venture industry. Now, Venture 2.0, this is where we are now. This is the golden age of venture in many respects. You've got everyone working together. You've got family offices, angels, venture firms. Everyone's created this fabulous cooperative ecosystem where we all get together and party like it's 2020. And you can see it here. This is a picture of a 500 startups demo day. What else has happened? Global returns have stabilized, so you now get the same kind of returns from Africa and Latin America that you do from the US. Never used to be the case 10 years ago, but now you can get money all over the world. And I used to have a slide here where I'd challenge people to figure out where this picture was taken. Any guesses? Rio. There's just no way anymore that you can know if it's Delhi or Rio or San Francisco or anywhere else. Everywhere looks the same with these demo days. And that's part of the point I'm making here, is that we've created this global situation where everything is in perfect balance. All the systems are there to do a deal pretty quickly. The due diligence is fairly understood. Processes are kind of the same. So what could disrupt this perfect world that we're in? Maybe this, maybe Venture 3.0. What is Venture 3.0? What characterizes Venture 3.0? One of the things that characterizes it is a massive amount of capital that's moving into the space. So you've got JP Morgan lending Tiger Global $5 billion to invest in venture. That's a lot of money in venture. You've got venture firms raising more money than ever before, more dry powder than ever before. Forget all the gloom and doom BS that you're seeing in the news media. There's more money in venture capital waiting to invest in new venture firms than there has ever been before. So this raises a question. How do you get rid of this money? How do you invest this money? You have to apply new systems. You have to apply new technologies. Now, when Goldman Sachs faced this problem in the 90s, how do you invest in public securities at a much higher velocity than before? You adopt a lot of technology. You do a lot of data analysis. You use a lot of AI. And if you look at the start of the 90s and the end of the 90s, at the start of the 90s, I'd be going to Solomon Smith Barney, there's a name you probably haven't heard in a while, and saying, I want to buy some AT&T stock. And they'd say, okay, fine, we'll get back to you in the afternoon. By the end of the 90s, my money is part of a multi-billion-dollar dark pool somewhere, getting invested in a whole bunch of stuff that computers are making decisions on. Completely transformed over 10 years, public securities. So our view is venture is going the same direction very, very, very quickly. And the new players, the smart players like Steve and Wholesale Investor, like Hatcher, we're adopting AI as fast as we can. We've raised almost $25 million at Hatcher to invest in AI and data processing. As a VC, that's our operating budget, and that money is getting invested into making us more intelligent. A couple of other things I'd mention. When Tiger Global invests in things, when most VCs invest in things, they're investing in a seed to IPO strategy these days. It used to be I would go to a party and I'd say, hi, I'm a seed stage investor. Doesn't happen anymore. It won't happen in 5 years. You won't hear people introduce themselves anymore as a seed stage investor or a Series A investor. It's all going to be seed to IPO. Why? Because you'll invest in seed, you won't let the guy in the next round, and you definitely won't let them in the round after that. So your seed stage investor is going to be there for multiple rounds, and they're going to build mega portfolios. Hatcher's goal is to build a portfolio of 1,300 companies. We just raised a bunch more money to help us get to 500 companies within the next 2 years. And then in the next 2 years after that, we'll hit our goal of 1,200 companies. That's a mega portfolio. What do mega portfolios do? They're a lot more diverse. They more robustly produce returns. You can basically put a mark where that return's going to be, and it's going to be somewhere around 4.2x in 10 years. That's the benefit of a very diverse mega portfolio strategy. The last thing I'd say is the kind of processes we're seeing come into place now are going to be very similar to that transition I talked about with Goldman Sachs in the 90s. It's not going to take 6 weeks or 6 months to do a deal anymore within a couple of years. Those deals will start to be done in hours or minutes or days. Already they're happening in days, mainly because the processes have been automated. So this is where we see Venture 3.0 going. So let's recap. So Venture 2.0, when you think about it, is a pretty slow animal, right? It moves very slowly, it's very manual, it's very collegiate. We all call each other in the venture community saying, we've got this great deal, do you want to come in? Right? It's local deal flow for the most part. You've all heard that phrase TMZ, which stands for 30-mile zone. It's an American phrase. It's very much, I think that really characterizes venture capital very smartly because most VCs only invest in a 30-mile zone. That itself is changing. And you'll see VCs now that never used to step out of their backyard, and they're hopping on a plane and they're going global. A lot of the VCs are still doing manual DD and analysis. They have a team of junior analysts in the front there, and their job is to look at your business plans, founders, and decide if they should go upstairs or not to the partners. Now, what could go wrong with that strategy? A lot. You've got an idea called Airbnb. What's that? A bunch of air mattresses in a spare room? That doesn't sound like a very good idea. Right, so does that go upstairs? A lot of times it doesn't. Uber. Who's going to hop in the back seat of some guy they don't know and just drive around town? So you can see that there's a problem with a lot of the ways that people currently approach analysis in the front office. Most VCs have small portfolios because they have 2 partners, 3 partners. They can't afford more, they can't scale, so that they keep their portfolios purposely small. That goes against what statistically should be your strategy. It used to be that impact wasn't very important. We didn't really care about it as VCs. No one did. And suddenly it's vital. It has to be in every deal. No one's investing in stuff anymore that is not impactful. Or at least you're only investing in stuff that does no harm. Stage specific, I spoke about that. Co-investment rights. It used to be that investors wanted to invest in your next round. Now your investors are much more likely to be a co-GP than just simply get co-investment rights. An LP, which you've probably heard the phrase, refers to someone who's a limited partner in a fund. The limited word refers to their limit of liability. The GP has all the liability for the decisions. The LP has none in that scenario. Increasingly, the LPs are saying, you know what, I want to be part of the decisions. I want to be engaged with these investee companies. And that's another big change that we're seeing. It used to be VCs would get you together and they'd put on a function and they'd have an annual report that they do to their limited partners. Now that's moving. Real time is really what most investors want to see today. If a co-founder left yesterday or took some time off or the product failed, they don't need to wait 9 months to know about that stuff. They need to know about that right now. So let's look at 3.0. It's fast, it's automated, it's competitive. VCs are now up against each other. Why? Because there's too much capital and they need to get in the deal. And so no longer are we all super friendly, we're now frenemies. We're fighting over deals. So your deal is going to get taken up usually by the guy that you meet with, and maybe they'll share it with one other person, but it won't be 10 people in the round anymore. Everything's very, very much global. It's very much AI-powered is what we're moving to here. Mega portfolios of above 500. Claudia Zeisberger here at INSEAD and a couple of colleagues did some research recently that shows that the Hatcher strategy of investing in 1,000+ companies, Dave McClure's strategy of investing in 500+ strategies, these are the strategies that work when it comes to creating returns that you can rely on. That's not to say small portfolios won't sometimes create 10x or 20x returns rather than a 4x return, but more often than not, they will return 1x or 2x. So a 500 company portfolio is really what you want to be aiming at as a VC. Impact is now a core metric. When we ask people to apply on Hatcher.com, we ask them, what are you doing in the areas of impact? And that contributes to your investability score on our platform. So how real is what I'm saying? You can say, okay, what's this guy? You know, like he's just one guy. What does he, what does he know about AI? Well, Gartner is a pretty well-respected research firm, and they believe that by 2025, 75% of venture investors are going to be using process automation and AI. Isn't that interesting? Now, how many VCs are using it today? Not many. What about family offices? What about non-VCs? What about angels that are in the audience here? Well, if you want to compete and you want to do deals in days rather than minutes and you want to take advantage of process automation, you're also going to have to get on board with technology. And so one of the things I'm going to spend the last few minutes here talking about is what we can do to help you. And what I want to do here is introduce our VAAST platform. So the pandemic was very good to us, and one of the reasons it was very good to us is at the start of the pandemic, we didn't know what to do. All of the accelerators that we normally invest with had closed down. There were physical co-working spaces. You couldn't turn up to work. We couldn't get on a plane and go and raise new capital. It was very difficult. So we decided to lock a bunch of guys in a room, give them $12 million, and see what they could do to improve our technology. And so that's what we did. We locked in fund managers, lawyers, data scientists, process automation experts in a room, and they came up with VAAST. VAAST stands for Venture as a Service Technology. Like what Steve's doing with CRISP and at WI, we're doing with our platform. And as Steve mentioned, there's a few differences to what we're doing. We really focus on the investing side. We focus on what you need to build in order to build a 1,000 company portfolio. You can't do that using manual systems. You'll go absolutely mad. Worse, you won't know what's going on. I met an angel the other day from India. He's a billionaire. And I said, how many startup investments have you made? He said, oh, I don't know, 100. And I said, how are they doing? And he said, I have no idea. Why doesn't he have no idea? Because it's all sitting in a spreadsheet somewhere in his office when they report, if they report. So technology can really be your friend. By the way, our service, we went up against 476 fintechs last October in Zurich, and we ended up in the top 3 in the winner's circle there, top 2 actually, with the Future of Finance Challenge. And what UBS liked and what their judges liked was how we could address many of those Venture 3.0 issues with our set of technologies. I want to stress that we built this because we're investors. We're not software guys. We actually are software guys, but we're investors. So all of us had a previous life as CTOs. Dan and I have both been CTOs for some pretty decent companies, and we've both spent a lot of time coding. I'm a process automation guy. My partner Dan's a data scientist. And we also run 3 funds here, just as an example of 3 of the 11 funds that we run. And you can see here that 15 companies, 150 companies, this is where we are now. We just got a commitment for $250 million for our carbon fund. So when you look at these things here, if we didn't have technology, we'd be asking the question that many investors ask, and that is how can we continue to scale up while keeping our costs down? Because typically when you start adding funds and you add portfolio companies, you need to add people. And if I go to the Valley and I go and meet with some of my peers there, I'm going to be walking into offices with 200 or 300 people. We have 15 people at Hatcher, and we have a 150 company portfolio. Everything gets audited. Everything is known to the second as what's going on at these companies. And part of the reason for that is that we have built the solution that enables us to do that. So with our solution, you can set up a fund in 5 minutes. You can expand your deal flow. You can use AI to grow and manage your portfolio, and you can automate your back office. I was stuck in a bus the other day with the head of a Saudi fund of funds. We went 2 hours from Abu Dhabi to Al Ain to look at an indoor farming project that was awesome called Pure Harvest. And I explained to him what VAAST is, and he said, wow, he said, this is like a GP in a box. And it is. It's like a VC in a box. If you don't have staff right now, but you have money, you can sign up for VAAST, and it will do the work for you. And part of the work that it will do is it will help you build a fund. With VAAST, you can build a fund in 5 minutes. If you go to the lawyers here in Singapore, it'll be 6 months or 12 months to build a fund, and they won't be plugging you into an auditor or a fund admin or an external asset manager. We do all that, and we can do it very, very quickly. I don't need to tell anyone in this room how much the Singapore VC is gathering steam at the moment. This, as a fund structure, is really, really doing incredibly well. And by the way, if you're a family office and you're in the audience here, or you're an angel investor, you might want to consider moving to a VCC, because the diligence that they do in a VCC consists of asking the fund manager for a letter of comfort versus all the KYC stuff that you're going to have to go to as a standalone investor. This is a set of VCCs that we set up recently for a Dubai family office, $80 million. That was the size of the fund. And just looking at the costs on the left there, that's what they were quoted by all the entities, the auditors, everyone else in Singapore. That's what we ended up charging them. So there's a huge difference when you automate things and when you reuse back office and front office staff. It can be hugely consequential in terms of your operating costs. So we can help you set up a VC and run it at minimal cost. And by the way, I'd stress this is for an $80 million fund that's quite complex and has a lot of bells and whistles to it. For a $20 million fund, the costs are going to be probably around $60,000 or $70,000 a year, which is less than the cost of one person. So what is Deal Scout? You heard Steve talk about deal sourcing today. It's super important for investors. Without Deal Scout technology, what we have in our database is about 1 million VC-backed companies. It has AI-powered search and mandate matching. I was just on the phone yesterday with 3 of our top data vendors who all want to re-up us on their contracts. And I was just playing around with their systems, which I rarely do because they're so horrible. And I was trying to search for companies, and they were forcing me to use keywords, and I was bringing up all these profiles that hadn't been updated in 2 years, and it was super annoying. With our system, you can go in there and you can feed it a brief using English, and it will go looking for that brief. It'll go looking for exactly what you've stated, and it will find it among the 1 million companies, and it will give you a competitive matrix of what it's found. And this is what that looks like. It's designed to kind of operate a bit like Netflix. What I've asked it to do here is to look for indoor farming projects in the United Arab Emirates, and this is what it's found. And so it's found 501 entities here, and it's listed them from what they think is a close match to what I'm asking for, to the stuff that's just broadly in that space. And on the right-hand side here, like Netflix, I can say more like this, less like this, and I can train it to understand what I'm looking for. That's a much better way of looking for deals than most other systems. And by the way, Steve and I are talking at the moment about a licensing deal with our AI, so our companies will be getting closer together and cooperating in this very important area. Okay, lastly, what's our back office offering? Our back office offering is simply you can log in and you can see what's happening right now today. You can get today's NAV. Anyone that's ever tried to do a deal with a fund admin group knows the first question they ask is, well, how often do you want us to report, right? And their cost to you is directly related to how often they report. And to keep costs down, you'll say, I don't know, 6 months, 3 months. With our system, you can get a NAV right now, right this second, that's up to date. It's also got support for paperless audit. You can self-serve. You can manage an unlimited number of portfolios. It's multi-language. It's multi-currency. 18 languages, 50 currencies, including the top 4 cryptos. We do charge for this. Deal Scout is about $10,000 a year. The fund builder, you can set up a fund for $25,000, and then it's got to cost you a de minimis amount of your AUM. We looked at doing a fund yesterday for a Swiss-based group that's buying resorts. It's not venture, but it's an asset. And for them, the costs were very, very little. It's a $25 million fund, and the costs, I think, came out to be about $55,000 a year to run it. Again, it's very hard to staff up and get even close to that if you're doing it yourself. So look, I just want to leave you with some thinking here. We've talked a bit about venture 2.0 versus venture 3.0. There's a couple of things I didn't touch on. Hatcher VAAST is sitting on the blockchain. We're on-chain. What does that mean? It means that no one can jump into a centralized database and change one piece of data and screw you out of some shares in a company that you just invested in. Why? Because that data is sitting out there on 14,000 other servers, hashed. Right? So every piece of data on our system is verifiable. And so when it comes to auditing, the auditors know that no one's in there manipulating the data, which is extremely important. Our data is fully encrypted. So if someone were to break into our database, they're not going to get very much information. It's encrypted the same level of encryption that virtually every large-scale company uses in the world. So I'm not going to go into much more detail than this, other than to encourage you to have a really good look about what Venture 3.0 means. Because the problem with staying in Venture 2.0 is the same with everyone that stays in an industry that's getting disrupted. Eventually what happens is you run out of customers and you run out of space, you run out of air. And so have a good look at Venture 3.0. If we can be of help to you, if Steve can be of help to you, I think both companies are moving in exactly the right direction. Please come and see me. I'll be around the conference here because I want to go and have a good look at who's presenting next door and the founders there. I hope this has been helpful and interesting. Please follow me on LinkedIn or Twitter. And again, get in contact if we can be helpful. Cheers.
Thank you, John, for that wonderful keynote session. So for those of you I haven't met yet today, my name's Jonathan. I'll be emceeing. So I'd like to announce the first panel session of the day. So NFTs and the rise of digital ownership. Can I ask the panelists to please come to the stage? So Hayden Hughes of Alpha Impact Group, the CEO. Lim Hui Ji of Vision Group, founder and CEO. Ben Simpson of Collective Shift. And Kishore M. of Crowdfund Junction. Thank you. Test. It appears we're missing someone. So we've got Ben. What was your name, sorry? Lim. And yourself? Hayden. Okay. So we're missing Kishore. That's all right. Do you guys just want to kick off?
Sure.
Yep, cool.
I don't know.
Is someone moderating?
I thought you were moderating. All right, I'll moderate. How does that sound? Apologies for this, guys. Kishore must have been moderating.
I've got the questions here. I'll do it.
Okay, question one. All right, Ben. So question one. In the audience, there may be some investors who are cautious regarding investing in blockchain and in particular NFTs. To give them some perspective, could you name the most interesting and or promising examples of using NFTs for businesses?
Okay, I'll talk about maybe Gary V's NFT. I don't know anyone in the audience are familiar with Gary V, but he's building a community around different characters, and those characters represent different, I guess, feelings or emotions or characteristics of what he's calling like a good human, basically. And if you own one of his NFTs, you get access to his annual conference. So I went to his conference in Minneapolis a couple of months ago, and you can only get access to that conference if you have his NFT. So NFTs, the best ones I'm seeing are basically just digital communities that you need access to attend events, become an online group, get access to different people. The other large one is the Bored Ape Yacht Club, which is the largest NFT collection in the world. Players like Snoop Dogg, Eminem, Gary Vee again, Justin Bieber, some of these biggest celebrities in the world own the Bored Ape Yacht Club, and to get access to their events and their private dinners and stuff, you need to have access to that NFT. You can't get access any other way. So I think that's the most exciting thing I'm seeing at the moment, the communities around them.
Okay, no problem. Thank you, Ben. Kishore? You're moderating, correct? No? All right, I'll keep moderating.
I think you're the
All right,
moderator.
thank you very much, Ben. So, Lim, are you from Singapore? Do you mind me asking?
Yes,
Yeah, okay. So just on that, obviously, I guess you might have a different perspective. Do you mind offering your thoughts just on the same question?
Yes, I will. So I think for the NFT space, it's something that's quite interesting. If we look a little bit at the growth over the last number of years or so, I believe that the NFT space probably has transaction value of maybe about 25 billion last year. And just in our first half of the year, we have achieved approximately about 46 billion in transactional volume. And if you take a look at the first half of last year itself, it's just slightly under $1 billion. So you look at a growth from billion to 25 billion for the full year. And in our first half of 2022, it's already about 46 billion. Although the growth is fast, actually the numbers in totality is actually quite small in the overall view of things. But the important thing is that I foresee that this will potentially grow more significantly as more players come into this particular space to better understand how NFT operates and work, the different use cases, and more importantly, the technology becomes more easily adoptable for the different users itself. We see a large number of companies that's entering the space. Other than the traditional digital assets and crypto space, we see a lot of the large brands, whether it's from Coca-Cola to McDonald's to Louis Vuitton to Lamborghini. And a couple of them have some interesting use cases. Unfortunately, it's still very nascent at the start where adoption is not fantastic, but I believe strongly as more and more so, when the entire space actually grows, that there's going to be much more significant adoption. The adoption, I think, at this point of time, it's very much actually around the gaming as well as the collectible space. But NFT has so much more other use cases other than just gaming, as well as the so-called collectible space. And I believe as you go through the panel, we'll explore a little bit more on that. Thanks.
Okay, thank you very much, Lim. I think this leads well into question 2. So this one, I'll ask you, Hayden. Last year, we saw a very high level of interest in NFTs. This year, everyone is talking about the crypto winter. Which projects, in your opinion, have the highest chances of surviving?
Sure. So I think it's a great question. And where I sit, I'm looking at a lot of, we run a Alpha Impact, the company that I run, as a social trading platform. So people come to our platform to find ways to invest in this asset class. I think it's worth mentioning the fact that this, as a crypto winter, so to speak, is a little bit different to the last time around. I think most of the people on this panel were in the previous crypto winter. And what we saw in 2017 was a meteoric rise in assets. Everyone was kind of talking about crypto, but no one was actually doing anything. Fast forward to today, and you have, as was mentioned, NFTs being used for real stuff. 2017, everything was a pipe dream. Nothing was actually happening. And so the 2018 crypto winter was really very painful and existential for many of us who felt that this is maybe the crypto industry won't survive. Fast forward to today, asset prices have declined to almost the same levels as they did in the previous crypto winter. There's a real sense of optimism. And you look around and you see venture funds raising 1 billion, 5 billion. So the amount of dry powder in the space that's there to be deployed into new projects is just gargantuan. It's crazy. So I think the industry is well positioned to continue funding innovation, whereas in 2018, in the previous crypto winter, there was nothing happening. I think the most conservative way to think about finding an investment thesis is actually not project by project or deal by deal. It's so let's break it down. So there's, in the crypto world or the NFT world, there are private sales where projects sell a very small amount of their tokens very early at a high discount. Those are almost impossible to pick unless you have access to the deal flow. And really, that trade only makes sense for 4 to 6 months every 4 years. So it's very tough unless you're a specific investor that has access to that stuff to get in. I like to think about the fundamental building blocks that the public layer 1 blockchains that other things are built on top of. So Ethereum is a great example of that, built as a blockchain that has smart contracts built into the programming language. Many of the applications we see are built on Ethereum, including a lot of the NFTs. So I think if you have a 3 to 4 year time horizon, I think you need to think as an investor about which blockchain is going to succeed getting the most adoption. Tezos is a great example of one that I think has an amazing technical product. It can't be forked. So the French central bank has just said we want to use them as a pilot for their CBDC. So I think, but in the next 2 years, I think Ethereum will continue to outperform Tezos. So I think it's very important to have a view on the layer 1s, these so-called protocol layer coins that have the ability to have an ecosystem built on top.
Awesome. Yeah, thank you very much. Kishore, I'll hit you with the hard one for that late arrival, okay? No. So, question for you. Pretty much everyone who uses NFTs is considered an early adopter. What is lacking, in our opinion, for broader adoption of Web3?
Right. So, unlike Ethereum, Bitcoin, and the other coins, NFTs is non-fungible, right? So, if you look at the adoption of NFTs, it's more about I would say profile pictures and more on the price point of view more than the utility. That's kind of getting ignored. But I think with the bear market coming in, people are questioning the utility. And I think that's where the whole thing is starting to change. And you'll see more and more NFTs being used in, for example, in authentication, in ticketing, voting, and possibly every business will be looking at how we can use NFTs to scale and grow their business, because there's a lot of use case. And I think that's where adoption will start to kick in, more than just collectibles and people trying to chase the next Bored Ape or the next CryptoPunks.
Okay, thank you, Kishore. I'd actually like to also get your opinion, Ben, on that, just because I know at Collective Shift you're really involved in the education space around Web3. So I think, yeah, it'd be great to hear from yourself as well.
Yeah, I'd echo what Kishore said in the last November, when the NFTs were really probably at its peak. There was so many people coming out, especially influencers launching their own NFTs, really as a cash grab. And I think now 6 months on, when there isn't the FOMO and excitement from retail investors, a lot of those NFTs aren't really doing too much anymore. And a lot of those NFTs walked away with 50, 60, $100 million, right? So I think the real builders and the best NFTs right now are going to come out of this bear market. Like most good companies, they're built in down periods. So I think we at Collective Shift focus on more of the retail side. So I see a lot of education gap as well. I'm still getting messages from random people, getting inboxed on Instagram with random scam NFTs, and they're trying to FOMO in, and there's just a lot of lack of knowledge, I think, as to what a good NFT is, how to find real communities, and how to, I guess, pick the good from the bad. So education, I think, for me is a big missing factor for us.
Sure. Yeah. Okay. Awesome. Thank you very much. We'll circle back to you, Lim. So another question. There's so much noise in Web3 from shit coins. Is that a typo?
That's a technical term. That's a computer science term.
I'm allowed to say that. Okay. From shit coins to outright scams to garden variety mediocrity. How should investors analyze Web3 projects? What fundamentals should we return to?
I guess there's a lot of different investors within the space as well. There are investors that are very early stage, and they're just looking at how the community it's really reacting towards NFT itself, whether there's any uptake, whether the community outreach is actually great, whether there's a story behind it. And those were very much the early NFT so-called investors, and literally a lot of the different things that they put in, there's a good chance that some of them actually increase in value and price. And it's actually when the liquidity starts cutting, a lot of them start losing money as well. But my personal view, very much in the space itself, other than the traditional digital assets and NFT space, it's very much how the NFT space is combining with other so-called projects within the space that might ride upon certain forms of enterprises or government or tightly related type of projects. One of the projects that I've recently been looking into was a project called Oz Finance, and it was quite interesting because what it was starting was very much looking into the free trade zone or special economic zone from a global scale, starting with the Philippines. And in essence, what they did was to do a collaboration with the Philippines government to provide NFTs to identify potential tax residency type of models, where they eventually can provide NFTs towards people who want to get tax residency in the Philippines and vote on projects within the ecozone itself. So projects that are related towards specific potential brands, potential large enterprises, potential other use cases where there's already a very strong native community and audience, or on the other aspect, regulation, clearance, or push within the space, I think might have a potential chance to have some forms of sustainability.
Can I add to that?
Absolutely.
So we are a DAO VC, and we look at three things. First and foremost is the team. That's the most important thing. Projects come and go, but if the team has been abandoning projects in the past, and that's what exactly happened to Azuki, right? Then the floor price of the NFT can really drop down. So it's very important you check the background of the team. Second is the community. Now, when I say community is, please be careful because a lot of projects, they will increase the number of followers, whether it's on Twitter or Telegram or Discord. But if you look at the engagement, it's absolutely nothing. So look for real engagement. And that's where you kind of know whether there's real community out there or it's just bots. And of course, third, I would give equal importance to tokenomics and utility. Utility can keep changing. We can understand. Projects keep pivoting. But tokenomics is important because if you have an NFT with the use case of tokens, make sure that it's aligned with the market maker. Because a lot of projects, they go fundraise first, and then they look for market makers. Now, market makers are not magicians. So please work with them first before you finalize the tokenomics.
Can I make a quick comment? I think another thing that has struck me as being different in crypto compared to traditional finance is just how accessible people in the industry are to one another. I'm an investor in, 50 public companies, and I don't think I could call up those 50 CEOs and say, hey, can we have a chat? You run a, $500 million airline, let's have a chat. They'd push me to the investor relations department who would just send me some form, hey, check out our newsletter. Founders in crypto tend to be fairly accessible, even to external investors or to one another. There are, I think, a lot of founders who have been in trouble lately from possibly not doing the right things. But in general, I think it's extremely easy to just get on a call with some of these people. And if investors here in the audience or elsewhere are looking at investing in these projects, you can literally join the community on Telegram or on Twitter and say, hey, I'm thinking of investing. Let's have a call. Founders are generally pretty accessible. And one of the things that I think, just to give a small plug to Alpha Impact and what we do, users on our platform are really confused as to how to think about investing in crypto. And so much so that learning how to trade these assets has become a major priority. So we've actually built this separate business called the Traders 100 Club to help people figure out how to think about trading. What we're seeing is, in the old days, everyone wanted to just have an expert do the trading for them, and now people really want to do their own trading. So that's our Traders 100 Club program, and I think it's learning how to think about trading these assets is very important because the tools that you learn are extremely important, outside of crypto as well as in the industry.
Yeah, one more thing. I think it's a really good point. I think there's a big opportunity right now in the UI and UX space of crypto, like trying to explain to my mum how to buy an NFT and go to Ethereum and then get a MetaMask and then don't send your seed phrase to anyone and then like all this stuff and ledgers and gas fees and OpenSea and Solana, like it's actually a bit of a nightmare still, right? So a lot of the people in the room are probably early adopters, finance, tech people, we get it. But I think for the next wave, like the next billion people, the early majority are going to be your mum and dad investors. So I don't think there's enough time and capital being spent in the user experience space right now. I think that's a bit of a trend and a bit of a theme I think I'm going to be looking at to invest over the next couple of years.
I'd actually like to double click on something that you, Hayden, mentioned, and I guess ask an open question, because I think you're exactly right. It's still quite foreign to me, and I probably criminally so, seeing that I'm quite young still, but there is an openness that I can observe within the community itself. And if you contrast that to what you see in a lot of online environments, etc., where things are becoming, there's a lot of disinformation and toxicity, but I can definitely see almost an alliance amongst founders. So what do you think feeds that energy?
Sure. I think you were looking at me. I don't know if that was a nomination. I'll go first. Hey, I made it to the stage, so we've all beaten the odds apparently. So I think there's a real skepticism in throughout the world of crypto as an asset class, and I talk to bankers, and I talk to central bankers, and I talk to decision makers and family offices, and you name it. There's a real skepticism, and it's heavily influenced by whatever story happens to be trending at the moment. So there was a big piece that came out in New York Magazine overnight about Kyle and Sue from 3 Arrows, and I've had people messaging me asking, is my Bitcoin investment safe, given what I just read about these guys? So I think there's a real disconnect between what's actually happening in crypto and what is perceived to be happening. And I think, the naysayers that hate crypto, they raise a lot of arguments that I think in many cases are important to really reflect on and understand. And one of the arguments is that crypto doesn't do anything. NFTs don't do anything. They're just JPEGs of rocks and monkeys and bananas and things I won't mention on stage. And that criticism has been leveled at many different types of technologies. And it's important to remember, I think, that we're very early. There's no central banks using CBDCs yet. There's no major companies using NFTs for ticketing yet. All of these things are very, very early. And when I think back just in my lifetime to the internet, people thought that was a fad and it was going to pass. When we think about cell phones in the 80s, people thought that was a fad and that was going to pass. But when you think about how terrible the internet was in the first few years and how terrible cell phones were, my dad had one. It used to short the battery on his car unless he was driving. It was a car phone, and he would habitually kill his battery because his phone was using too much electricity in his car. So I think the naysayers have a lot that I do agree with, that crypto hasn't reached its potential yet. And I think all of us have a role to play in building something. But the argument that this is just a financialized ecosystem, that nothing is actually happening, I'm very sympathetic to, because a lot of the stuff that we're building has not come to pass yet. And I think all of us have a role to play in helping shape the narrative by building all of our things, by not doing an exit scam, by not over-leveraging from every single financial counterparty and destroying the whole industry. I could go on and on. So I think that's just some early thoughts.
Very interestingly, I just got back from the Web3 and NFT conference in India. And I've been to many conferences. The ratio of men to women is usually men are more than women. But because this was an NFT Web3 conference, the ratio of women were more than men for the very first time. And you'll be surprised, they were of the average age was 25. And they were all running their DAOs. So it was so refreshing, and there were a lot of after-party events which was organized by them. So what NFT has done, or Web3 is doing, and in that perspective, DAOs, is they are kind of leveling the playing field. More and more women are coming and getting opportunity in this space. And that kind of really, like you say, adoption, right? That's where I think adoption is really going to grow, because now it's not just the men, we've been in the Bitcoin space, the Ethereum space, but I think the NFT, the DAO space, I think is very much being equally driven by the women as well.
one other thing I'll say is around, I think the ethos of crypto is to be your own bank and not your keys, not your coins. And we've seen, as mentioned here, like recently, Celsius, probably one of the most trusted platforms in the space, just basically went bankrupt because there's sort of leveraged balance sheets and all this sort of stuff. But I think one thing that I'm a big believer in when getting into crypto is like anyone starting out should start with Bitcoin and should start to understand how to store that Bitcoin offline, where they can own that Bitcoin and they can do what they want with it and no one is in control. Because the reality is holding your assets on any exchange, as we've seen recently, just isn't 100% secure or safe. So understanding that whole ethos around crypto, being your own bank and owning your keys and wallet is super important, I think.
And I guess one other thing about founders very much bonding together in this particular space, I think fundamentally is because they really believe in the future of Web3 and highly passionate about it and how it would actually change the world. And I mean, we look at the entire movement. The fundamental thing is what really will be the future of this particular space itself. We talk about Web 1.0 being an I model, very much where the platform creators would create specific content. We move to Web 2, where it's a we model, where we start contributing and creating content as well. And we move into the Web 3, where it's an all model, where all of us are starting to contribute. And more importantly, looking into other areas of privacy and ethics and data, so-called being ownership very much towards a specific individual itself. So I guess in this particular space, a lot of people who foresee and look into the history of the space, looking at what's happening now and looking to the future, many of the different founders bond together primarily because they believe very strongly that blockchain and cryptocurrency would be a specific catalyst that will really make a huge difference and will be a game changer moving forward.
And sorry, if I can just say one thing. I think for folks who are considering this asset class as somewhere to deploy capital, it's very important to remember that there are safe places to buy these things. There are safe places to store these assets. I think Gemini is a very safe exchange. You can buy $25 worth of Bitcoin or Ethereum on Gemini. You don't have to go crazy into these crazy projects or brand new platforms. And I think that it's important that investors consider the possibility of what if all of us crazy Web3 people are actually right and we're not crazy, and some of these blockchains are going to have all of this adoption, and these NFTs do take off. And if that is the case, I think it's important to position accordingly, and that can be buying $25 of Bitcoin or buying 100 or 500. You don't have to start with $1 million. You don't have to buy a whole Bitcoin. So I think investors should consider the possibility that maybe all these Web3 people are onto something. And the way to defend against that is having some small piece of exposure, whatever that is for you. Don't go crazy, but I think $100 of Bitcoin is a safe investment. And I think it's important to think about what that would look like for each of you. So Gemini, I think CoinHacko is also good. Those are great platforms. Thanks.
Okay, great. Thank you all for your answers. That was fantastic. Another question, and I'll leave this one open. So in an environment where funding options are abundant, what is the role of institutional venture capital in funding Web3 startups?
I think institution can play a great role in governance. They can definitely play a role in I would say, custody. Custody is very important because with the kind of hacks happening and cryptos getting stolen. So Singapore has a good, I would say, ecosystem of institutional custodians, and they're also starting to offer to retail investors. One example being Propine, they're licensed by MAS. So yes, I feel institutions are going to be more on, I would say, the major coins like Bitcoin, Ethereum. I don't think they're coming in yet into the NFTs. NFTs is more retail-driven, majorly rather. But institutions can definitely help in growing this space once the regulators kind of start looking at NFTs. But other than if it's fungible tokens, I think that's something that they are already already have a buy-in.
I think that it's important to distinguish the traditional institutions we think about, venture capital funds that have been around for a long time, and what we call the crypto VCs. And I've talked a few times about this recurring market that comes for 6 to 8 months every 4 years. And during those crazy bull markets, you have deals that typically will go up 20x, 50x, 100x, not because of how good the project is, not because of how great the technical or commercial solution, but just because the market happens to be moving in that direction. And so we raised capital by doing a token last year, and it was absolutely insane how easy it was to get that capital. I mean, talking to VCs, raising equity takes several conversations. It's very hard. But raising a token, if you happen to be in that 6-month window, investors typically will spend 10 to 20 minutes on the phone with you and say, okay, what's the maximum I can get? I don't need any more information. I'm ready to close right now. And I'm not joking. That's actually what happened to us. So I think it's important to understand that there are some institutions that are not really institutions. They're just a guy and his brother who had 100K, and then they invested in a bunch of deals, and now they have a $12 million fund. And then they do no hedging, and then on the way down, they end up where they have $800 left over. So that is a very real phenomenon that happens at a certain point in every market cycle. And I think it's important for investors who are thinking about deploying into these funds to really understand what is the pedigree and what is the edge of whoever the manager is, and is this just the flavor of the month? And another thing I want to talk about is psychology. I think during these crazy bull market cycles, if every newspaper is talking about crypto every day of the week, every hour of the day, and all of your friends and family and kids and grandkids, that's usually a good time to sell. Those are not buying times. That means everything has happened, and now we're at the top. So just wanted to say that as well.
So I guess traditionally in the venture capital space, a lot of venture capitals fund risks for gains. And fundamentally, the model really, it's about looking into areas of problem statements that can be solved, gaps that's there, as well as how eventually they're able to drive some forms of innovation. So I think fundamentally from venture model, it's really about looking at good projects and seeing which are the ones that we eventually grow, forms of innovation, so that the entire world will be a better place eventually.
I just go back from the US and speaking to a few funds over there. I think the biggest themes that funds are investing right now is the gaming and metaverse sort of theme, and also just infrastructure layer 1 levels is probably the most popular, I think, macro broad investment scheme. But there's also just so much money coming into this space. I mean, the A16Z fund, what was it, $4 billion I think they raised, like back in Australia. Airtree's probably their leading Web3 VC back in Sydney. They just raised a $50 million fund. So there's a lot of VC capital coming into this space looking for a home. I think that's the smart money. Sometimes I do ask myself, are we crazy? But I think there are some very smart people putting a lot of money into this space. So yeah, it's exciting times.
Cool. We've got a few minutes left to run out of scripted questions. So I'm going to just ask one that I want to know the answer to. So obviously politics and all the legislation around crypto, it's still early days. So globally, is there a country you think that is positioned to be that overall early adopter and really benefit from being first mover with their legislative choices and reaping the benefits? Is there
I think Singapore. Singapore has been in the industry, the crypto industry. Earlier in the year, Singapore globally, there was a perception that the Singapore regulator was moving slowly, but then just a few months later, the whole industry blew up. And I think it's appropriate to move slowly. I don't think we need to be giving licenses to every Tom, Dick, and Harry. It sucks because we're going to apply for a license and it's going to take a very long time and it's very challenging. But that's what you need in financial markets is you need strong regulation to prevent the future. I don't want to mention these firm names again and again, but prevent the future industry blow-ups from happening. So I think Singapore is well positioned. There's so I'm a lawyer, and the beauty that we have in Singapore is that we have regulatory clarity. We know what the law is. We know how to get a license, what you need to do, what you need to not do. I think Singapore is really well positioned for that in a 10-year time horizon.
I think if you are issuing tokens, yes, Singapore no doubt has the infrastructure, the legal aspect of it. But if you're looking for talent, then I think Vietnam is definitely a place to look at. Just got back from there. Talent is just superb. Indonesia, definitely, if you're looking for gaming, those guys are just amazing as far as gaming is concerned. And if you're looking for Web3, India. Yeah, so those are my...
So I guess it's very much dependent on the project or the end objective of what they would like to eventually achieve. Of course, from a jurisdiction standpoint, having forms of clarity as well as regulatory cover, it's always important because you don't want a country that changes all the time and basically every single couple of months because it swings there and they charge you licensing fees for it and they'll be able to make money from it, they move that space. So I think Singapore's been doing really well in terms of charting a roadmap, not just for now, but what would eventually be in the future in this particular space itself. There is very inclusive in terms of constantly engaging the community as well in what will be the areas that they should be looking to regulate, what will be the areas that they should be looking at to better enforce upon, what will be the areas that they should actually look into to actually improve so that the entire space itself would actually become better over time. So I think from a regulatory and jurisdiction clearance perspective, Singapore will be definitely fantastic. And I guess today, from talent perspective, definitely from different areas and geography. However, today, I guess in the Web3, we are very much a global so-called country, or we're a global workforce, or we're a global organization. And typically, most people even work from home or remotely. So I guess from that particular perspective, after the pandemic, or even because of going through that particular phase, we are just so much more flexible in being a so-called countryless organization in terms of operations. But I guess from a jurisdiction standpoint, Singapore has very clear jurisdictions. And I think the community has very much benefited from that.
Okay, awesome. Well, thank you everyone for your answers and questions today. Yeah, cheers Ben, Lim, Hayden and Kishore. So I think that wraps it up. We will step off the stage. I may or may not be in this seat again, so we'll go from there.
Thanks for moderating.
Let's have a round of applause for our moderator.
All right, thank you everyone. So we're now moving into the round one of presentations. I'd like to welcome to the stage Lawrence Ginseri, founder and CEO of Skyhook Capital.
Okay, good morning everybody. Let me begin. So I'm going to start off the day with actually a homegrown Singaporean company, although despite my accent, I sound like I probably came up from Sydney with Steve Torso and the crew, but that's not the case. You know, Skyhook, we founded that business just over 3 years ago, and the focus was really to look at how do we integrate into the wealth management industry or sector what's going on in the blockchain industry. We felt that when you looked at the stats in the wealth management industry, you know, you've got 60 million accredited investors across Asia Pacific today. That population is expected to double by the end of the decade. Surveys that have been conducted by the likes of Accenture have identified that over 64% of those investors prefer to access their wealth services over their mobile phones. They're not interested in talking to advisors. Already today, close to 50% of funds are actually transacted online. And when you consider that most of those investment products are going to be moving onto the blockchain as a digital security in the coming years, you start to see that there's quite a bit of disruption that's heading our way within the wealth management space, away from what we call the traditional approach of wealth, which is advisor-driven. Now, with Skyhook, we have a number of advisors, and we've got founders that have been drawn from already entrepreneurial worlds. I mean, myself, I built a company, AG Delta, that really pioneered a lot of the advisor-driven approach to delivering wealth management services. The platform was all about automation of the advisor experience to help service the customers. But when we're moving into a market where you've got such a vast audience, 60 plus million, going to 130 targeted accredited investors just in Asia Pacific by the end of the decade, you can't support the delivery of wealth services using that advisor-driven model. So there's a number of disruptive forces that are already occurring in the wealth management space. Coupled with that, there's downward pressure on fees that are being charged by not only the private banks, but also the fees that are being earned by the issuers of those products. According to PwC, if you're an asset management firm today, to maintain your revenues going forward, you will need to increase your sales by up to 38%. So that is a direct effect of the downward pressure that they're experiencing with regards to fees. So clearly, there's a new approach that's required to deliver those wealth management services to customers. And this is all happening at the same time when you're seeing securities now moving from conventional onto a digital protocol, the blockchain. So what we looked at is a solution that really integrates the distribution of wealth services through what we call a self-service wealth management capability. And we also saw that there's a lot of other technologies. You all saw one discussed earlier today, VAAST, where you're seeing on the asset management side platforms that are being developed to help digitize the connectivity to asset managers. So you're making it easier for distributors, wealth service providers, to be able to integrate using their platforms into the issuers. And ultimately, we saw this as an opportunity to build a platform that really was going to streamline the entire distribution of investment products. We've gone live with this platform today. Effectively, what it delivers is for wealth service providers to be able to white label and deploy a full self-service wealth management capability that integrates in to the digital asset management platforms that are now coming to market, and ultimately help those wealth service providers be able to onboard the products that they need to their digital product shelves that they wish to distribute to their investors. Now, we also thought about, it's not just about technology. When you start thinking about the adoption of blockchain, it also creates the opportunity to change the commercial model. And we sat down and we thought, well, how do we help the wealth service providers be able to get a different approach to how they look at their business? And what we came up with is a commercial model that effectively allows for the wealth service providers to get a piece of the ecosystem through which they're sourcing their digital securities. And so we developed an ability, we issued our own token, our own security. And that security is actually backed by the transaction flow that goes through our platform, and we use it as a reward to then effectively provide the wealth service providers with a stake in the ecosystem. Effectively, what we're doing is we're turning wealth service providers into miners, and they mine by basically doing more transaction flow through the network. What this effectively gives them is the ability to no longer have to get their technology by entering into a normal software as a service agreement with a typical wealth tech provider. Here, they actually become part of the business. And so their investment in their technology actually becomes an investment in the growth of the ecosystem. And the ecosystem grows with more transaction flow through it. So to get traction in the market, we've already gone out there. We've rolled out our first platform for a wealth service provider in the Australian market. They're already onboarding accredited investors. They're putting deal flow through the platform, and they're seeing amazing results, amazing growth. To further expand this, we're focusing across the region. We're working with a technology service provider that has quite a lot of banks already as part of their client network. And we're also doing some negotiations right now with established wealth network platforms already supporting conventional product distribution, now looking to tap into digital product distribution. In terms of the market size, if you want to look at just in Asia Pacific, the capital inflows into private market investment products is about to reach 2 trillion by 2025 in 1 year. By 2028, it will hit somewhere in the level of about $3 trillion just in Asia Pacific. And if you look at private market investment capital inflows globally, that will then look closer to $6 trillion. So when you compare this even to the size of the whole digital asset economy at its peak, that pales into insignificance when you see the opportunity that's available actually in mainstream finance. So we've developed the models with regards to what sort of ROI that digital security that we'll issue will be able to receive. And it's going to be quite significant based on each percentage of those total market share in capital inflows that we ultimately route through the platform. We think this is going to change the nature of the wealth management industry and move the supply chain from private banks through to effectively the mass affluent sector. Thank you very much. I'll be around all day if you want to discuss more with me. Cheers.
I'll introduce you again. CK, right? Thank you for your time, Lawrence. The mic's not working. So this is CK, founder and CEO of Smart Tradz.
Thank you. Good morning, everyone. My name is CK. Today, I'm going to present our next generation end-to-end digital trade platform and our agriculture marketplace platform. Sorry. Smart Tradz provides two solution tracks. Firstly, we provide enterprise B2B solution that enables frictionless B2B e-commerce transaction, optimizes transaction economics, smoothens cross-border trade, and reduces supply chain costs and impact of supply chain disruption to enable enterprise profit optimization. Our second solution is agriculture marketplace that enables disruption of the middleman channel, transportation, economies of scale, and market price optimization. So those are our two solution tracks. Our platform is a level 4 maturity platform, which somehow this is not working. Which enables end-to-end digitized and transformational processes by providing higher depth of capabilities and hence providing higher value creation impact. Our solution is enabled by disruptive technologies such as AI, blockchain, and also IoT. Our enterprise B2B solution consists of multiple components as shown on the slide, of which our pricing and supply chain solutions are award-winning. We have gained traction in the market. Some of our clients include Petronas, Indian Oil, Cargill, and FGV, which is a conglomerate in the plantation and agriculture industry. The integrated end-to-end platform provides the foundation for us to launch our agriculture marketplace. So I'm going to elaborate a little bit more about the agriculture marketplace. In terms of the pain points that the agriculture marketplace is having for e-commerce adoption, firstly, there is very heavy reliance on middlemen to reach the market, and there is lack of economies of scale, resulting in unattractive pricing. For e-commerce, the challenges include low digital literacy for farmers and fishermen, as well as the need to support varied pricing mechanisms practiced in the agriculture industry, including e-bidding, negotiated pricing, etc. From supply chain perspective, due to the short shelf life of agriculture products, supply chain management is highly complex and costly. Typically, transportation cost is not optimized, especially for low quantity orders, and furthermore, product traceability is not widely adopted. Other challenges include the complex cross-border trade when involving export and import of agriculture products. This would require requirements for customs and also food safety, which adds a lot of complexity to the process. Our agriculture marketplace addresses the pain points highlighted earlier by providing a platform to enable direct sourcing from farmers and fishermen, easy-to-use mobile app to ease adoption, comprehensive pricing mechanism to satisfy the needs for the different practices in the industry, advanced supply chain capability, for example, to enable transportation economies of scale for low quantity orders, blockchain traceability, and lastly, cross-border trade facilitation. Our platform is supported by Malaysia's Ministry of Agriculture and Food Industry. We have made traction in the market and generating sales year to date of US 5.2 million. We expect exponential growth due to the combined offerings of our enterprise B2B as well as the marketplaces that we have launched. In terms of the benefits of our platform, it covers different stakeholders such as the government, the farmers and fishermen, as well as the small quantity buyers and the consumers. Our competitive differentiation against other agriculture marketplace covers comprehensive pricing mechanism, advanced supply chain capability, like mentioned earlier, blockchain traceability, as well as cross-border trade facilitation. So there are a lot of advantages of our platform compared to others which are existing in the market. So in terms of market size, agriculture e-commerce constitute an immense market. So for a total addressable market valued at 804 billion by 2026, we estimate the sum at 22 billion. So now is the opportune time to capture these market opportunities. And there are recent development which is accelerating the adoption of agriculture e-commerce, including high food and energy prices, geopolitical situation in Ukraine, and global government focus on food security. Looking at the statistics, there is ample room for growth in terms of the agriculture e-commerce. So our team is well qualified and well positioned to capture these opportunities. The founders has more than a decade of experience in consulting, working with companies such as Accenture and Deloitte, specializing in pricing, supply chain, B2B, e-commerce, commercial excellence, winning multiple awards throughout the career. Our our core team has the technical competence, industry experience, and also connections to deliver success. For example, our advisor is a former director of Shell, and our BD team consists of industry veterans in the agriculture plantation space as well as commodity trading. So building on our existing credentials, we have generated significant pipeline. For example, opportunities for a global project with a major multinational energy and chemicals company. Opportunity to deliver an end-to-end platform for Ministry of Commerce for one of the Southeast Asia companies, and also oil distributor throughout Southeast Asia. We are also actively participating in market expansion programs involving accelerator program to enter South Korea and China market, and also collaborative R&D effort with companies in the UK and Europe. For industry focused marketplaces, we have launched the agriculture marketplace as mentioned earlier. Towards the end of the year, we will launch the halal marketplace and extend the platform to cover agriculture commodities such as palm oil, and subsequently extend that to other commodity industries such as fuel and chemicals, as well as the mining industry. We are seeking investment to fuel our growth and market expansion. With that, I thank you for your kind attention. If there is any interest to discuss further, my contact details are shown above. Thank you very much for your time.
Thank you, CK. We'd like to welcome Ming Wang of Opal to the stage for the next presentation.
Morning, everyone. Oh, is it working? You guys hear me loud and clear? How's everyone today? Good? My name is Ming Wang, and I'm the CEO of Opal. So Opal is one of the first licensed neobanks in Asia that is focused on international commerce for small and medium enterprises. So by way of introduction, I've been an operator and investor in the fintech space for the last decade. My CTO is also in the financial services space. He was tech lead at Goldman Sachs and the CTO of multiple hedge funds. And my chief legal officer, who's also in the audience, is a specialist in FS regulations for MENA and APAC. Now, over the years in financial services, what we have seen as the greatest opportunity and the most underserved is when it comes towards international commerce, anything that is cross-border for businesses. So I'm sure most of you guys have tried to make a transaction on any payment platform, any remittance platform, right? If you're trying to send $5,000 back to mom in Malaysia or the US, it's really simple. If you're trying to move $50,000, $100,000, $1 million, you're faced with a barrage of questions, and typically your payment ends up a week late. Or you're trying to get financing, right? If you're trying to get money to pay a local vendor or supplier, you've got a bunch of solution providers. The moment you're trying to make a payment to an overseas vendor or supplier, again, a bunch of questions, and quite typically you do not get access to the solution that you need. And the worst of it all is that all of these different solution providers are on different platforms, meaning you're going to have two bank accounts, you're going to have a Wise account, you're going to have an account with funding societies, you're going to have an account with an Insurtech platform, trying to manage your business on multiple platforms. What we have done at Opal is, sorry, let me rewind that. Let me give an illustration on that same problem. So on the left-hand side is you have an SME. This SME is trying to buy $100,000 worth of inventory from an overseas supplier, let's say from Thailand, right? This SME goes to his bank and says, okay, I want to have working capital to finance that purchase. The bank looks at him and says, your business is great, but you don't have more than 2 years of track record with this specific bank. Tough. Our SME goes to an alternative lending platform, another lender. The lender typically is using the same data points that the bank is using to underwrite that credit. So if he's lucky, he gets the financing at a very expensive cost of financing, high interest rates. He gets it, story isn't done there. He has to get his lending platform to then send the money to his bank account. Why? Because the lending platform is not able to hold and store funds. Now at the bank, he says, okay, I've got 100,000 Singapore dollars, I need to make the payment in Thai baht, right? The bank says, you're an SME, do a couple million a year, but you're not a favorite client. You're not going to get good rates. So you get the bored FX rates, the poor rates. So what happens is our dear SME then has to use yet another third-party platform, typically a remittance provider, to try and get that solution done, right? On this third-party remittance player, they'll say, okay, so you're trying to move $100,000, it's considered high risk. I'm going to ask you a bunch of questions. If you're lucky, it's between 3 days to 2 weeks before your transaction lands to your beneficiary, your supplier in Thailand. As you can see, just this simple transaction that he's going to do week in, week out, month in, month out, he's relying on multiple platforms, which means that he would have had to KYC and onboard on each and every single platform because they're all regulated, right? 2 weeks each to open a silly account. There's going to be frictional costs as he's moving the money from one platform to the other. He's going to try and manage his business across multiple platforms, which is absolutely impossible if you're a small, medium enterprise. And even worse, next month, the same thing is going to happen again. Why? Because each of these platforms do not talk to each other. We don't have what you call open banking in our part of the world, right? So all the fintechs, all the banks are not talking to each other. No one has a complete picture of your business. So next month, you need financing again. I'm going to ask you the same questions again. You're going to do payments again. Oh, it's 100,000. You get delayed again. What we've done at Opal is we've created a unified account where you can hold 34 different currencies. You're able to pay out to 180 countries across the globe. You're able to get paid by your customers all around the world in multiple settlement methods. You get financing on the same platform. So that's different. We're not a pure payments player. You get financing on the same platform. And of course, we've thrown in escrow because anything to do with international trade, escrow is extremely important to build trust. Now, something unique about Opal is we don't just provide these solutions natively on Opal. We actually provide you access to other financial solution providers. As you can see, it's an illustration on the left-hand side, whether it's insurance, whether it's different lenders, whether it's different payment platforms. You do it all from the single dashboard that is Opal. To date, we've got 3 bank partners, 4 international payments firms, a Sequoia-backed lending platform that's very well known, I should not mention right now, and by the end of the year, another revenue-based financier. So this is interesting because that means scalability of our product and offering is pretty much endless. So what that means is now in that same transaction, SME on the left trying to buy stuff from an overseas supplier on the right in Thailand, right? SME gets financing on Opal through one of our product partners. He gets competitive terms because he has access to multiple lenders. The best terms goes through all on Opal. That SGD loan facility gets converted into Thai baht, gets paid out to the overseas supplier, also on Opal. Now, this is interesting to the business and to investors. Why? It's the revenue model, right? Because we take a clip when the loan facility is approved. We take a clip when the money is converted from SGD to Thai baht. We take a clip when it's processed to be paid out. We take a clip if there's escrow involved. And this is only one single workflow that we're illustrating. And the entire thing, the entire work stream, is happening on Opal. So I'm saying I want to pay somebody there, I'm getting financing, I want escrow on that entire user journey. So quick bit on the sizing over there. Globally, yes, it's $56 trillion, right? International trade. But keeping our feet on the ground, the serviceable obtainable market in just these handful of countries in Southeast Asia is $1.3 trillion just for SMEs, international trade. We are looking at processing close to $20 billion of volume annually by the end of 2026. How did we get that number? Based on some early traction. So let me just explain this graph really quickly. On the left-hand side, we went to market last year in June, and the first month we processed about $300,000 in volume. 8 months later, in January 22, we crossed the $16 million mark in terms of volume that transacts through our system in a month. For context, this was done with 1 salesperson and 1 onboarding individual. We are able to onboard, I dare say, 3 times more efficiently than the closest unicorn today. Some projections. Mindful of the time, so 3 main things that gives Opal the advantage. 1 is we're fully licensed. So I think you hear a lot of people being regulated. They've raised hundreds of millions of dollars last year. They're regulated by the Monetary Authority of Singapore. They're not licensed. They're hoping they get licensed. We are fully licensed. So that means credibility with clients, fintech partners, banks, investors. And the economics is superior for us because when we connect with a fintech partner or any payment network today, they can trust our license and they can leave the compliance operations with us. It's not outsourced to them because we are licensed. So they give us better economic terms. The second thing is that unified account. Remember I said one account will give you access to all these solution providers and different solutions. Scalability. And the third thing is because all of that data, every single touch point that's happening through Opal as an aggregator sits with Opal, we have that information to build a superior risk engine because we have that complete picture of your business that no one else has in our region today. So these are just some highlights of what we've been able to achieve. So in a nutshell, our team comes from some of the tech havens of the world, Singapore, Tel Aviv, and the United States. Some of the companies where we've helmed from. We're raising $6 million today. We've got $2 million in commitment, primarily for customer acquisition retention because we've got that good early product market fit. And very importantly is the R&D. We want to build out our product, integrate with more fintech players, and very importantly, build out that superior risk engine so that users are able to get better access to financing, better access to payment terms, better user experience, better rates. Okay, I'm mindful time is up. I'm just going to skip right through over here. This is actually a second phase. So right now, we've been able to acquire a number of SMEs on our platform. For the last year, they're already using us. What we want to do next is be able to embed all that we have built, our infrastructure, all of the entire ecosystem into other platforms. So we can go to a lending partner and say, hey, how would you like to have wallets where everyone is settling and transacting and applying for loans on your own wallets, as an example, right? We can do it for SaaS companies, lending platforms. We're doing a POC with an agri-food company, a blockchain agri-food company, where they say, hey, we've got something, we manage all the goods, you manage all the financing, I want an entire bank plugged into my platform, and that's what we can do. All right, guys, so it's been fantastic presenting to you guys. If you have any questions, we're at booth number 9 in the corner, and it'll be lovely to take this conversation further. Thanks.
Thank you very much, Ming Wang. We'd like to welcome to the stage next Stephen Moss, founder and CEO of Boolean FX.
Testing. Hey guys, how are you? It's good to be in Singapore and talk to you all. I'm going to talk a bit about Boolean FX today. So let me just start. Does anyone love their bank? No, I don't think so. No one ever says yes to that. But we're living in a very important time in history. The banks today are reliant on an inherent trust, which is diminishing. Digital banks have not really changed the system. They've changed the user experience of the system. And blockchain has given us the technology and ability to change the system, but it's really failed to bring stability into the market and reliability as well. Boolean FX is basically a financial ecosystem built on a gold backbone. So the crazy thing in blockchain is developing out on a USD backbone. So everyone in blockchain is saying this is the next evolution of currency, but yields, DeFi, decentralized assets, NFTs are all being developed on US dollars. So in developing a financial ecosystem, Boolean FX have developed a gold backbone through the base of it. Liquid, which is our gold backbone, is basically comprised of Bitcoin over gold, ETH over gold, yields over gold, DeFi over gold. So a complete system that allows the user to bring their wealth back to gold. Liquid is more than just a gold token. Our gold liquidity, we've solved some of the 2 major issues in the industry. One of them being audit. Audit's major. There has never been a crypto product with an institutional grade audit, which is absolutely insane. If you want the big banks to trade crypto, you're going to need institutional grade audits. We worked with BDO for 3 years to build the world's first institutional grade audit in this space. So we've solved the problem of audit. We've also solved the problem of liquidity. We work with StoneX to provide absolute spot price on gold. So users can use the system to yield, access DeFi, access the future of assets, build decentralized products over gold, as opposed to USDT or Bitcoin or Ethereum as well. So a quick map of our system, you've got swaps, yield, DeFi, and Vault, which encompasses decentralized assets. So essentially a financial ecosystem built on a gold backbone as well. Just a quick look at our system. Simple exchange functionality, centralized and decentralized. We apply investment banking principles to yields, which is another first. We apply portfolio theory, scatter yields, and greatly reduce risk while maintaining return. Again, in an industry like this, which is largely unaudited, this is a pretty powerful product. There's some of our first yield pools which we've launched. We also have a DeFi component on the system, which is pretty important. Again, we see the future of DeFi being traded against a gold backing as opposed to an algorithmic stable coin or an unaudited stable coin, or Tether, which could collapse tomorrow, which is also unaudited, etc. The third component of our business, so we've got yields or savings, DeFi, debt, is Vault. Vault encompasses the future of assets. So one of the first products we're building on Vault is NASDAQ G. We're trying to build a NASDAQ over gold, essentially in stock markets over gold. We've got a pretty simple staking mechanism to achieve that as well. But look, we can't predict where this industry is going, but we can build a model to encompass future products within this industry. NFTs, property, shares, commodities would be housed here. Just quickly on NFTs, I see them more applicable to future mortgages or car loans, where the lender might actually want some non-fungibility on the token as opposed to a picture of a sparkling unicorn or something like that. So that's quickly on Vault. We have quite an aggressive distribution strategy through ambassadors, a lot of very well-known sports personalities, etc., financial influencers. We have a drive globally to bank 1 million people. Because we're decentralized, it's very easy for someone in India to just create a wallet, keep their wealth in gold, because a lot of those countries don't like keeping their wealth out of gold, spend it through debit cards, yield it, save it, DeFi it, trade stock markets, all the above. So we have quite an aggressive strategy there, which doesn't unfortunately have enough time for this session. We also have a strategy with brokers. So one thing that is happening globally, and one thing we can solve as a decentralized ecosystem, is the biggest arbitrage in the room. We've got record low interest rates globally, but in the blockchain world, we've got record high interest rates. So imagine giving mortgage brokers the ability to parcel a low interest rate mortgage with a high interest rate offset from the blockchain world, which might be a yield pool that's diversified and audited, and actually a product that can sit in a broker's hands. So we completely have the ability to revolutionise the broker industry from commissions down and engage them as well. Just quickly, because I've got 2 minutes left, our system has an ecosystem token called Bull. Bull can be used to basically increase your returns in yields, get you a better rate in DeFi. You have to buy Bull when you create assets in Vault. So it is an ecosystem token. And just quickly, we listed Bull about 9 months ago. Bull is traded on a couple exchanges. We're just moving to establishment phase now. Bull currently has a market cap of about 100 million or so. Just quickly, the business, the team, we've raised about $4 million over the last 12 months. We're now raising another $10 million to provide liquidity to our system for a launch. The team, very quickly, is myself. My name's Stephen Moss. I was a co-founder of Australia's largest carbon trading platform back when carbon was the largest unregulated financial market. So I got into blockchain in 2016. I built Australia's first cryptocurrency vault. I co-founded BDO Blockchain, which is the world's first institutional-grade audit.
CEO of Collective Shift.
Awesome. G'day everyone. I'm back with my Web3 crypto t-shirt. I'm a little bit underdressed. I think this is the crypto uniform, so glad to be representing that. I'd just like to share with you quickly, I got in late last night. I had a flight on Sunday and we were two hours into the flight, and we actually had an emergency landing. So I was asleep at the time, and the captain came over, and we had an emergency landing. Someone actually had a heart attack on the plane, so we had to go back to Sydney, and there was ambulances on board, and it was one of probably the scariest feelings of my life. I didn't know what was going on, I didn't know if it was going to be okay. And it actually reminded me about the first time I got into crypto 6 years ago. Not the fact that I was having a heart attack, but there was just chaos, unknown. I didn't know what was going on, and it was really, really scary. And I guess 6 years on now, with Collective Shift and the company that we're building, is really to help people get into crypto safely. So one of the biggest problems I see in crypto right now is there's a lot of investors investing into the industry without any really idea about what they're doing. In fact, 1 in 3 investors that do invest actually admit they have zero idea what they're doing. Plus, the scams in the space. Some of the smartest people in the crypto industry, unfortunately, are the ones that are scamming people's money. And these are usually mum and dad investors. So $14 billion worth of money was lost in scams alone in 2021. I too, when I first got in the space, got scammed like most people do. We call it the tuition fee to get into crypto. Hopefully you don't lose too much money. So what I've put together is a platform where we're trying to make digital asset investing really simple. So we're building a personalized experience where you can look at any asset across NFTs and crypto and have a really easy understanding of whether or not that investment is something you should buy. Along with that, what we're building is your ability to plug in your wallets, be your Coinbase or your whatever wallets it might be, Binance, Kraken. You can plug in your wallets and you can get an overview of everything you own, and we can give you a step-by-step checklist on how to improve those assets. So one of the most common things, people come to me and said, hey Ben, I listened to Elon Musk on Twitter and I bought all this Shiba or this Dogecoin. Why aren't I making money? Well, those users will be able to use our platform to get a score rating, like an A to F, with like a fuel indicator of how to improve your portfolio. Along with this, we have copy portfolios, we do on-chain analysis, really simple content to help people get into the space. Right now, we launched 18 months ago, and we have 1,500 active members from across the world. We're doing $115,000 a month in revenue through our subscription model. And we've really only been based out of Australia for the first 18 months. So recently, we've hired 4 people from the US and starting to invest into America. As we see, it's a much bigger market. Really, our focus over the last 18 months has been building out our product. So we've reduced our subscription churn from 30% to 7% a month. And our emerging growth channels are converting and ready to scale without spending any money on marketing right now. Really, where we are different from the other competitors is the fact that we're simple. We speak English. We wear T-shirts. We don't wear suit and ties. We can speak to the everyday mum and dad investor. A lot of the other people in the space right now, whether it be TikTokers, YouTube influencers, are pushing out a lot of, to be honest, crappy content, and there's a lot of backdoor deals where people are getting paid to promote tokens, paid to promote NFTs, and there's a lot of bad investment going on. So all of our content is research-backed, transparent, and on-chain, and simple. Crypto and Web3 is growing really, really rapidly. So in Australia, there's 2 million users that own crypto. In the US, there's 60 million, and it's growing at 59% year over year. The Web3 space is growing rapidly fast, but yet there's no one really competing in this space of helping people invest properly. So I've actually built a crypto subscription business before. I've been in the education space in crypto since 2017. We grew the last business to $450,000 a month in recurring revenue, and then I wanted to start my own thing. We hired Aman Asadi, who's ex-Google employee, to build out our growth team in the US, and also Aaron, a good mate of mine, who is the head of digital at the hospital in Perth in Western Australia. We have 12 full-time team members, 16 in total across Australia and the US, and we've got a really awesome team of advisors. So right now, we've just opened out our seed round. We've already closed out $750,000 in our raise. We're looking to aim to raise $1 million. We've got one of our largest investors here in Singapore, which I'm catching up to tomorrow, and we just have one of the largest family offices in Australia invest, the Smorgan family. They've just put in $250,000 as well. So we've got some really good backing, and yeah, we're basically putting all that money towards building out a better user experience, as I was talking about this morning, because crypto's missing that. To onboard this next billion people into crypto, we need easy user interfaces, easy platforms where people can invest and do it safely. My name's Ben Simpson. Thank you very much for having me. I've zipped through. I like to be short and sharp. I've got a booth outside, so if you'd like to come and chat throughout the day, I'd love to chat. Thanks for your time. Cheers.
Thank you, Ben. Next up, we'd like to welcome to the stage Marshall Lees and Jamie Penrose, founder and CEO of Myth Central.
Good morning, everyone. Hello, everyone. Thanks for giving us the opportunity to present Myth to you. We're an Australian startup that's focused on reinventing modern fandom for the millions and millions of fantasy fans around the world. Marshall and I, like many of you, grew up surrounded by iconic images in the fantasy space. For me, it was Star Wars. For Marshall, it was Dungeons and Dragons. And for each of you, I'm sure there's memories that around film, movie, gaming, that trigger emotional responses for you all throughout your life and continue to do so. It's for many, being a fan has carried through to adult life. We've seen an explosion in the number of collectors, fans, gamers, and really the exciting thing that the innovations Web3 affords us are now becoming a reality and change not only entertain but virtually every aspect of our life. So we've brought together an incredible team. We spent the last 12 months doing a lot of work behind the scenes. We've got a fantastic set of partners and hundreds and thousands of fans that they bring, and a novel approach to commercialisation and community management, and to realise what we know will be the benchmark for modern fandom in the Web3 space. So I think perhaps the best way to give you a sense of what we're doing is to show you a short video that we put together. Oops. I'm hoping we will. Oh, sorry, guys. So that was a little sting we put together for some of our partners, but we believe there's a very real market opportunity to realise truly immersive fan-based experiences by harnessing Web3. So for all the reasons the panel spoke of this morning, and you've heard a lot around crypto and the utility of NFTs, we think there's a really amazing opportunity, and certainly the experiences we've got to date from our partners and our community has been really significant. We believe it because the sheer size of the market is so huge. There are millions and millions of people online who feel incredibly passionate around fantasy as a genre. There's a massive opportunity to leverage incredible IP and to create stories and build additional IP off of those collections. And because Web3 has evolved so quickly, and we heard a lot about it this morning, blockchain, decentralized solutions, the NFT utility itself, they're all factors that have really led us to be able to leverage where we are at this point in time to build something pretty special. And finally, for me, I think the most important thing is that we know the fans who are incredibly passionate about fantasy want to be challenged and want to delve deeply into their passion. And there's been a lot of promises over the last couple of years by a lot of players about the future of virtual lives, about metaverse plays, avatars and the like. And we believe we're now at a point where the technology is catching up with the ambition and we'll be able to create something really special. So I'll pass on to Marshall to go through some of the key things that we've developed.
Sure. Hello, everybody. Yeah, I've been in this space for going on 5 or 6 years now, and I own some other businesses in the entertainment space, and I've had dozens and dozens of conversations with brand and IP owners who are looking to do something in this space, but there is a real lack of talent and a lack of knowledge about how to transition from Web 2 to Web 3 and to really build advocacy around those fan bases that they have. And those conversations, on top of some of the other things we were doing in this space, really led to Myth. And so we've been really focused on building a team of really incredible people that can help us deliver this. And on top of that team, a partner network and best-in-class technical support partners to really deliver on something special and to enable us to take to market fan experiences that we think are next level. So I'll take you through some of the team. Get the next one up. Not the best-looking bunch of people, but what we've really done is try to assemble a group of talented people that not only know the technical side of things, but also understand the importance of bringing IP to the platform, understanding how important creativity is to a business like this, because we are a creative enterprise. So if I just pick out a couple of these people, we've got Matt Medney, who is the CEO of Heavy Metal. I don't know if you know Heavy Metal, but it's been established for close to 50 years as a leader in the science fiction publishing industry, now moving into TV and film. Matt is also a best-selling science fiction author. We have people like David, who manages over 4,000 pieces of the most valuable IP globally in TV, film and publishing. Then we have my good friend Michael Cooper, who is considered one of Hollywood's top deal makers and one of the founding partners of Range Media Productions, who are a major player in Hollywood. So we've basically assembled these people and partners around it. We now have a community base of over 700,000 people from our partner projects. We're looking to launch around October this year, and we're going to leverage those community partners to do that. We've also managed to bring on board some of the biggest players in the Web3 space, so the likes of Crypto.com, who we're a premium partner with, The Sandbox, Vulcan Forge, which is a gaming ecosystem that you may not be familiar with, but I was actually the angel investor in, and we took that from 0 to a $1 billion market cap in about 18 months. Obviously, with everything in the crypto space at the moment, that has cooled off slightly, but there's a lot of learnings from that experience, and Vulcan Forge are a big supporter of what we're doing now. And we also have TDeFi, which is part of the Trade Dog Network, as our accelerator program. So we're focused on delivering really fantastic experiences for fans. We've divided those experiences up into 5 sort of content pillars. We already have partners who are delivering on all of these, or will be delivering on all of these within Myth. And those partners are doing really exciting things that are all leading towards sort of metaverse plays. We're actually excited to announce, we can mention it now, but we'll be announcing soon that we've just picked up the global rights to Survivor and Black Mirror, which has been one of the most successful science fiction TV shows of the past decade. So our team's creating incredible experiences around this sort of IP. So I think yep. Okay, so we're looking for equity investors in the actual Myth Central platform. We also have a secondary offer in the token, MythX, and that's something we can detail outside for anyone who's interested. But we're really excited about where we are right now, considering we haven't yet publicly launched. We're getting incredible feedback from the market, and we would love to have a couple of you on board, if possible. Thank you very much. Thank you.
All right, thank you very much, Marshall and Jamie. We're running a bit behind time, so morning tea's actually already been served, so I'd encourage everyone to run down and grab something to eat before it all goes. Probably about 20 minutes, we'll ring the bell and let you know when the presentations are resuming. Thank you. Thanks, everyone. Hope you enjoyed the break. Cheers for coming back into the presentation room. We'll kick off the second round of presentations with Michael Baker, CEO and Managing Director of Aravela Therapeutics. Please welcome Michael to the stage. Thank you.
Thanks very much for the introduction, and thanks very much to Wholesale Investor for putting the event on. And of course, thanks everybody for participating today, and of course those that are joining us online. Great to have you on the digital platform. And so I'm the CEO and Managing Director of Aravela Therapeutics. We are a biotechnology company. We're currently listed on the Australian Stock Exchange under the ticker ALA, and I'm looking forward to taking you through our story. And there's our forward-looking disclaimer. And I just wanted to start with a few details about the company in terms of the financial metrics. So as I said, we're listed. Our valuation sits around 15 to 18 million, which we don't think adequately reflects the value of the technologies that we've got for cancer treatment that we've licensed from Imperial College London and also at the MD Anderson Cancer Centre. As of March, we had $8.1 million cash in the bank. And like everybody else in the small cap and biotech sector, we've been caught up in a sell-off, but it does look like things are stabilising at the moment. In terms of our investor base, we're delighted to have Merchant Group join our register. They were the cornerstone investor of a placement in January. And we've got a number of supportive small institutional investors and high net worths on the register as well. But of course, always looking to welcome new people to the register that understand the risks, but the potential rewards that come with an investment into a biotechnology company. And so I'd like to just give you in a word what it is that we're focusing on, and it's cancer. And I think you look around the room, it'd be hard pressed to find anybody that's not affected by this disease in some way or another. And the reason being is it is such a prevalent condition. In 2020, there was approximately more than 19 million cases diagnosed, and in the same year, more than 10 million or around 10 million deaths. In addition to that, we know that by 2030, we're expecting the cancer therapeutic space to reach about over $360 billion, which is an enormously large figure. So we see that there's a huge impact from a societal level, but also a commercial opportunity to be involved in. And more specifically, what it is that we actually focus on, it's what we call immunotherapy. So it's using our immune systems to tackle the disease. And more specifically, we're looking at something called cell therapy, which some of you may have already heard of, more affectionately known as CAR T therapy. And essentially, it's ushered in a new way of thinking about cancer treatment. And why is it so exciting? It's because it's now at the point where we're starting to use the word cure in the same sentence that we're talking about cancer, which is a lovely place to be. And this is just a snapshot of some reports that were released in February this year, where some of the patients that were taking these types of therapies more than 10 years ago are still cancer-free. And that's also been the case for the first paediatric cancer patient, so the first child cancer patient that's also 10 years cancer-free, which is why we are using the word cure. And so, as I said, it's typically known as CAR T, and that's where really the difference comes into it for us. We work on not CAR T cells, and T cells are the immune cell. We work on iNKT cells. They're a naturally occurring immune cell in our body. And before I go into the advantages of the iNKT cells over the T cells, I'd like to take you through how this therapy actually works. So we start off with a healthy donor, someone young and fit with a high-functioning immune system. We take their immune cells or their blood, and then we harvest the immune cells, the iNKT cells. We genetically reprogram them in a lab to produce what is called a chimeric antigen receptor, or CAR. So you can see that sticking up. And that actually becomes like a guided missile to drag the cells towards the cancer cell to trigger its destruction. We grow them up, so there's billions of them. We freeze them, and then we give them to a cancer patient when they're eligible to take the therapy. So the biggest benefit for the iNKT cells, is that you can't do this with the conventional T-cell therapies. So the ones that are approved, you can't give them from a healthy donor to a patient. You need to take them from the patient and give them back. And that renders the therapy being created bespoke for every single person. So it's not cost effective, and logistically it's very challenging. So we know that for our therapy, we can give them from a healthy donor to a patient, so we alleviate a lot of those bottlenecks. And we also know that they are one of the most potent immune cells, so they rapidly kill the cancer cells. They also recruit other components of the immune system, And for tumours that produce something that's called CD1D on their outside, we also know that our technology performs better than the conventional T-cell therapies. Now, in terms of the commercial activity in the space, so when we look at T-cell therapy, so there are 6 approved products now on market. There are hundreds of companies and hundreds of clinical trials ongoing. For iNKT cells, there are literally a handful of companies working in this space, and we're one of them. And in the last, say, 14 months or so, all have experienced some pretty significant commercial activity. So Appia Bio, they're preclinical. They won't put their therapy into humans until the end of calendar year 2023. They raised $52 million in May last year and entered into an $875 million partnership with Kite Pharma. Cure were acquired by Athenex for $185 million total deal value. Athenex are now, there's some news articles floating around that they're in the process of being acquired for potentially up to $200 to $250 million. And Mink Therapeutics, I've listed here, is valued at $43 million, and overnight they went up 100 and something percent to about $120 million US. So Aravela, we sit at around a market cap of somewhere between 15 and 18 million, so we see that we're very undervalued relative to our peers, and especially because our lead technologies come from 2 of the best centres in the world, Imperial College London, a top 10 university worldwide, and the MD Anderson Cancer Centre, which is often regarded as one of the best, if not the best, cancer centre globally. So in terms of our pipeline of products that we're developing, so as I said, we've got ALA-101, which we're using to develop to treat CD19 producing blood cancers, that's leukemias and lymphomas, and that's the technology we licensed from Imperial College. And for ALA-104, that's to treat multiple myeloma initially and potentially for solid tumours, which opens up a very large market, and that, as I said, we licensed from the MD Anderson Cancer Centre. So we also have a platform where we take drugs and convert them from solid dose form to sprays, and we commercialised our lead product, Zolpimist, through our partner Starter Australia in June this year. So that's a product that's out on market for treatment of short-term insomnia in adults. Now, behind a really successful biotechnology company, technology is critical, but the team is equally as important. And so over the last 12 months, we've worked very hard to bring in heavy hitters and very, very experienced people in drug development, but also specifically in the cell therapy arena. So our interim chair, Dr. Liz Stoner, is formerly an assistant professor at Cornell University before becoming a senior leader in large pharmaceutical companies like Merck, and now she's the executive partner at MPM Capital, a well-known life science-focused VC fund in the US. Dr. Deborah Barton, also very high profile and high C-suite roles in a range of cell therapy companies. She's currently the Chief Medical Officer at T-Scan Therapeutics, so both joined as directors late last year. And we've just appointed another Australian-based director, Dr. Gary Phillips, who's a 10-year veteran for Australian biotech companies. And 2 VPs we recruited out of North America, Dr. Sandy Buchanan, who's leading the manufacturing of our cell therapy product, and Dr. Minnie Barathan, who's leading the translation of these types of therapies from the preclinical stages so that we can advance them as rapidly as possible into clinical trials. So with that, I'd just like to say thank you very much. It's great to see you all here out and about. Thank you for listening, and I'd be delighted to take you through the therapy further if you come over to booth number 2. Thank you.
Thank you very much, Michael. Next up to the stage, we'll welcome Richard Rendell, Managing Director and CEO of Biosignals Diagnostics.
Okay, thanks, Jonathan. So yes, I'm the CEO of Biosignals Diagnostics. Let's jump forward. And we are on a mission to save lives using precision healthcare to predict, diagnose and treat cardiac disease. It's a complex space, and for example, every 3 hours, at least in Australia, a woman dies of heart attack. It's complex because the symptoms aren't always the same as the usual pains in the arms, and quite often it's difficult to diagnose. In some populations, around 60% of those populations don't respond to the usual cardiac arrhythmia medications. 2/3 of adults who are unfortunately diabetics die from cardiovascular event, and they monitor glucose constantly, but not ECG. 30% of strokes are caused by atrial fibrillation. This is reasonably well known, and strokes are a very bad outcome. Chronic stress is a strong relationship in through to cardiovascular disease is becoming much more well researched and evidence supporting it. And of course, COVID-19, as we know, has a very strong relationship in inducing arrhythmias. Overall, what you can see as a common theme is that enhanced accessibility and accuracy of remote ECG monitoring will improve these outcomes, and that's what we're here to do. So to start off, there's 3 horizons here, and the first one actually is with a small handheld device, which we call ECG-Me, and that one is just the size of a credit card, pretty small, and it converts to an on-body device as well, so we can actually do that. It is TGA approved in Australia, CE mark, so we're ready to go. We have about 6 weeks of final work before manufacturing and final implementation in the cloud. The ECG-3Me device is a clinician-based device. It is for those harder to detect arrhythmias, and it is something which would be prescribed in its use for patients by a cardiologist. And then the showcase of where we're going is OmniMe, this platform which allows us to use graphene-based sensors, which are really thin. They roll on like a tattoo. There's the size of a postage stamp. And we can put those in all of the 12 lead positions and not only measure ECG, but also blood pressure, glucose, and various other analytics with sweat, for example. And all of that basically supported by a number of patents that we are working on with the platform below. There's about a $130 billion market that we have assessed, and this is actually a kind of conjunction between some of the digital health, the cardiac monitoring, mobile cardiac monitoring markets. We've drawn that down to around a conservative $2 billion service obtainable market. In terms of people, I was at Oracle for 18 years and had responsibility for some significant products there. We were involved in the original human genome mapping, and when I left Oracle, I embarked on a journey of creating a precision medicine company based upon DNA and working a lot in oncology. My co-director, Stephen Foy, is actually a very well-experienced cardiologist who has actually built and led cardiology centres within hospitals. Chris and Lexi head up our scientific team and engineering team. Lots of experience within precision health and cardiology and medical devices. And Kevin Hollingsworth, who has been very instrumental in listing some of Australia's larger biotech companies. So the go-to-market is reasonably straightforward. Firstly, GP clinics. We, at this stage, will work through this messaging of easy ECG assessment. Just simple device to put in your hand for 2 minutes while you're having your 12-monthly checkup, or if you're having symptoms, trying to explain what they are. Pharmacies are the next stream, and pharmacies do medicines reviews. So with older people, for example, medicines reviews are where lots of different drugs are being taken, and they can have effects on each other and can be measured. The effects of that medicine interactions can be measured. About 300 people over 50 years old is in a database with our chemist partner, and that's a target for us. General public then, we go into disease prevention mostly. It's just an easy thing to be able to do. Fits in a bag, fits in your pocket. It brings ECG monitoring very, very simply to anyone on a mobile basis. Health, sport and fitness is a $1.3 trillion market, and that one there we also will participate in. So status, we are currently pre-revenue for the next 6 to 7 weeks while we have the final production made. 3 clinics in Australia on the GP level. We also have a pre-order for about 1,000 devices in the Middle East, and that's a very interesting market for us. Australian pharmacy chain I mentioned, the aged care and remote and rural are 2 areas of particular interest for this particular device. It is comprehensive ECG, so this gives us basically an open door into in-home care. The Apple Watch often gets talked about. It effectively does certain things, does atrial fibrillation. This device is a set of dozens of arrhythmias that are analysed. So there's a big difference between what you'll get out of an Apple Watch and those sorts of devices versus the analytics that we will get out of this across multiple arrhythmias. So our market, really, our business model is based around 50,000 customers over the next 3 years. The device is 270 Australian dollars and 120 a year in a subscription, which allows you to go into a portal and be able to view your own data if you doing that, and so that gives us target revenues of around 12 and 5 mil recurring over that period. The doctor-to-patient model is based on that 3-lead device. So the 3-lead device will be provided to a patient as a medical diagnostic, and that is charged for on a per diagnostic run with each patient. So that again gives us some target revenues there of 17 and 2 million recurring. So just a reminder that the roadmap here, it's a horizontal roadmap, short-term revenue, short-term impact for people to be able to use this comprehensive analysis on this device. Then the 3-lead device going into a clinical application, and then there's this much wider OmniMe platform which allows us to look at multiple diseases through that graphene sensor network and be able to diagnose, predict and manage those other diseases. So we think there's a 20x target at about that end of that. So we're looking for 1.1 on a valuation of 8.9. We've been reasonably conservative in this, and our primary use of the funds is really to just get this device out there. As I said, we have all the regulatory approvals, we are ready to go, the manufacturing and the final cloud implementation is underway. The other parts really are going to be the 3-lead device development, which is already underway, and the next phase of our platform. So that's it. That's where we are. We are out in the exhibition, so please drop by. Happy to talk about this and its competitive natures with all of the other devices as well. Thank you to Wholesale Investor for putting the event on. It's been a pleasure. Enjoy the rest of your day.
Thank you very much, Richard. Next up, we have Esther O from Agiliate.
Imagine coming home with a terrible cough, and within days, you can no longer see. It was only the 4th specialist that told you your vision could have been saved if the first doctor sent you to emergency department rather than referring you from specialist to specialist. This happened to my son during COVID lockdown, where I also lost 3 doctor friends to COVID. This is why I founded Agiliate, an adjective meaning empower to work smarter, faster, safer, to save, protect, and transform the lives of patients and clinicians. How? By using X-ray vision smart glasses to connect frontliners to remote specialists and AI assistants to deliver knowledge on demand in real time. The problem of medical errors and delays affects 134 million patients globally every year. But did you know that 80% of the deaths and disabilities are preventable, and 15% of the hospital spend are spent on defending litigation claims against healthcare professionals in OECD countries? Yet, our escalating global crisis of increasing population, mutating viruses, and disasters are putting clinicians under extreme pressure. This means that you may not get medical help in the most critical life and death moments. So how bad is this situation? By 2030, we face a global shortage of 18 million frontline healthcare workers, not counting specialists who take even longer to train. In 2021, the total addressable market for telehealth accounts for 37.6% of the $12 trillion spent globally. Targeting only 13 countries of single-payer healthcare systems, such as Singapore, UK, and US, our serviceable addressable market is worth $21 billion if we use our solution to resolve 2 million shortfall of frontliners. Servicing Australia alone gives us a serviceable, obtainable market worth $800 million in annual recurring revenue. So how does X-ray vision work? So where time is of essence and lives are at risk, this is where our solution comes in. A patient with a complex condition presents to a frontliner who is not sure what to do. The frontliner puts on the smart glasses and voice command a video call to a remote specialist. The remote specialist can zoom, highlight, and even draw on the frontliner's vision exactly on the patient's wound itself, or look down to examine the throat of a patient and guide the frontliner exactly what to do. Specialists who are retired, immunocompromised, or even overseas can now work remotely without exposing to infections or travel to high-risk areas. When there's no human or internet available, frontliners simply voice command our AI assistants for audio-visual instructions. X-ray vision integrates complex extended reality plus artificial intelligence and computer vision into one simple plug-and-play solution with minimum learning curve to rapidly upskill the workforce. This also enables remote doctors to log in anytime, anywhere, without the need for special equipment. We have co-developed our solution with leading professorial surgeons to ensure reliability, security, and fit for purpose, reducing manpower costs, travel, errors, and risk, while improving the patient outcomes and clinicians' health and safety. We also create impactful ESG returns with less paper and carbon footprint by transforming the model of care virtually. So why Agiliate? There is no better time to invest in revolutionary digital health due to the macroeconomic factors and the metaverse influencing the future of work that are here to stay. We won multiple innovation, cybersecurity, and impact awards and patented our unique IP that is highly scalable with multiple applications across various industries, including defense, who approach us to help them solve mission-critical issues on the front line. Our core team consists of industry leaders who have founded successful companies with over 300 years combined expertise from government, digital health, finance, and technology. I was one of the pioneers for the global mobile e-banking and biometric authentication systems to solve the Y2K crisis, technologies we cannot live without today. My co-founder, Chris Markovic, founded R Group International, servicing governments, aged care, and remote communities with advanced telecommunications and satellite solutions. Dr. Chris Payton, head of emergency department at a large remote hospital in Western Australia, also founded several digital health companies, including the largest doctor education platform. Anil, a war veteran and founder of the listed Moore Australia accounting firm, chairs the 9th Royal Australian Regiment and is a director of Clontarf Foundation. Robin, a pioneer in telehealth in Australia and the US, was ex-Microsoft senior account director running HoloLens clinical trials. Jim, chair of Aramsi Ventures, our biggest venture capital backer, also co-founded Chronicle, an NFT platform, and invests in emerging companies with global impact. Looking ahead, our roadmap aligns technology, intellectual property, finance, sales, and marketing with coordinated timing for potential exit in 5 years, licensing our IP and working with strategic partners to scale into different markets. Our business model is based on a monthly recurring revenue subscription and upselling modules and services with add-ons with economy of scale. Agiliate is an early-stage innovation company qualified by the Australian Tax Office, which gives attractive tax benefits to investors. We are also the first private company to become a medical research future fund eligible organization, a status reserved for large hospitals, universities, and medical research centers. Structured for maximum asset protection and investors' return, invest in Agiliate to build a lasting legacy for many generations to come. I hope to transform your vision today so that together we can transform our world. Thank you.
Thank you, Esther. Next up to the stage, we have David Wong, co-founder and CEO of Booked.
Great, thank you for that intro. I'd like to start off by having you meet a friend of mine. I'll call him Ben. Ben is the CEO of a fast-growing fintech company in Hong Kong. Now, last year, he moved his team from a co-working space into a cool, brand new open plan office. He even put a pool table in it. Now, his team loves it there, and they do great work. But Ben has a problem. That open plan office is great for collaboration, but unbelievably noisy when his team is having calls and meetings. It's a productivity killer. Ben was thinking about solving the problem by renovating to create some meeting spaces, but even a small 50 square foot meeting room would cost him $7,000 to $8,000 and cause weeks of disruption. He's worried about how well the rooms would be used. He's thinking about COVID and the fact that half his team is working from home. And most importantly, he's thinking, why would I want to renovate now when I may need to do more changes in 12 months or 18 months as my team grows? In short, Ben lacks data to be able to understand the return on investment for that renovation. And for him, putting money into something with no known outcome is a bit like going over to Marina Bay Sands and just gambling at a casino. But now, there's Booked. Our modular smart space system that we call Cubic offers a quick and cost-effective way for companies to create and manage private areas, private spaces to work or to meet, all at 70% less than the cost of traditional renovations or fit-outs, and in less than a day. Call it Flex in a box. Here's my co-founder, Charles, to tell you more about how it works.
That you can book. So we have our booths, we have meeting rooms, and for desks. On the Cubic system and our platform, you can actually list up hot desks, you can list up your own meeting rooms, and of course, you can list up our booths. So right now, we'll test this out with our espresso. So essentially, you tap, and you have choices where you can book now or book later. And let's say if I book now, which is the nearest available time, the nearest available time right now is 6 p.m. for 30 minutes or 6 p.m. for 60 minutes. And let's say I book for 6 p.m. For 30 minutes. And all you need to do is put in your email address. You press continue. And as you can see, you get a QR code for access. And this will only be available at the time that you book for. So right now it's 5:44 p.m. And so I can't access this until it's 6 p.m. So I'll show you. So as you can see, there's 3 beep, meaning you cannot access this. So I already pre-booked it for 5 to 6 p.m. to show. So if you see this, as you can see here, the booking time is from 5 p.m. September 23rd, 2021. And if you do that, you can open. That's it.
So Cubic is a game changer for companies needing an agile solution that can adapt to their changing team needs or needs of their office. And the results speak for themselves. A typical order today is 2 booths or 2 systems. If you add in the sales cost of the hardware, plus the installation, plus the monthly software subscription fees to access our booking system and our data analytics platform, and the average order value today is just under $16,000. Now, we launched Cubic in May of last year. In the past 6 months, we've seen a 5x increase in monthly revenues, including a $500,000 deal with WeWork to install Cubic here in Singapore, as well as in London. The GMV for our sales leads is over $1 million, and we're on track to make $4 million in revenues in the next 12 months. But that's just the start. So let me share with you our plans to get to 20 million in revenues in the next 24 months. First, We've spent very little on marketing. We can be tripling or quadrupling our sales leads just by investing more in events like this or ramping up our digital marketing campaigns. Secondly, we've developed a strong distribution network of partnerships in Hong Kong and in Singapore. Leaders in their categories, companies such as Ricoh for smart office solutions and Okamura and Zenith for office furniture. We can be accelerating our growth by extending these partnerships overseas. And then there's this. Our access control system, our technology, isn't just limited to working to our booths. It can work with any meeting room or any workspace. That opens up additional upsell opportunities for our applications and services. Because the market opportunity is massive. The office fit-out and renovation market in Asia today is $1.4 trillion every year. It's driven by the need to upgrade old infrastructure, as well as renovating and remodeling existing older buildings. I'm David. I've grown startups in Asia, as well as in Europe. My co-founders, Charles, deep operations background from private equity, including Credit Suisse, and Ken, he was part of the team that developed and installed the contactless card system that's being used in the Beijing Metro. Between us, we have 3 exits and 6 patents. Now, we've got backers that include Techstars, Colliers International, and Lazard Korea. We're looking to accelerate our growth by doing an additional raise of $1 million. We've got 10% committed so far. Now, I started off this presentation by talking about my friend, Ben. Well, he ended up buying 2 cubic systems because it was a way to solve his problems with privacy and noise and meeting space. Using our data analytics platform, he realized that his team was using our systems an average of 6 hours a day. They love them. So he ended up buying a 3rd booth. And you can actually see that on the bottom right. That's the customer there. We're booked. Our vision is for our technology and our solutions to be able to be used in future workplaces that combine the ability for teams and people to do their best work together. So we're next door. I invite you to come and talk to us, be a part of our growth story. And together, we can make commercial real estate less of a gamble and more of a sure thing. Thank you.
Thank you, David. Next up to the stage, I'd like to welcome Peter Yang of eiz.com.au.
Good afternoon. My name is Peter Yang. Our business is called EASE. What is EASE? EASE is a logistic technology company. So we use the data-driven technology to helping e-commerce business to solve fulfillment and logistic problems. Sounds very complicated. To make it simple, we are building Airbnb of logistic service global-wide. So my background, I was from 2015 to 2018, helping Alibaba and JD.com to set up a global fulfillment infrastructure. So I left the business. 2018, we start again from Melbourne. We currently be rated top 2 logistic technology company in Australia. This year we're expanding our business in US market. We're looking for 5 to 10 minutes fundraising. About the whole and what we achieved. Last financial year, Australian financial year, we make $20 million of revenue with 40 people. Our partners in 3 different countries, 5 cities, and 8 warehouses. And also we have more than 4,000 registered business majority from Australia and New Zealand, but we do have 10% from China, Singapore, Thailand, and US. About the market size, e-commerce business is huge. But how big is the logistics expense? So logistics expense in e-commerce industry is an average of 10% e-commerce GMV. So for Australia, we're looking at the e-commerce logistics size is $3.1 billion US dollars. Southeast Asia is $12 billion US dollars. US market, huge, $60 billion US dollars. What's the trend of this market? Now, tier 2 marketplace is catching up. What is a tier 2 marketplace? We know Amazon, eBay, that's all tier 1 global-wide e-commerce marketplace. But this trend is secondary, but it's not small. It's a traditional retailer is coming up. They buy online business and become online marketplace as well. Have a look at Walmart in US. Have a look in Australia, Kogan, Catch, MyDeal. They has been like engaged by the offline huge retailers. The other one is the Shopify WooCommerce is catching up. It's a big percentage of market share in the e-commerce market. So the people, the brand owner, e-commerce business, what they want to do is selling on multi-marketplace. Our customers, we focus on medium to size e-commerce business. Mainly 90% they are brand. So the brands come from Australia, New Zealand, Southeast Asia, China, and US. Everywhere they want to grow the business. So we find out this is the difficulty or problem they have. We call 3 to 1. So 3 is operation cost is high. If you just do the manual job, it's operation cost high. Integration cost high. Logistic management cost high. And also when they come into the new market, they will find where it is sold. So entry level resource, marketplace resource, this is the lack, and also the lack of the logistics service resource. And also we found out they haven't really used the data well. So I draw this. This is before they using ease. You can see what they need to do. Integrate with the local marketplace, integrate with the international marketplace, contract with all the transport business. And also, for example, in Southeast Asia, they selling in Singapore, Thailand, Malaysia. So they need a 3PL business in different regions. This is really troublesome. What do we do? So once they integrate with us, they use our service. So we have a pre-install and integrate with all the marketplace from tier 1 to tier 2. And also we have a very good discount contract with the transport service. But also at the same time, we have a already pre-set up contract and service from the logistic 3PL business as well. This is our global version, which is we want to bring brands, e-commerce business from country to country, not just a local. So we're helping them. So we already see that. We're helping Australian business, Australian brand, and set up the business in Australia. But when they come into the US market, they have to learn the new things. So we let them focus on what they're doing for business, leave these logistics things to us. We done the integration, we introduce the marketplace to them, and also they just send the inventory to our US fulfillment partner warehouse, and we contract with the UPS, everything, and just send it out. So straight away, 3 months later, our first customers in the US already has hundreds of orders a day. Our customers, current customers, we have a small, medium, and large. So our sweet spot is medium size. So the 30% of our customers' size are filled into the medium to large brand, and also they contribute 80%. We call the entry level not small customer. There's a lot of a good brand. They want to sell internet. They sell on the internet. They want to try overseas. So we're helping them. We teach them. And we help them graduate from the entry level to the medium-sized users. But also we do have, because of our technology called composable architect, so we do have a list of companies like JD.com is our customer, the ZTO is our customer as well. That's how we grow. With a strong e-commerce and logistic background in this industry, first 2 years, we set up, we build this platform, and then you can see every year we grow our business. By the way, this is a calendar year. So our last financial year, Australian financial year, is from July to June. So we make $20 million. This year, post-COVID hit all the industry. So we used to plan make $30 million, but now I want to decrease this at $23 to $25 million. About our system, so compared to the whole market, we're sitting on the level of the supply chain, digital infrastructure. So it's different from our competitors. Maybe they focus on warehouse digital 3PL technology or the shipping technology. But what we do is we want to combine them together. Because for my logistic background, 90% customers start from their garage or their own warehouse, and 10% they were using 3PL. But now my customers, no matter they got a shop, warehouse, or they got a 3PL, they're using one system for everything. Our US plan, we already come into US. So now we have one customer sending from our LV partner warehouse. This year, but this is Australian financial year, we're gonna bring 50 customers from local and local US, Australian, and set up business. We're looking at $2 million revenue from US market, and we try to prove the concept in US market as well. This is Southeast Asia. Southeast Asia is more complicated compared to others. But we also want to helping South Asia brand to come out from Southeast Asia and set up this business in bigger market. We're also looking at like potentially in 5 years more than $110 million US dollars revenue. That's our team, 40 people in 3 different countries, head office in Australia, but we're looking at the flip up our business head office in Singapore. We want to use our raise of $5 to $10 million. This is a little bit mistake. So our money will spend 40% on our developing, but 40% in US and Southeast Asia as well. That's all. Thank you very much.
Thank you, Peter. Next up to the stage, I'd like to welcome Jens Bonwagner, CEO of X Square.
All right, good afternoon, everybody. I'm Jens, CEO of X Square. At X Square, we develop solutions for the intelligent warehouse. Our mission is to allow goods in the warehouse to flow like water. We understand that to achieve true automation within the warehouse, you need to consider all the equipment you have, and you need to use a holistic approach to involve all this equipment and control it. At the moment, we can identify several phenomena, especially after COVID. There is a rise in labor costs associated with shortage of labor. This is a global phenomenon. You have, in general, for years already, a lack of interoperability within intralogistics. There are inefficiencies associated with this. Safety concerns are always a topic. And of course, especially after COVID, crisis mitigation is a hot topic. So these are phenomenon or challenges that warehouse operators need to address. And our solution in this respect is twofold. One is our AGV, our autonomous forklifts, the muscles if you want. So these are proprietary AGV built in-house here in Singapore with high precision, which allow operators to execute transport orders, to move pallets around within the warehouse. Our specialty here is that we allow mixed operation. It doesn't need to be shielded from humans. We can operate with humans alongside. And 24/7 operation is a given. So this is the execution side of our solution. Then on the software solution side, we have our WCS, our warehouse control system, which is the brain. There are several layers associated to this. One is the integration layer, which allows us to connect to all kinds of equipment within the warehouse. Be it conveyor belts or elevator systems, other fleets of robots. Of course, our AGV can connect. Sorry. ASRS storage systems, warehouse management system, ERP systems. So we can connect end-to-end within the warehouse with all kind of equipment that you need to consider. Once we have connected with this and integrated, we can orchestrate. We know the properties of each and every equipment. We know what kind of properties they have, how they operate, and so on. So we can execute transport orders coming from an upstream system like a WMS end-to-end in a very efficient way. And then the next layer on top of this is the optimization layer. After the orchestration is enabled, we are able to optimize processes. Consider you have 10 robots running around and several storage systems. You want to optimize in a way that your machinery is utilized in the best way. So this is the muscles and the brains of our solution here. A quick overview of the market. I don't want to go into details here. For us, relevant is the AGV and WCS side of the logistics technology. And our addressable market that we have identified is around 4.2 billion by 2025 across Asia, excluding China, Europe, and US. What we have seen as a company over the past years, especially now after COVID, is exponential growth. We started 4 years ago with our R&D phase, with our initial R&D phase. And since then, converging to this year, we have secured this year 3.3 million of signed orders. We have, as you can tell from our customer list, high-profile customers like GSK, British Pharmaceutical. We have Kato Nazi, is a multinational from Belgium. They're dealing with chemical logistics. And a beverage giant from the US, I can't give you the name, but you have drinking it, that I'm certain. So you can see there is the MNC area is a high focus for us here. We have some SMEs as well. ST Logistics is a local Singapore company. They operate a government warehouse that we are going to equip with our AGV. Our growth strategy. I mentioned that before, MNC engagement. We see high potential with MNCs, not only as a first-time customer, but for expansion as well. They have huge facilities, and usually after the first project, we will continue with them in conversation for other areas within the same facility or cross-region or cross-country in other countries within the region. We are also working on a new feature, is called container loading unloading. This feature is high demand from our customers. 90% of the customers we are talking to are keen to have this provided by us. Container loading, unloading, you can imagine these big shipping containers that you have all seen. Customers require that these are loaded and unloaded autonomously, and we are going to provide this with our forklifts as well. The next part, the third part, and this is actually the biggest part, is a collaboration with one of the biggest suppliers of forklifts worldwide from Japan. Again, it's under NDA. We are going to do a press release in 3 weeks, roughly. Through this collaboration, we are able to tap into their distributorship network in Asia immediately. So that gives us an immediate scale into the region. And we are, I don't have to talk about it, we are very excited about this collaboration. A few highlights, strong traction, especially with MNCs. Our margins are quite high. The strategic partnership, and I'm rushing here a little bit, my clock is ticking down. Where's the next one? Okay, to the financials. We are looking to raise 6 million on a 30 million pre-money valuation. How we are going to use this is approximately 1 million for this container loading, unloading, 2 million for other R&D. For example, the optimization is our main focus moving forward. Marketing and working capital will be a substantial part as well. Yeah, I think. Thank you very much.
Thank you, gents. Up on the stage next, we'll welcome Keith Oliver, Exec Chairman of Blackhawk.
Good afternoon. It's a pleasure being here today. Blackhawk believe that for a sustainable planet, we must all do more with less. Our contribution to do that is to unlock the potential of mobile assets, plant, machinery, and equipment, and empower the users for the assets that keep the world's economy moving. And by assets, we mean mobile, plant, equipment, machinery, and logistics systems. We service two segments in the mobile asset industry. The first segment is the supply side. So that's companies who sell, distribute, service, lease, finance, and rent machinery and equipment. On the demand side, that's customers that have intense use of mobile assets in critical situations in their business. If we turn first to the opportunity and the problem in the supply side of the industry, the biggest problem there is that universally, companies that sell plant, machinery, and equipment only get to service approximately 30% of what they sell. The problem with that is selling equipment might generate a margin of circa 10%. Plant, service, equipment, and maintenance and spares can be generating upwards of 60% or 70% gross margin. The opportunity with some recent research in the US is greater than $240 billion worth of revenue that's being left on the table. That's why our supply side customers come to us. On the demand side of the equation, customers with very large fleets of mobile assets, think of everything you see out the window at an airport or a port, really don't know how many assets they need. They don't know whether they're compliant, they don't know whether they need to be serviced. It's hard work managing large fleets of mobile assets. So our solution is a white-labeled SaaS platform. For supply-side customers, it reduces their cost of finance and reduces their cost of capital. It allows them to increase service and parts revenue. We saw there's an opportunity to go from 30% upwards on this aftermarket service revenue. And it creates a digital customer channel. So our customers, our dealers and financiers, get to give their customers an app for their smartphone. Think Uber, think Grab. So our customers get to have a digitally branded SaaS application that they can see their mobile assets, they know when they need to be serviced, and they can see the performance of the service company that's providing them. On the demand side, our customers like Qantas are able to now manage their fleets effectively. They're able to save time, they're able to reduce the fleet size. Some of our customers have reduced the fleet size by greater than 10%. And they're able to motivate their staff, again, by giving them the digital applications. So supply-side dealers, we've seen customers that have increased greater than 15% of their service revenue, 30% of their parts revenue, and to increase their machinery sales. So how does this work? We attach QR codes and IoT devices to the machinery and equipment. And for the modern machinery equipment, like Caterpillar, for example, they provide the data to us through their APIs. Customers then get to use browsers and apps to manage the machinery and to manage the proactive maintenance applications with a screenshot here. They're able to do pre-start inspections before they use the equipment to make sure they're safe and serviced. And they're able to have an unplanned maintenance job board so they can see in a queue of what machines are in service, what machines are waiting for maintenance, and they can actually measure the service level of their maintenance suppliers. But not only that, in the same way on Uber and Grab, where you might be able to rank the driver and rank the customer performance, our customers are able to rank the performance of their service technicians and understand the performance of the people on the ground who are actually delivering their brand promise. The real value comes in taking our customers on a digital 4.0 journey, starting with connecting assets and managing them all the way through to optimization and predictive management. No solution like this can work alone, however. So we have ecosystem partners, both in the software stage, in the IoT telco network stage, on the third-party IoT device stage, and increasingly importing data from OEM APIs who serve the data to the cloud themselves. What our customers tell us is unique about our business is our white label customer and channel engagement product. The ability to give their customers an app that allows them to be digitally connected to their assets on the one hand, and digitally connected to their service provider, their financier, their service depot on the other hand. So an ideal customer on the supply side looks like a mixed machinery brand, somebody who's in a tier 2 or tier 3 position and they're wanting to go on the digital 4.0 journey. And in the customer side, it's customers who have very intense use of mobile assets to keep the world's economy moving. So we've talked about a business model with two sides, supply and demand. The typical customer is paying us an ACV of around $50,000, and we've recently been able to introduce the product to resellers. So we're finding that telcos are very, very interested in this product, a way they can add value to their corporate customers by using the SaaS, and of course they can white label that with their own brand. One of the beautiful things about this product is as customers use and consume it, they suddenly find there's more assets, more ways that they want to consume the data, more assets that they want to connect to. So two cases in point, large machinery dealer, multi-brand, the largest in this case in New Zealand, 23 branches and 23 brands, I should say, and 20 branches. And they are using this product to deliver a digitally connected service to the largest dairy manufacturing company in New Zealand. Qantas also enjoy this product. They have over 1,000 SaaS users managing the more than 4,500 mobile assets that move around the 12 airports in Australia. So we've got great traction. This year we'll have 4.4 million revenue, 2.5 million of that is recurring, some 8,000 software users, and we're growing our subscriptions at a rate of 32% per annum. The addressable market, we're focused on New Zealand, Australia and North America. So the target market in the machinery space is around 20 million assets, which is equivalent to about $2 billion worth of SaaS. Over the next 3 years, we want to build a business to 20 million ARR, and we can do that by signing 500 customers. Our key focus beyond sector, territory, product innovation and partnership is our contestable moat, defensible moat. The digital connection that we're offering our customers between their machinery and their customers under our white label brand is proving extremely powerful. But a business of technology is nothing without smart people. Our customers tell us one of our unique characteristics is the performance of our senior leadership team and the people that work with them. We also have directors and investors who have scaled companies in the past for successful exits on the international stage. So our target over the next 3 years is to generate 22 million worth of revenue and 20% EBITDA, and we're raising 10 million, and of that we're going to be investing 6, which leaves 4 for further expansion. And my last point is, some of you may know a little bit about New Zealand. One of the interesting things about New Zealand is it's a great place to live and work and to bring up a family. And the New Zealand government, as of the last month, have just announced a $5 million residency for companies and individuals that come and invest in the New Zealand market. So if you're interested in coming to New Zealand, we'd be delighted to talk to you. Not only can you invest in a really cool company, but you might also get to live in New Zealand with your family. Thank you.
Thank you, Keith. Next up, we have a recorded presentation from Carlton Taylor, founder and CEO of Syngaget.
Welcome, and thank you for your time. It takes a great man to reinforce the importance of education, even in developing, emerging, and third world countries. And following on from that point, today's children are our future, but they want to learn and should be taught in a more engaging and rewarding way. And this is precisely what our company is doing, breaking the traditional mold of teaching and learning. A little bit about our company. Syngaget is an education technology company that came about when two edtech companies joined forces. Syngaget, a digital content aggregator with access to 3 million digital titles from over 12,000 global publishers, and Gate, an artificial intelligence-driven learning management system developer. We believe technology is rapidly transforming the education sector. The pandemic also made a difference with online, remote, and homeschooling reaching unprecedented levels. We have a razor-sharp focus on the role we intend to play, from our vision to our people, to our products and solutions, to our targeted markets, and importantly, our strategic partnerships. EdTech is a high-growth sector estimated to be worth US $64 billion by 2027. To date, we have invested significantly, and our business model is now market ready. Our aim is to grow big fast, and in doing so, drive our valuation up and create the opportunity for a potential trade sale. The education market is broad-based, and so are our range of products and solutions, as you can see on the screen. Unlike several of our competitors, we are not a one-trick pony. Our value for money products range from education resources to tutoring platforms, to our learning management system, and now to vocational education course programs. Our go-to-market strategy is the framework that wraps everything together. Our plan clearly defines our target markets, our value propositions, and product fit for those markets, and our in-country partnerships that brings us local connections and on-the-ground support. I mentioned partnerships in a few slides because we see it as the key to our success. One such partnership is with Aleph Education, a UAE-based global digital education provider. They liked us for our range of content and our partnerships in China. And we were very impressed with their ambitions for global expansion and a smart learning platform. Their aspirations for rapid growth across Asia matched with our overall strategy. And as a result, our two organizations have jointly agreed to a projected target of US $655 million in sales over the next 5 years. And on China, we have spent the past 5 years formalizing our partnerships with two Chinese Ministry of Education-owned organizations that ensures that Syngaget is fully compliant in China. Despite our extensive range of products, we aren't standing still. Our ongoing research and development will deliver innovative solutions, such as vocational education resources using mixed realities, which is a combination of virtual reality and augmented reality, and a children's e-library with adaptive reading for our target markets, especially in China, where children's reading of international books is a priority. And my prediction is the metaverse will be the next big game changer in education. And as a digital education company, we want to be the first mover in meta learning. At a recent conference, an event such as this that I attended and presented in Sydney, I was asked about the metaverse and our role, and I explained it this way. Imagine the creation of a virtual education campus that has no walls or boundaries, but can deliver world-class programs to masses across the developing and third world markets. It would be inexpensive and highly effective, and this is our vision. Our financial projections underpin our business strategy, and we have set ourselves key milestones over the next 4 years, as you can see on this slide. Year one will be a defining start for us, and our revenue projections have been based on our sales commitments from our partners, with the first half orders are now on target. On our leadership and our key people, we have a globally dispersed team that are the foundation of the business, and the reason we have decentralized our organization structure is to attract the best talent with universal knowledge and expertise. Led by our two founders, including me, we have many years of experience in business and technology. Before this, I ran the South Pacific business for a major US technology multinational. I did that for over 8 years. So to sum up, we want to grow quickly, and we need adequate capital to fund our growth. We're seeking up to US $5 million in this round to fully operationalize our business, including the lucrative Aleph project. Finally, and for those not familiar with EdTech valuations, there is an Indian private company called Byju's. They were recently valued at US $23 billion on revenues in 2021 of 1.2 billion. They have raised a substantial amount of capital, and each time they raise money, their valuation rises. This round, they're raising 800 million. Well, that's all from me, so thank you very much for your attention, and look forward to connecting with you soon. Welcome.
Thank you, Carlton. Next up, we have another recorded presentation. This one is by Steve Tiley, CEO of Wandara Pty Limited. I believe there are a couple of representatives from the company at the event, so I think you can find their booth in the exhibition hall. Thank you.
Good afternoon. My name is Steve Tiley. I'm the CEO of Wandara. I'm based in Townsville, Queensland, Australia. Our presentation today is all about industrial hemp, and it's quite a story around the hemp opportunity. So it's been with us for, industrial hemp's been with us for about 8,000 years, and it was cultivated and used for many, many centuries. And around about the 1930s, it got caught up with its cousin, the marijuana plant, and it was prohibited by governments all around the world. And basically for 70 years, we lost a lot of its use and knowledge. In the last probably 10 or 20 years, around about 47 governments have deregulated the use of hemp at various levels. And we're excited by this opportunity because we think we have one crop and we have potentially 5 big revenue channels. And really, as the world rediscovers the uses of hemp, we're well aligned to take advantage of that. So if we look here at down at the bottom, on the bottom blocks here, the stalk provides us a lot of the fibre and the herds and some of the products that come off that offtake. Then we go over to our food and oils section where we extract that from the seed. So basically it's an oil seed. So the hemp oil can provide a number of products through here, through foods and industrial products. And the pressed cake can be used for protein, for example. Then we move over to the health and wellness. So from the flowers and leaves, we have our cannabinoids, which are our CBD or our health and wellness products. The fourth opportunity is renewable energy, because we have waste on waste as we process a lot of this equipment. We can also use the entire plant for pyrolysis and renewable energy. The last thing is we border a lot of our operations on the Great Barrier Reef. So it's a really good plant for carbon capture. It grows over 90 to 100 days. And we're very strong in regenerative agriculture down here because of our operational areas border the Great Barrier Reef. So what's happening? It's going from around about a $6 billion sector globally at the moment and forecasting up around $130 billion as an agri-food sector. And we believe we can generate a very minimal $90 million in new revenue. Now, our business model is basically based on the Canadian sector. So we've been able to do a number of technology transfers with Canada, who have been doing this for about 10 or 20 years, and they've taken it from a cottage sector into a $2 billion sector. We believe, because the world is rediscovering hemp, there's a lot of work we can do with our balance sheet through patents and R&D, intellectual property, methodologies, and brand development as its uses are more adopted. Australia is very efficient at broadacre cropping, so we can get 2 to 3 crops off a year. We have the water and land security here in North Queensland, and using our agri-tech platforms, we're able to scale. And we also have the wonderful Port of Townsville here with direct shipping to Southeast Asia on a regular basis, so we containerise a lot of our exports. The last 2 points are really around developing a new economy here in North Queensland. The Australian government wish to develop the North much more, and we have a product here and a process that will receive a lot of government support, a lot of co-contributions, both intangible and cash, to get us through to this very exciting opportunity. So our business model is basically one of five areas, if you like. So our primary production, so we'll be growing it with our existing farmers here who have a great knowledge base in the local area and grow similar crops like soy and mung bean. The second opportunity is the manufacture of food. So we need to produce a lot more protein for the global market. So plant-based protein, beverages, and animal nutrition are a key part of our offtakes. Then we process the stalk, which is leads us into the fibre and herd markets, and things like construction material, animal bedding, recently wind turbine blades can be used, the hemp can be used in those sort of products. So it's very exciting around the material sciences. Then section 4 is basically the health and wellness. So our cannabinoids are being widely recognised globally for a number of medical uses. And lastly is the environment. So it is really a wonderful CO2 sequestration plant, around about 22 tonnes per hectare. Again, no waste. We can use a lot of our the whole plant for our activities. And then the soil health and regenerative agriculture movement here in Australia. And our sales and marketing is really based on a pull demand system. So we make sure we have all the sales contracts in place, which we're doing at the moment, and we'll pull through the crops. Our hub and spoke model is one where Townsville is with about a 200,000 person population, modern port facilities, rail hub, transport hub is head office, and final product manufacturing ready for export. And to our north and south are basically sugarcane zones where we will rotate with when they rest their soils or rest their land, we can grow in the industrial hemp in that. And we're very welcome, and we've signed up a number of large grower contracts at the moment. Pushing out west of Townsville into Western Queensland is a couple of areas called Charters Towers and Hillingdon, which is out a little bit further. And we have lots of water and new soil out there, particularly organic soil, that we can grow our crops onto. And all that will be then brought into Townsville efficiently for the final processing. So Australian demand for plant protein, and this could be particularly global, is there's a big change going on now where flexitarians, we're reducing our meat consumption, and some of the wonderful things that we can do with plant-based foods. For example, here in Australia, we're going to go to what we believe will be a $3 billion market. So the government and our consumers, wishes to produce those products here in Australia. And also government is really backing, federal government is backing manufacturing, particularly food manufacturing. And again, through the Southeast Asian transport links up into those markets. Aquaculture is an important market for us here in Australia. And again, opportunity to produce a lot of fish pellets based on hemp, soy and mung beans, which grow quite rapidly here in North Queensland. So our use of funds, at the moment, we're hoping to raise over $5 million. and basically your standard scale up. So continue our R&D that we've been doing, go for our commercial cropping here just to finally prove up the process. A lot of CapEx around just buying some specialist equipment like headers and balers, through to decortication systems, and finally the seed processing line, and of course operating expenses to keep us going. On the other side is the co-funding. So as we say, a lot of government support to assist us in this process. So just finally, impact investing. We believe we have a wonderful opportunity here in North Queensland around our environmental pillars such as CO2 sequestration, healthier water runoff into the Great Barrier Reef, opportunities for clean tech. We hope that and understand that most of our power can be regenerated here on site through solar and the waste streams. Potentially 150 new jobs here, a lot of money being paid farmers going back onto the farm and back into rural communities. And finally, just the governance. We're behaving and have a systems like a public company at the moment, and going for government grants. Government are backing us, so there's quite a big governance factor around how we plan to do our work and how we will achieve our work and projects. So thank you very much for the opportunity. Thanks to Wholesale Investor for the opportunity. One of our representatives from Wandara is at the show today for the presentation, so please make him known, and if you have any further questions, please see our representative. Thank you. Bye. Good afternoon. My name is...
All right, thanks everyone for listening. Next up, we have Glenn Wheeler, Managing Director of Fremantle Octopus.
It was the great English writer, W. Somerset Maugham, who put it like this: "It's a funny thing about life. If you refuse to accept anything but the best, you very often get it." Species of octopus that we catch is only caught off the coast of Western Australia. We're the largest producers of MSC accredited octopus in the world, and for those of you that don't know, MSC certification is an independent global fisheries standard that is only awarded to fisheries that meet a science-based set of requirements for sustainable fishing. Increasingly, the world is looking at high protein coming from sustainable sources, and we are the world's #1 premium caught, wild caught octopus. We own 48% of the licenses in the #1 MSC accredited fishery in the world, and we're a fully integrated octopus fishing, processing and wholesaling company. The world catches about 400,000 tonnes of octopus. That's a $12 billion market. Most of it's primarily caught by indiscriminate trawl fishing, primarily off the northwest coast of Africa. The trawling industry worldwide is estimated to create more CO2 emissions than the entire aviation industry in the world, global aviation industry. What Fremantle Octopus has done is developed and patented the world's most ethical, environmentally sensitive and sustainable octopus trapping technology. This summarises why our product is in demand worldwide. You can only catch it off the west coast of Australia. It's the #1 premium octopus in the world. We have the dominant licence holding in the fishery. We currently own 42%, going to 48%. There are 3 different zones. We own 78% of all the licences in the primary catch zone. We have the world-leading patented technology that puts us as #1 in the world in terms of supply of premium sustainable octopus. Just here in Singapore, you've got restaurants like Burnt End, C'est La Vie, Level 33, and a host of others who only have the world's best octopus on their menu. We've developed other products that are now in demand from Australian supermarket like Coles, which is Australia's leading supermarket. We're in 619 stores. We've recently gone into the United States. Whole Foods, for those of you that don't know, Whole Foods has 476 stores nationally in the United States, and it is recognised as the most premium natural and organic food supermarket in the United States, if not the world. We export to Singapore, Hong Kong, Shanghai, United States, Europe and Dubai. And we're by far and away the leading octopus business in Australia. There are only 2 MSC accredited fisheries in the world. The other one is on the north coast of Spain, Asturias. It's a small artisanal fishery, only catches enough octopus for the local market and not much more. The only other fishery in the world where you can get sustainable octopus is the West Australian octopus fishery, and we own most of the licenses in that fishery. Research has shown that the West Australian octopus fishery has a minimum 400% growth capacity that we can grow into. This is where we're going in the next 12 months. We're going to buy 3 more vessels. That'll increase the deployment of licenses that we have from 49% to 64%. The West Australian octopus fishery was only established in 2015. It's a relatively new fishery. We haven't even fished all our licenses yet. We're buying more licenses, buying more vessels, and fishing for more octopus. And the reason for that is we can't keep up with the demand from customers nationally and internationally who want our octopus, and we're able to sell at the highest price of any octopus in the world. So we go into international markets, our octopus is 30% more expensive as a minimum than anyone else, and yet the high end of the market just wants Fremantle octopus. Our catch will jump from 247 tonnes last year to 349, a 41% increase. Revenues will go from 7 million to 11.3, and international sales have gone from 10% in FY21 to 30% in FY22 and going up. 50% is next year. We're looking to raise $5 million at a market cap of 16.7. When you add the 5 million, that'll take us to 21.72 million. We're going to spend 1.7 million or 1.68 on licenses, 1.6 on vessels and equipment, 1.72 on working capital because of the expansion into international markets. We'll do 11 million of revenues, 1 million of EBITDA, and that'll move up over the next couple of years. We're already a proven business with proven revenues and profitability. The indicative market value of the business will move from 17 million to 39 to 64 to 78 fairly quickly. Our key shareholders are institutions in Australia, high-end institutions. We've got the Cowan family, Domino's Pizza, Hungry Jack's, etc. Bunning family sold to, or currently valued at about 20 billion, with Wesfarmers, and our directors own 44%. The primary reason that people are investing in Fremantle Octopus is our board of directors. We've got 3 directors with ASX listed experience. Bronte Howson took AHG from 100 million to 1.5 billion market cap. Angelo Del Borello took Aspen from 700,000 to 350 million market cap. 3 directors with ASX listed experience. We're a proven business, proven products, with proven growth strategies, run by a proven board. And in closing, I'd like to wish you well for the day and remember the quote from W. Somerset Maugham. It's a funny thing about life. If you refuse to accept anything but the best, you very often get it. Thank you.
Thank you, Glenn. All right, everyone, we're running a little bit behind schedule, so we're going to break to lunch. We may shorten this just to keep on track, but we'll let you know with the bell as usual. Thank you.
So this is always the hardest part as an event organizer, trying to get people back in after lunch. Thank you very much for those that have already come in already. So look, obviously we've had an incredible start to the day, and really, as I said, there's 3 things where make real value from this type of event. Number 1 is obviously the speakers and the panelists that are actually participating in these sessions and what we get from them. Number 2, obviously the opportunity to network with other attendees, which always ends up being a strong part. Number 3 is obviously the companies which actually participate in the event. So I'd like to say a big thank you to everyone for being involved. Now, one of the common questions we have from people is how do we curate opportunities? And I think that's a really important question. For us, what we're looking for, when we actually host events like this and we host showcase events, to me, what's really important is you have that really nice mix, and this is what makes WI unique, is that 3-sided marketplace. When we're looking at companies, we're looking for founders that have got that sort of been there, done that experience, number 1. We're looking for sectors which are in that sort of growth phase, which are of interest to investors at that time. You know, to me, that's an important part. You know, the old saying, a rising tide lifts all boats. And as I mentioned in my first slide, there's been a whole bunch of sort of fear and association around the last sort of few months, you know, around the sort of venture and the high growth or the innovation space. To me, that subsides when you start to see some of the exciting companies that are coming out and the growth potential for those companies. You know, number 3, when we're looking at B2C businesses, obviously we're interested in some of the metrics which they've been able to produce to date. B2B businesses, we're looking for blue chip names or brand names which they've got trials with or got partnerships with, etc. as part of it. And then the last one is especially, like, we deal a lot with sort of really technical and deep tech businesses. We're looking for potentially industry awards or at least referrals from people in that space that sort of know that as an area. So this space is always difficult and always challenging, but to me, as I said, what makes it so unique is the people involved in it, their optimism and their approach. What also makes this all unique as well is that however many people are here today, whatever networking takes place, it sometimes crosses over years the impact in which people can meet from one conference. And to me, that's why I love, when I say that the vision for WI is creating opportunities for tomorrow, that is fundamentally what drives me and drives us as a company to keep hosting stuff like this when it is such a logistical effort to not just bring attendees, but also the speakers, the panelists, the companies, etc. Because we know the power of one conversation and the difference it can make. So on that note, I'm going to let Jonathan do the introduction to the next panel session. This, for me, is probably going to be one of my, obviously, the trends in venture capital, I think, is probably one of the powerful sessions, but this one, for me, I'm absolutely fascinated by. As a company that's moved ourselves into the fintech area, I said, majority of the panelists I know and have great respect for and have watched them build their own portfolio and capacity in this space as well. And I think we're quite privileged to hear from them. So over to you, Jonathan, for the introductions. Thank you.
Thank you, Steve. So this panel will be titled Fintech, Trends and Disruptions. The panelists are Luke Jones of Redstone Capital, the CFO, Hurston Powers of 1982 Ventures, Managing Partner and Co-Founder, Calvin Ng of Aura Group, Managing Director, Madhu Mehta of MSPL Consulting, Founder and CEO, and Fong Jack Gan will be moderating this panel session. And he is from Jubilee Capital Management and is a founding partner. Thank you.
Okay. So very good afternoon to everyone. This is after lunch, so hopefully you will not fall asleep too quickly. So all we can all fall asleep together. Yeah. Okay. So let me just kick it off. The topic that the organizer has given me is fintech trends and disruptions. Right. So this is a very broad topic, and we're very honored to have a panel of very experienced investors and professionals from the financial sector. So we'll cover a few areas, but given the time that we have, it's about 30 minutes, we'll focus on a few areas. So I'll break into 3 parts, more the past, present, and future. And we'll start off with a round of self-introduction by everyone. and then I'll kick off with some suggested questions for each of the panelists to share their insights. So I'll kick off for myself first. So my name is Fong Jack Gan. Gan is my family name. So I run Jubilee Capital Management. I run 2 funds. One is a early stage tech fund. It's a 7-year fund. This is year 7. It's fully deployed. Do investments in pre-A to early B round, fintech, e-commerce, AI. And I have also got a crypto fund. It's a 3-year fund that I've exited with good returns, 3x, given back to investors. So now just looking at the market, trying to learn and see what everyone's doing, and hopefully get involved in something more exciting. So I'll pass it over to time to our next panelist, Kevin. Maybe you want to share your background. Yeah.
Hi guys, thanks for having me here today. My name is Calvin Ng. I'm the managing director and co-founder of Aura Group. We're a boutique fund manager specializing in private markets. So what does that mean? So we do a lot of venture capital, private equity, and private credit. As of today, we're currently managing about 1.3 billion, predominantly on behalf of high net worth investors, family offices, and institutions.
Hi, Luke Jones from Redstone Capital. So we operate a crypto-only venture fund. So we basically use our own money to do, complete degenerate gambling in crypto. For those of you who've experienced the space will probably know what I'm talking about. But so yeah, that's what we basically do, and we've had a pretty strong focus on DeFi, so decentralized finance, over the last couple of years. So that's probably why I'm here.
Hi, I'm Madhur. I'm a capital raising banker. That's where I spent all my professional life. About 1.5 years ago, I moved and created my own consulting company. I got exposed to tech in my bank when I created a venture on the bank's computer architecture, which was Tinder for borrowers and investors in sustainable finance. Fell in love with tech, left, and now what I do is I consult RegTech, Fintech, Insurtech, and EduTech to scale them up.
Hi, I'm Hurston Powers of 1982 Ventures. I'm a co-founder and managing partner. We're a Singapore-based seed fund exclusively focused on fintech across Southeast Asia. Right now, we're the most active fintech investor in the region with LPs from Genting Group in Malaysia, Carta in the US, and one of the largest Indonesian conglomerates. Thanks.
Okay, great. So maybe let's just kick off with the first part of the question. Let's talk about some of the disruptive technology that you have seen, or investment opportunity that we've seen in the last, say, 5 to 8 years, right? And maybe we'll start with Hurston. So that's first part of the questions. So as you go through, I would like you to share about what you have observed as what we call disruptive technology, and then also share a bit about your insights on what you see next for the next. So from at this point in time, what are the new disruptive technology that you see on the horizon? Yeah.
I guess I'm not going to be able to pinpoint exactly where you should be looking at. So I would put it in a framework of what we see as the biggest misconception in Southeast Asia right now around fintech. I think when many people think about fintech in Southeast Asia, they think about e-wallets and payments and think that Southeast Asia's finished. We've made it here. We haven't even scratched the surface with regards to fintech. We're really just getting started in Southeast Asia. So we see a lot of white space of fintech entrepreneurs building on the existing infrastructure that's been laid out for the last 5 years. So utilizing existing payment rails to build more sophisticated business models on top of those, but also utilizing what we say more sophisticated technologies such as BRIC in Indonesia, which is an open banking financial API platform, to start embedding fintech and financial services within your core offering. So I think what we can say is that compared to the rest of the world, Southeast Asia is still way behind, but we actually have some of the strongest growth drivers behind us with regards from a macro perspective and demographic. Couple that with the massive financial inclusion issues you have here, we see that the next 3, 5, 10 years will be a super cycle, not only for Southeast Asia and especially Indonesia from a market expansion perspective, but it's really fintech's time to basically take the center stage or forefront in this ecosystem. If you look at the past 5 years, 10 years, it's e-commerce, online gaming, online travel, ride hailing. Those stories are great. They're still continuing to play out, but we're already seeing massive exits in those sectors. Looking forward, it has to be fintech. So I guess to get a little bit more specific, we see that payments is still a huge headache for most individuals. Even though I can send you money instantly through an e-wallet, everyone here has probably experienced the frustration of not being able to get a wire across or failed payment. Why does that have to happen today for a big business? Why can't banks allow us to try transfer funds easily as I do to my friends? So we've invested in a Singapore company called IPID, which allows corporates, banks, financial payments platforms to be able to wire money to any country in the world with one identifier, not needing an address or account name or anything like this. So we see these little unlocks are going to basically create a lot of value for the entire ecosystem.
Yep. Yes, just go around.
Okay,
Yeah.
okay,
Go
cool.
free.
So I'm only a year and a half old in this area. I spent, as you know, all my life capital raising in large banks. So what I see is obviously the simple way of saying is B2C and B2B. I'm more on the B2B side. I'm going to say a few radical things because I wasn't exposed to this and I'm pretty new to this. So whenever I see the RegTechs and the Fintechs go across to pitch to large corporations, I see a lot of pilots and POCs taking place, but I don't see commercialization taking place. So I think the killer of innovation is the large corporation. B2C works very well because the consumer makes the choice. B2B is damn tough, and I've seen that. A lot of the corporations, the large ones, and I mean the seriously large ones, 10, 20, 30,000, 100,000 employees, have tech teams which are maintenance and development tech teams. The development tech teams push back protecting their jobs. Because when you come up with a really, really great tech product, which those guys can incorporate on their system, and they probably will lose 10 to 20% of the workforce, they're going to push back. So one of the things I've seen is internal tech teams, again, radical statement, are the killer of innovation. Not always, many times, across the world, not just one country. So that's one. Two, what are the B2B areas? I really don't know too much about B2C. That I see as the growth areas, just about everything. So just think of bank. You've got a traditional bank and a digital bank. Why does a digital bank do well? Because people between the ages of 15 to 25 are going to embrace the digital culture, or have. And they want to do a trade, let's say 4 o'clock in the morning, they can. Not like the great grandfather or whoever wanted to go across to the branch and do their banking. So those digital banks are going to do really well. Of course, they'll need to be well managed. So I think that is definitely a growth area. And then just think of the ecosystem. What does that digital bank depend upon? A number of products which they will need to utilize. And all those products are definitely going to do well. I know we're constrained on time, so I'm just going to stop here. Luke?
I guess the only thing I'd add to that would be my own simple opinion on what's growing in Southeast Asia and what the next step would be. For me, it's like the payment solution has, you're right, not entirely been solved, but it's pretty much in the works. Like you've got a number of different applications around here that can enable people to transfer funds and not need to be banked. So that whole banking the unbanked argument has almost already been solved here. The only thing I would add to that to say the next step for me would be the solutions that are going to provide access to capital for people at non-predatory rates would be the next stage of interesting innovation that can happen in this area. Because although you can transfer money that you already own, getting access to credit is in those environments are incredibly difficult. So companies that are looking to solve that problem, but it doesn't necessarily need to be a crypto thing. That's sort of where I see more of the more interesting stuff happening. As soon as I see anything about insurance in this space, I immediately think it's pretty much too early, because we've seen lots of sort of smaller level B2C insurance stuff pretty much not work in a number of different market segments. But yeah, without crossing over old ground over here, that would be my 2 cents.
I think it's a pretty broad question, but I think the best way for me to answer that is use the use case that I'm most familiar with, which is the funds management industry. Like super, super archaic. Like if you had a camera watching me all day, I'm doing phone calls, I'm downloading PDF files, I'm printing documents, filling out forms, wet ink signatures. It's a maze of administration. In fact, there's a whole industry called the fund administration industry that includes things like manually updated registries, right? But if you fast forward 5 years, I think all these will be done via digital platforms, electronic signatures, digital identity management, and a lot of the transactions will be powered and recorded on the blockchain.
I want to dig a bit deeper into this, what Matthew was saying about the digital bank, right, or this neobank, right? Do you see, how do you see the change that's going to happen in the next few years? Because there's been a lot of new licenses have been issued. And banks are naturally resistant to change, right? Because they're established and you come from the traditional finance background, you've seen it at work, you know the drill. And when all these new startups calling out and say they're going to change the way people do banking and things are going to get easier, cheaper, faster, do you really think that it's going to really take off? And what are the problems that you can see, given your background, and what are the solutions that you think is available?
So let's just take the traditional bank. Why did people go to the bank? And let's say that was like 30, 40, 50 years ago. They went to do a payment. They went to deposit money. They may have gone for a wealth transaction to invest in a fund or whatever. And lastly, I think they actually went to meet people as well and be around people. Fast forward into a digital bank. Why would a 15-year-old to, let's say, a 30-year-old use a digital bank? Largely for payments, and that's why the payments industry has done so well. Also for wealth, and that's why the wealth industry on digital has done so well. So I think it's more of an enabler and a B2C enabler, but a B2B, that's going to be, I think, a lot more challenging, and that's going to take some time. But let's just come back to the B2B. What do you really require for that? You require an eKYC, the video KYCs you require. You need the digital identity. You require that ecological system. So once you attract that customer to that bank's website or the app, that app can provide other services like a mall does. If you go back 20 years, you found banks in malls. And like in the Philippines, if anyone's from the Philippines, they would be open on the weekend. I've even seen a church in a mall in the Philippines. So everyone just goes and hangs out on Sunday and does everything on Sunday as a family. And the shops over there benefit as well. So now think of the digital bank. So if that person goes into that app and has a variety of items like wealth or payments, or it could be food or whatever else, show me the closest Italian pasta outlet or whatever, Pizza Express. And that particular app is gonna just, I think, going to become an ecological system, just like Apple's created their own ecological system. So there's going to be a fair amount of other services coming through that one app.
I would just jump in. I think the fact that we're asking this question is showing that Southeast Asia still has a lot of room to run in this space. If you look at a country like Brazil, which is obviously a very big market, but not as big as Southeast Asia, they already have a neobank that's listed on the New York Stock Exchange. We know that this works for emerging markets, not just for the B2C, but for the B2B as well. We've invested in neobanks that are focused on SMEs, startups, and small companies, not just because of kind of an underbanked issue in markets like Indonesia and the Philippines, but user experience. Our good friends at DBS love them to death, but it's a horrible customer experience. And if a fintech can delight their customers with onboarding, give them the services that they need today as opposed to when they're 5, 10 years old, or not even a small business anymore, we know that market's going to be serviced by new startups. And there's been a lot of press and talk over the last few years about these digital banking licenses. Grab has one here, Shopee, they have them all over Malaysia. I think that's a good thing for journalists and to stoke interest and clicks, but nowhere in the world have the incumbents become the leaders in digital banking and neobanking. It just hasn't happened. It hasn't happened in the West, and it hasn't happened in emerging markets. So our view is that the neobank, or the digital banks of Southeast Asia, will be homegrown from the start, startups.
So just on that, the neobank in Brazil, that's New Holdings, and I know that bank, I've read about it. When you see the balance sheet, it's a super simple balance sheet. There's nothing complicated. It's cash, it's assets, there's equity, and you can, even you know, a university student can dissect that balance sheet. If you dissect a large bank, traditional bank's balance sheet, you probably get lost for like 1 month. And over here, you'll get to know what the balance sheet is in about 5 minutes or 10 minutes, and then of course you'll have to go deeper. But what I hear from my friends in South America is the UI UX experience of New Holdings is so good, it just attracts customers to them. I think they've got more than 65 million customers already in Brazil, Mexico, and Colombia, and all they're doing is Control-C, Control-V. They create it in one country, go to another country, and it's exactly the same strategy.
Sounds interesting. You must share that with the audience. Okay, let's move to the next topic. I'm going to tap Luke and Kevin's insight on this. So the next question is we're going to talk about, so given the current climate, right, all these different challenges that we're seeing on the news, on the world economics, between China, US, and on all the banks that kind of changing the positions. What is your view as to what we should be investing on in terms of the new disruptive tech that we are looking at? What are new trends? What are you investing in yourself, in your fund or?
Well, I invest in crypto mostly, so it's a bit different to what you'd be looking at traditionally. But the reason for that is because, and I could have commented on this on the banking thing. I mean, for example, I think that if we don't get caught up with the bullshit that is involved with the crypto space and everyone talking about blockchain and everyone suddenly becomes an expert in crypto after being in the industry for 6 months, which I really fucking hate. But it basically, the real advantage of, say, something like crypto technology or like, the way that crypto works is, I'll give you an example. So I got a $20,000 payment, US dollar payment into my Australian bank account a couple of days ago. And, it took a day. That's great. That's fine. But in the conversion cost, it cost me about 1,000 Australian dollars between what I would get if I was doing something, if I was getting a more competitive Forex rate. Now, the 24 hours thing is not a big problem for me, but the big thing that crypto does is that if I wanted to do a $100,000 payment from one person to another, I could basically go to an exchange in Dubai, get my mate to deposit $100,000, convert that into USDT, send that to my Australian exchange, convert it to Australian dollars, and I'm not joking, you will get the Google exchange rate, if not better. And it will happen in the space of probably 10 minutes. You could probably get that transaction done. And that's something that can't be done in traditional banking. Now, the main reason why, for example, I would invest in that technology over, something a bit more traditional is because of that basically speed and efficiency. Now, the one risk in that is, of course, the big regulation thing, which is what, which is where we link it back into what you're talking about with everything going on in the world, with sanctions, with all these different things happening. The biggest concern that governments have now is where these big lumps of money are coming from, where they're going to, are they being used to fund drugs, terrorism, child trafficking, some kind of illegal activity, whatever. And that's where the real risk is to see how it tightens. Now, if anyone's aware of crypto, like one of the main ways you could obscure transactions on a blockchain was something called Tornado Cash. And the US government basically came out and said, it's deleted, you can't use it anymore. And essentially, if your wallet had been a beneficiary of a transaction out of Tornado Cash, essentially you're locked out of a whole bunch of different DeFi services and things like that because they don't want to be sullied with this dirty money. Even though I think 65% of users were not doing anything dodgy, they were just trying to maintain privacy. But yeah, that's sort of the reason why I'd be looking at something more crypto-focused as investment to solve a lot of these problems as opposed to traditional.
Kevin, what are you investing in?
Yeah, I think in this sort of market conditions, the simple thing to do is look for a real-world use case, right? And if you've got a real-world use case, the SEM and TEM are easily identifiable. You can go after monetization sooner, and revenue is the best form of funding, right? And that'll put you in a much better position when the markets do come back to source funding. We keep things pretty simple, right? So like using the blockchain example, we really like picks and shovels, blockchain infrastructure, KYC tools, stable coins, stuff that is powering real-world transactions that exist today. And we're definitely staying away from, I guess, markets that have yet to be created.
Okay. Maybe Mahir and
well,
Hassan.
just to kind of keep on this theme, I'm definitely not an expert on crypto like my esteemed panelists, but we started kind of getting our beaks wet, so to speak, or dipping our toes in it. And we invested in a company called AAA here in Singapore, MAS regulated, that allows businesses to accept crypto without having to touch crypto. And I think that's kind of one of that first kind of baby step before we get into having their own wallets. So if you're a brand like LVMH or a hotel group or a private jet, anything where your customers want to pay in crypto, but don't really have the capacity, the bandwidth, the expertise to kind of set up that infrastructure for yourself, you can utilize an MAS crypto payment gateway called AAA to do that. They're serving over, I believe, about 11,000 customers in 80 countries to help people facilitate more crypto payments without the hassle, so to speak.
That's the one that's doing some OTC trades and doing some trading, right?
You can do trading, you can just buy, transfer. The best thing about it is that if you're LVMH or if you're Marina Bay Sands, you don't have to worry about the KYC. It's already being done by the payment gateway, and it's all regulated by MAS here in Singapore.
Okay. Mahir, you have anything to add? What are you investing in?
I really don't know much about crypto, but what I've heard investors saying is they really prefer a crypto platform in a regulated country, and if that platform is going to be regulated by the regulator of that country, then they get really comfortable because they really can't see behind the scenes and they depend on the regulatory guidelines for a lot of things.
Okay, thank you. So this is a very tough market, right? We see the crypto winter going through a rough phase. A lot of startups are raising money. But the good ones are still raising quite a bit of funds. Investors have a lot of choices. Investors are also having the benefit of looking at those listed stock market. A lot of the good value companies are trading at very good discounts. So there's a lot of options that is available for them. So maybe we can spend a bit of time just talk through to look at what are the advice that you can give to our investors online and also in person here. What can we look out for? How do we pick the next winning bet in terms of the startups and in terms of the investment opportunity? Any advice for our audience here, for investors?
I'll just start very quickly. I mean, something like because you started with crypto winter. I mean, don't get me wrong, it's been a good month. I mean, Ethereum's doubled in the last month. I mean, try doing that on the S&P. So it's been a look, but I mean, obviously everyone says that the bear markets are a real good time to find opportunities, which is very true. I don't think we've hit any kind of major low yet. I think we've still got plenty of down space to go because effectively the global economy is stuffed. So we've got to wait for that to sort itself out. But when it comes to my experience in cycles in this space, when it comes to investing, is that basically the worst time to invest is generally near the top or when everyone's hyped up, because you generally get complete shitty, overvalued projects led by people who have no idea what they're doing, who are just basically capitalizing on the fact that there's so much free capital. And that will slide, that stays true for the first slide down, because you get those late market entrants who are going to start doing, the the Aave of whatever, or the Airbnb of blurt, but in crypto. Like, you get all that shit, and then it's basically just not worth your time. And also because most of the founders are completely retarded. And so what happens, the best time to invest in this market is after, pretty much for me anyway, is that when the newspapers come out with crypto's dead, it's all over, the whole thing's going to implode, you've all lost your money, sucked in, you idiots. And then that's when you generally get people starting to come out actually looking at solving real problems that people want to see, and then blah, blah, blah. Like, for example, if you were invested in a lot of projects that sort of were raising in, say, 2019, late 2018, I mean, you were doing something like a 3,000x by the time they listed in 2020. Like, stupid numbers. And that would be my advice for how to invest in this space in my world anyway.
Right. Thanks, Luke. Any other advice for investors?
as a seed investor, my approach doesn't change too much. I'm a bit uncorrelated to the markets, and Southeast Asia has been a bit isolated, I'd say, to a lot of the doom and gloom. So for the thing that I would tell my founders, and the same approach that I'm taking to my business, is if you're in a strength of position, push on the gas. So right now, with a bit of capital to deploy, we're staying, I guess, extremely focused on finding fintech founders that we want to work with and staying very disciplined around price and valuation. As a seed investor, I'm generally setting the price. So it's only my fault if something happens with regards to paying too much. But with that said, if there's any signal that maybe we're back, is Adam Newman raising 350 from A16Z, the old WeWork guy. We don't want that to happen either. I think what we want to see is something that's sustainable. For the, I guess, from a portfolio perspective, what we're telling companies is if you're in a strong position, you've got enough gas in the tank, push on the gas in a prudent way and start, I guess, taking talent that you would not be able to acquire. You've got the larger late-stage companies getting forced by their board to lay off good talent. Take that 10x developer, 10x product, 10x salesperson right now. Go after that talent. You've got these larger companies that are halting expansion into new markets, expansion into new products. This is the time when they're slowing down to push into that and basically become that winner. For the companies that are not a strong position, and a few of those in our portfolio as well, where they were expecting the good times to continue to roll, so to speak, and being able to just raise capital on a whim, we've had to make sure that our founders have realigned their mindset and adjust their expectations. So maybe they have to be okay with taking a little bit more dilution than they would have 12 months ago. Maybe the round size is not as large as they would like. Our advice to them is get the round done fast, don't sacrifice growth, and come out stronger on the other side of it.
Right. So we have about 2.5 minutes now. I want to add on one more question. If there is a would-be kind of potential entrepreneur here who is looking to start a new startup, let's say in the fintech area, what would be that one advice that you would give, what to look out for? What would be one thing that you would direct and advise this entrepreneur?
Sure, I can go with that. Cash is king. That is very key.
Fundamental 101.
How long are you going to survive as a founder with all the losses that you're going to accumulate? That's important to calculate. There's a war going on. The banker to the world, that's the US. There is no QE anymore. It's quantitative tightening, QT. The manufacturer of the world, China, has a supply problem. So you've got 3 issues. It's not going to get sorted out very soon. Equity markets will price in whatever 12 months ahead of the curve. Leave that alone. A founder struggles every day. Fundraise every day. Watch your cash. Reduce your teams, stick to your milestones. The era of 2017 to 2022 is gone of valuations. Valuations are a lot lower. The bid offer from an investor to what a founder wants, you can drive a truck through it right now. It's going to be super wide. I don't think it's going to stay that wide because I think there's a fair amount of cash on the sidelines and the cash wants to come back. It's going to take time to come back. So just remember, take your time as a founder, get the right investor, the one that can make phone calls for you and increase your business as well, and can work with you.
Very good advice.
I'm going to say mine in 2 sentences, basically. On top of that is that the one thing I found that people really, really mess up is if you can't identify who your end customer is and how you're going to generate revenue, and this is something I see all the time, like who's your customer, how are you going to make money? If you can't answer those 2 questions, don't even bother starting.
Kevin?
Yeah, I'm going to echo both of what Madhu and Luke said. Keep costs low, focus on monetization. As I said before, revenue is your best form of funding, and that'll keep you in a really good place when the capital markets do come back and you need to raise capital.
Very good. Any last? Yeah.
Agree. The only thing I would add is there's no better time to start building than today. Southeast Asia is about to hit the super cycle. So if you're passionate about a big market and a big problem to solve, let's speak and let's get after it. Thanks.
Thank you very much. Give our panel a good round of applause. Yeah, thanks. So we're on time. Thank you very much for your time. Yeah.
All right, thank you, Luke, Matteo, Calvin, Hurston, and Fongjack for moderating. Up next, we have a presentation from Matthew Edmonds of Genie Yusto.
Yes, great. Well, good afternoon, everybody. Thank you very much for your time today. Thank you for giving me 7 minutes and 57 seconds, so I'm going to go pretty quickly. Firstly, thank you very much to the panel for a great segue into Genie Yusto. So, gentlemen, your comments around neobanking, digital banking, and how you feel that there's a wonderful opportunity right now for fintech to jump into that space and be able to provide a fantastic set of tools for the B2B digital banking. Well, here we are, Genie Yusto. So thanks very much for the segue. And so what is Genie Yusto? So Genie Yusto is a payment and a technology enabler. We are a software house, of course, but we don't go to market talking about being a software house. This day and age, nobody wants to buy software. So we call ourselves a technology enabler. We deal with banks, credit unions, payment providers, remittance companies, and e-money issuers on an international scale. So what this means is that we know exactly who our customers are. We only sell to regulated entities, could be pretty much any country around the world. One of the exciting things about the transactional business, about the payments business, is that it's pretty much ubiquitous, and it operates in almost the same way in every country in the world. So some regulation might be slightly different from one country to another, but at the end of the day, a payment is a payment is a payment. And so it means that we can deploy this technology very rapidly, pretty much anywhere in the world. We have customers right now in 12 countries. So we're not really a startup. I would say we're early stage. Let's move on a little bit. So what is it that we bring to the market? A couple of years ago, when this product was first brought out to the market to launch neobanking, digital banking, we talked a lot about core banking. But we quickly understood that this was a red ocean. We were up against many other players offering core banking. But the real strength of our product was the payments orchestration. So we started then pivoting into payments orchestration, and that gave us a lot of traction. We won new customers, we won new investors, and this really resonated very well with people. But now we see a lot of people jumping into payments orchestration, and so we've pivoted slightly even further. And there's a reason for that, because as these gentlemen were saying, crypto is on the rise. Our customers who are in the traditional banking space are asking us every day, what do we do about crypto? Is there something that you could bring? What kind of products and services could we offer in crypto to complement what we're doing? So we now call it a digital economy management suite. It's an all-in-one suite of tools that can enable either a neobank or a traditional bank or an EMI to really offer a very broad range of services on the front end with all the back-end management all the way to the front end of a super app type experience, as these gentlemen were earlier talking about. So payment services, payment aggregation, transferring funds, international remittance, checking my balances, buying, applying for loans, whatever it might be, can all be done through the system and fully managed. No? So I think there's been a lot of talk today about some of the current challenges in the global economies. They were just mentioned a few moments ago. There's a war going on. Interest rates are now finally rising, which is creating difficulties. Crypto coming along. The regulators around the world wondering what kind of regulations should we write. Some countries are further ahead in regulation. Some haven't even started thinking about regulation. Some have made some regulation that perhaps is not appropriate yet. It's going to take time for all of that regulation to mature. And so there's a lot of political headwind, economic headwind, tremendous challenges for financial institutions. One of the biggest challenges that they face, and we deal with this a lot, is that their technology costs are going through the roof. They're paying way too much money to incumbents for aging technologies that are inflexible, dinosaur systems that are just hugely costly to manage and maintain. So what are the 4 key challenges that our customers face? Compliance, agility, relevance, and efficiency. And these are the things that we solve. How do we solve it? We solve it with the Go Digital Economy Management Suite. This is a very powerful suite of tools. It's a mature product which has been 20 years in the making. We have enormous experience in the payments and banking industry across Europe, UK, Southeast Asia. We've now opened customers in the US, and we're expanding every day, winning new customers every day. So we deal with the front end, mobile, internet banking, very powerful apps for merchants, creating a complete ecosystem for people to use. We, of course, have core banking, managing deposits. This is great for neobanks, no? We have all of the compliance piece, as we talked about earlier on this panel, EKYC, AML screening, fraud monitoring, transaction monitoring, everything that the institution needs to successfully run a payments transactional business. So this could be an EMI, or it could be a bank that we layer this in right on top of their existing core banking. So I've got 2.5 minutes remaining, so I've got to do this really quickly. So powerful rules management engine. This is the key to what we provide. So this is not a monolithic software. This is microservices, can be deployed in any cloud that the customer prefers. We are an AWS partner, but it could be Azure, it could be DigitalOcean, it depends where they want to put it, right? And we can now serve in a modular manner any and all of the modules that we have, and then plug them in via the API Connect Hub into whatever systems they might be using, okay? The reason we can maintain compliance very quickly is because the whole system is based on a very powerful rules management engine. So we can go in and rewrite rules literally within hours, test them on a test platform, publish to their live environment, and keep the institution compliant, help them to launch new products, new services, whatever it might be, in a very short turnaround time. This is really a game changer for many institutions that we work with now. Agility, I talked about the complexity and cost of these huge tech stacks that they're running. We can bring this to the table, plug it in on top of their existing core banking. In many cases, we talk to institutions who are saying, we need to change our core banking. And in many times I'll say, you know what, keep your core banking. I'll layer this in on top. I'll extend the life of your core banking. You don't have to go through that enormously painful multi-year project, millions of dollars to change out core banking, very high risk. We'll keep the existing core banking, use it more like a data store, and we'll give them all of this agility on top of that. So we are taking small rural banks in the Philippines, in UK and other places, and turning them into neobanks, allowing them to now onboard customers remotely, grow their business dramatically, add payments through mobile, et cetera, et cetera. So literally taking traditional banks, turning them into digital banks. Remaining relevant with their customers. This is so important. The big players that are coming into the market with EMI plays, the Alipays of the world, in the Philippines, GCash and Paymaya you may know of. There are companies like this around the world who are squeezing the small banks out, and people are moving into these agile mobile payment solutions. So we want to help these institutions remain relevant by bringing products. Okay, time is up, it says. Let me show you the numbers very, very quickly. So by the end of 2022, we will be doubling our 2021 revenues. We're looking at $4 million in revenue this year. We are launching our raise now, and we're doing a pre-Series B. The main strategy is to launch ourselves into the US market. We have strong revenue. We will be cash flow positive by the end of the year. I have about 40 months of runway, so we're not really worried about the cash position, but we want to accelerate growth into the US market. There are over 10,000 community banks and credit unions in the US that need our technology. So there's a huge opportunity there. Thank you very much for listening. We've got lots and lots more information for you. If you come and visit us at the stand there, or if you'd like to set a meeting with us later on, We can get you into the data room. We can show you all the statistics. We can show you the apps. We can give you the live demos. And we'll be very, very excited to meet with you. So I'm Matthew. Thank you very much for your time today. Sorry I went over by about 1 minute. Bye-bye, everybody.
Thank you very much, Matthew. Up next, we've got Alberto and Birgit from WeAsia, CEO and COO.
Good afternoon, everyone. Welcome to WeAsia. When you're thinking of Indonesia, you're probably thinking of this, holidays. But for many local Indonesians, the world looks more like that. There are 135 million un- and underbanked. So not only is the scenery very different than the beachfront, it's also their financial standing. Our mission is to create financial inclusion. Financial inclusion is a global problem. It affects about 1 billion people globally, and Indonesia is one of the top markets in this space. Already today, we have traction in India. Our digital operating system is serving 50 rural banks. We have 4.2 million users. We are generating revenues, and we're making a tiny cash flow surplus. Our business model is B2B for C. And so the question is now, why would the Bs work with us? And that is because we're solving 2 pain points. The first one, it can best be visualized by this picture. Many of the 125,000 rural banks in Indonesia work manually. They don't have a system. They cannot offer a digital user experience to their 40 million members. And that is the reason why we provide our technology free of charge. That will allow us to get quick land grab. And now you're probably asking how we make money, which brings me to the second point. Rural banks, as you might be aware of, cannot do fractional reserve banking, and therefore they're constrained in terms of liquidity. In one case, that means they're at risk of becoming insolvent if they cannot serve withdrawal demands on the deposit side. And in the second case, they cannot grow their loan book unless they have more deposits. Now, what does that have to do with financial inclusion is Indonesia has a very, very high net interest margin in the region. And actually, rural banks are one of the best options for people to get reasonably affordable credit. But without liquidity, they end up with the loan sharks and peer-to-peer lenders and end up paying 20–30%. Now, what we now do is, and that's sort of like the magic sauce, if you will, after digitalizing the banks, we have data points. What we're now doing is we're going to the international investor community with backed up information, and we can now basically facilitate sustainable social impact investments into the rural banking ecosystem in Indonesia, strengthening the balance sheets, and therefore actually positively impact financial inclusion. With that said, I would like to hand over to my colleague Birgit. She will share a few more information on what else we're up to.
Hello, my name is Birgit, and let's start with the people. It's all about the people. I think we're all in the people business ultimately because people are putting ideas into action. And if they don't know how to execute and what they do, then any business will fail. So we have an international, experienced, diverse team from across the globe with complementary, distinctive skills. It's not our first rodeo, so we have some experience in running businesses and scaling businesses in the startup scene. And every team also needs a solid foundation. So operational excellence is the next building block that any company and legal framework should be built on. So we have our holding company in the Lion City here in Singapore, and we have 2 operating subsidiaries, one in India and one in Indonesia, where we're now launching. In India, we are already operational with 4 million users. Our traction in Indonesia today, our headquarters is in Bali, and we have a local business development team of senior people from within the rural bank industry. So we have strong network strength in the ecosystem of the rural banks and also towards the regulatory oversight body. We have round about 50 LOIs with rural banks signed already to date, and the list is growing every week, basically. Our team is very active and very successful in doing that. Our ambition is big. It's all about the passion and the ambition, and it doesn't stop in Indonesia. It goes way beyond Indonesia. Philippines, Thailand, and Vietnam have similar social demographics. We are already operational in India, and we continue to grow in India and in Indonesia. But if we go across the Indian Ocean into Africa, and I am from Africa, then we find the same problems in Africa and obviously in South America. So there's lots to do, as Hurston was saying earlier, and we just started with it here in Southeast Asia. Nothing more to add. We have 4 million users now. We are aiming for 30 million users in 3 years from now. And we invite every one of you to come to our stand, learn more about our plan, and imagine how it would be if we include all these people that are currently being underserved. They are not taking part in the economy with a super app, or call it a mega app, and they can take part in the normal life and economy cycle, which they can't today. So thank you very much for your time, and that's it.
Thank you very much, Alberto and Birgit. Up next, we have a presentation from Startup Bootcamp with Beth Henderson.
Hello, good afternoon everybody. My name is Beth Henderson and I am the Singapore Program Director for Startup Bootcamp, and I'm here to talk to you today about our new sustainable fintech fund that we are raising for $5 million. But first, you might be wondering, what does sustainable fintech actually mean? So back in 2019, Startup Bootcamp made a decision across our company that we were going to align all of our startup accelerator programs to the Sustainable Development Goals. Now, we don't often hear the word sustainability in relation to the finance industry. It's really more when you talk about energy transition or circular economy. But, yes. So, sorry, I just lost my train of thought. Now, sustainable finance is really important in a country like Singapore, and that's because it's in the top 10 countries worldwide for GDP per capita. And it's really important because the decision of where we invest, bank and manage our money has one of the biggest potentials to impact our transition to a more sustainable future. Now, the concept of sustainable finance has been floating around since about 2016, and it became popular in 2018 when a series of reports were released. One of our favourites is from the Boston Consulting Group. Now, their headline was that they estimated in 2018 that there were already $30 trillion worth of funds earmarked for investment into sustainable finance projects. Now, they also estimated that over the following 5 years, that the size of the sustainable fintech industry would increase to $30 trillion. Now, that's a huge change compared seeing that at the time in 2018 that the estimated industry size was $50 to $100 billion. So with this immense industry change happening, we had to ask ourselves what was happening in the startup space and what opportunities lay there. So at Startup Bootcamp, every year we assess between 20 to 30,000 startups in the fintech space, and we choose the top 10 to come into our accelerator program. Every year we also assess the emerging trends in the space, and in the last 3 years, which we've been running a fintech program for, we've seen a number of changing trends. Now, ignoring that top line for just a moment, the biggest trends that we saw in the past 3 years were in asset and wealth management, future of finance, which includes crypto, blockchain, and Web3, financial health and well-being, Insurtech, and banking. We went back and analysed the data again, and we pulled out keywords from the Sustainable Development Goals and assessed how many startups were we seeing that were aligning themselves in this area and aligning themselves into sustainable finance. Now, what we saw was an 800% increase in startups aligning themselves in this space over the past 3 years. So we knew that there was a huge opportunity there, and that's why we are now launching our new fintech program over the next 3 years that is purely focused on sustainable fintech. Now, this will be backed by our Sustainable Fintech Fund of $5 million, and we will be accelerating 10 startups per year in this space over the next 3 years. Now, to do this, we looked at the the full set of Sustainable Development Goals, and we chose the top 8 that we felt had the biggest potential to impact the finance industry or be impacted by the finance industry. We divided this into 3 key areas of financial well-being and inclusion, sustainable business practices and communities, and financing sustainable growth and resilience. Now, it's not just a hypothesis that we think this is a huge opportunity for startups, but we know it's true because in the last year of our most recent fintech program, we aligned our scouting themes into these areas and selected the 10 startups for the cohort that did align into these 3 areas. And what we found was our investments into that portfolio of startups was the fastest growing portfolio that we've seen in the history of our fintech program. So a little bit more about the difference between investing into an accelerator fund versus a regular fund. When you invest into a regular fund, you put in $1 of cash, you get back $1 of equity. It's a little bit different for an accelerator fund because we work very intensely with the startups over a 3-month period. So we work with these founders every day. We have a network of corporate partners that we help the startups to get POC and pilot opportunities with. We also help them with their future fundraising rounds. So when you take on these, when you consider these extra services that we're adding to the startups, for every $1 of cash that we put into the startups, we are also investing or helping them with these extra services, so we're actually getting back $3 worth of equity straight away. Now, if you haven't heard of Startup Bootcamp, we're the world's largest network of industry-focused startup accelerator programs. We started back in 2010 in Amsterdam. We've since grown to a number of offices all around the world. Our Australian office started in 2017, and I have been here in Singapore for the last year, growing our presence here. We've accelerated 1,000 or over 1,000 startups worldwide. The number we're most proud of is that second number there. 76% of our startup alumni are still active, which is really impressive when you consider the general statistic of only 1 in 10 startups succeeding. Now, this we're able to almost 8x this through our proprietary process of keeping founders focused and engaged, not only through the 3-month accelerator program, but also well beyond that through our alumni engagement process as well. Not only do we work with startups, but we work with corporate partners in each of the industries that we align in. For our most recent fintech program out of Australia, we had the pleasure of working with Bupa, Australian Super, NAB, Capgemini, EY, and Deloitte, and various others. From our global fintech programs out of Europe, we also work with all of the companies you see here on screen because they know our process works and they want opportunities that are going to work with startups that result in tangible outcomes for the future of their business. A little bit about our current fintech portfolio. So as I said, we've been running our fintech program out of the Australian office for the last 3 years. It is a global program, so we do scout and invest in startups all around the world in all the countries you see on screen here, including 2 out of Singapore, and even last year, our first one from Fiji. And there's a lot of interesting things happening in the fintech space in the South Pacific too. So the portfolio is currently at 27 companies. It's valued at 190 million Australian dollars. And some of our global highlights out of the Europe-based fintech portfolio was our biggest exit ever was $300 million. And our biggest valued company is currently Kuda, which is an African neobank. Their last round valued them at $500 million, or euros, sorry. So a little bit about how the investment works, or how investing into this works. We know that maybe it might be, a few people in the audience might be new to investing in startups, so we've really tried to make it as easy as possible. The minimum investment size is $25,000. Australian dollars. So for that amount, you are getting equity access to a portfolio of 30 startups over a period of 3 years. We are currently over 70% subscribed to the minimum amount that allows us to launch the first year of the program and get going, but we are looking for a total of $5 million. So if you think that sustainable fintech is where we should be investing our money for a more sustainable future, please come and talk to me afterwards. I'd love to speak with you. Thank you. My name is Beth Henderson. Thanks for listening.
Thank you very much, Beth. Up next, we've got Simon Odell, co-founder and CEO of Insurtech Gateway, Australia.
All good, thanks, mate. Thank you very much. I'll be echoing the sentiment that Insurtech or insurance is quite hard to break into. I really enjoyed the panel discussion. Thank you for that. We launched a venture capital fund targeted at seed and Series A stage out of the UK, and we soon learned that it wasn't enough. Strategic capital is not enough for the insurance market given the barriers to entry. So we launched a world first, an incubator model that's regulated and independent to help founders break into the market. So we attract genius founders to solve big problems, and in doing so, they are reinventing the insurance industry. In 30 seconds, founders struggle to break into the $6 trillion insurance market due to startup killing and barriers to entry. Insurtech Gateway is Australia's first regulated and independent startup incubator, unlocking insurance to global founders. From an annual pipeline of 150 qualified pitch decks we see per year, we identify the 2 to 3 who are ambitious enough to solve some of our biggest challenges we face today. We provide cash and services to help these founders break into the insurance market, build an MVP, and achieve product market fit. In exchange for that cash and services, we receive equity. As the world's challenges increase, serial founders are flocking to Gateway to launch their ideas, and we're looking for strategic partners and investment to continue the journey. In a bit more detail, the problems, the industry, as we know, is highly regulated. Founders often have difficulty launching MVPs. They often lack the credibility needed to achieve strategic insurance partnerships. They have operational and compliance difficulties, and this leads to high failure rates. We provide licensing in 2 weeks, not 52 weeks. We provide access to global insurance partners, investment capital from our own balance sheet at a pre-seed stage, and a venture building platform, which is essentially a bespoke insurance startup playbook surrounded by mentors who have been there and done that. We have happy founders. This is Gil Sneer, CEO and founder of Audit Cover. I'll read some of his quotes. I think it's a good case study. So lean startup methods are not enough to break into Insurtech. 3 primary reasons. 1, securing an insurer to take on the risk capital for an unproven product and team. 2, you need to be authorised and regulated to sell insurance. 3, the user experience, product and service needs to be compliant, as do our operations. I would hate to think how long it would have taken us to launch, at least 12 months. The solution for us had to be Gateway. So as you can see, it was fairly quick for them to get to the seed stage, and now they're chasing Series A metrics in a short turnaround. We only started 2 years ago. The red line here shows the capital, the cash we've deployed, and the blue line is our #1 performance metric, which is the portfolio equity value that we accrete and gain on our balance sheet. As you can see from this pie chart in the red, the majority of the value we gain is from our sweat equity, so it's from our services that we provide as opposed to the cash element. So where are we now? We launched only a couple of years ago, and we have 5 portfolio companies, and the portfolio equity value is certainly going in the right direction. Where are we headed? As a proxy, I've overlaid the UK incubator portfolio who started a few years prior to us in 2017. They have 3 portfolio companies valued at over $200 million now. To help attract the best founders and to de-risk the post-incubation journey to ensure they continue to scale, we have 2, I guess, follow-on services. One is the Gateway Fund that I mentioned. As portfolio companies came out of the incubator and achieve product market fit, the fund sits there to invest in seed Series A. And the LPs in that fund are strategic, so reinsurers and insurers from around the world to help with scaling. Also, to aid replication in new markets is our global incubator. So we have one in Amsterdam, London, Australia, and soon to be the US, and hopefully Singapore, which is why we're here, looking for strategic partners. Just briefly looking at the bar chart here, Insurtech is one of the fastest and exciting growing places in venture capital right now. Last year's investment, $15.8 billion, was double the preceding year, 2020. And per the pie chart there, it's just a drop in the ocean compared to the size of the insurance industry. So I'd like to pull back the curtain a little bit on how we look at Insurtech from our deal flow room or investment committee, just briefly. So we look at it, the insurance market across 3 segments or 3 horizons. Horizon 1 was tech fixes insurance. So that's essentially doing insurance, but a little bit better using technology. An example of that in our portfolio is Cobra, a pay-per-kilometre motor vehicle insurance offering. Horizon 2, if you think about, Horizon 2 is essentially insurance fixing tech. So if you think about decentralized platforms like blockchain, crypto, shared economies, gig economy, and so on, bringing Lloyd's of London and other A-grade insurance risk capital to these decentralized platforms brings to them resilience, legitimacy, and strength, and helps enable them to thrive. And we really like that space. An example of a portfolio company in that space, CoinCover, who walked into our office with an idea to insure crypto assets. I think it was late 2018, and they're now insuring over $1 billion in crypto assets. Horizon 3 is quite exciting, almost altruistic, a little bit ESG, tech and insurance fix world problems. So we're really focused on that area as well. So an example from the UK portfolio is Kita, the world's first insurer of carbon credits. So they help remove the carbon delivery risk from the carbon trading market. So just wrapping up, we feel like we're getting really good pull from the market. Between us and the UK, we have a portfolio of 27 companies. We feel that word has got out that the insurance market is open to disruptors now. Between our incubators around the world and the fund, we're the most prolific backer of Insurtechs. We have inbound inquiries daily from climate scientists, astrophysicists, lots of special founders, successful founders wanting to break into the insurance market, and they see our platform as the means by which to achieve that. So we're quite excited and we'd love to back more. This is our team. So it's a mix of insurance experience. So Robert Lumley there from the global Lumley insurance business. His grandfather sailed on a ship to Australia from the UK and brought Lloyd's of London insurance to Australia for the first time. So a lot of strong insurance history, pedigree there, as well as successful startup founders. Thank you for having us. We'd love to have a chat.
Great. Thank you very much, Simon. So up next, we've got Andy Glenn, founder and managing director of Aviator Capital.
Good afternoon, everybody. Thanks for having me. The name might sound a little bit confusing. I'll come to the background behind that in a second, but primarily Aviator Capital is a property syndicator, and today the hottest topic of conversation really for most of my clients is interest rates and inflation and how we protect against that to make sure our investments keep performing. So I'm going to address commercial property versus or as a hedge against inflation. So we all know what inflation is essentially we need inflation in the economy. It's how the central banks manage the economy. Unfortunately, they've only got one tool to do that, which is interest rates and changing the cost of debt, essentially. Most central banks have a mandate or a band of inflation that they're trying to operate or maintain within. And at the moment, when you look at inflation in the US, it just dropped from 9.1% down to 8.5%. Singapore's running at 6.7%. Australia's running at 6.1%. The UK are forecasting a peak of 13% inflation. So it's a huge impact on the way your investment might perform and how you can mitigate risk. So it needs to be controlled. Central banks have made it very clear at the moment that they are willing to hurt the economy and cause an intentional recession to control inflation. So they're putting inflation well ahead of economic growth and prosperity at this point. I won't go into the short-term nature, perhaps, of this as a supply disruption event or why we think the inflation is there, but I think it's pretty important to understand that most people are not used to this. Interest rates haven't risen for around 12 years, which is shortly post-GFC. So if you think about that, we've been until just recently in a continually falling inflationary environment, which means if you want a manager that's had at least 5 years experience in a rising interest rate environment, that person's probably nearly 40 years old. That's quite astounding, isn't it? We think this is a normal cycle. A cash rate cycle would be a 4 to 5 year cycle, but really it's been 12 years before anyone has seen an interest rate rise. So are we prepared for it? Aviator Capital primarily is we have some equities funds and a mortgage fund, but primarily we're a commercial property syndicator. And so the inflationary effect on our investment is of paramount importance. We have 10 single asset closed-end unlisted property trusts at the moment, which is about 250 million Australian in assets, and all of our funds return a cash rate net of fees of about 8 to 12% per annum, paid monthly. And so we closely monitor inflation and interest rates because we need to manage that risk and that debt. Where did Aviator come from? I mean, you see a lot of photos of planes. It comes from my background, which was as an Australian fighter pilot many years ago. And people often ask, how did you go from fighter flying into commercial property? That seems like bizarrely different, but actually the risk decision matrix that you make all day as a fighter pilot translates really nicely into financial risk management, and I'm very passionate about it. If you want to come and have a chat about fighter stuff, you can do that as well afterwards. All right, so why does inflation matter in commercial property? Well, commercial property valuation is really a long-term stream of stable, reliable income. That requires good tenants, it requires good debt policy, it requires good leasing activity and sound management. But if you think about inflation, if you're running at 3% inflation and your income is fixed, then next year you're only getting 97 cents in the dollar. If it's 10 or 9% in the US or 13% in the UK, that is a massive hit to your real purchase power that you're getting out of that stable income. But it's not all doom and gloom. How do we manage it? Built into the leases is normally a inflation review or a fixed annual review. So if it's in the last 10, 12 years when interest rates were falling, the fixed annual increases were gold. We're getting 2, 3, 4% fixed when inflation was running at essentially zero. At the moment, when we're renegotiating leases, you can see a lot of people pegging their annual increases to CPI. And I'll come back to that in a minute, because that's one of the real ways that commercial property can hedge against inflation. The other thing that's important to note is the different type of lease structure. So if you've got a gross lease where the landlord pays all the outgoings, then you're at risk of inflation creeping into all of your service contracts and your operating expenses, which you have to bear, not the tenant. But if it's a net lease or a triple net lease, the tenant takes on the risk of inflation. So if you can structure leases that way, then you can protect yourself against that inflation. As an example, you might have a tenant that is paying $500,000 a year in rent. It's a good tenant. They might have a fixed annual increase of 3%, or they might have an increase of 7%, depending on which one is if inflation's running at 7%. As I said, Singapore is 6.7, Australia is 6.1 at the moment nationally. So that can make a big difference to your operating income. So if it's a 3% increase, then obviously your rent goes up $15,000 a year. If it's a 7% increase, your rent goes up $35,000 a year, which makes a huge difference to your net operating income. So in an inflationary environment, if you look at listed equities, their cost of debt goes up, their profits come down, they start having to retrench people, future PE ratios get hammered, and the share price takes a hit. So they're very, very sensitive to that, where commercial property actually has an inbuilt hedge against this inflation. And the other important thing to remember is that it's the capitalisation of that net operating income that goes to valuation. So if the income goes up $35,000, then the actual value of the property, assuming the cap rate stays the same, also went up a significant amount. And in this example, on a 6% cap rate, then the value of that tenancy went up $583,000. So it's a great way to mitigate risk in an inflationary environment because some of that is built into the mechanisms we use every day. All right, the other important thing to remember is we're not talking about a one-year thing. Most of the leases that we do, 5, 7, 10 years, even smaller stuff would be a minimum of 3 years in a normal case. So it's inflation year on year on year. If you were being really clever, you would say it's a minimum of 3% fixed annual increase or CPI, whichever is higher. So you cover yourself on both sides with a ratchet clause on the downside. But the real key here is your ability to mitigate inflation is going to be dependent on your experience and how you structure those leases, how you structure your debt, whether you use fixed or hedge or swaps to control that risk and to preserve that operating income. Here's an example of how we use this in practice. This is our 10th fund, which launched recently. It's a 5.5-star asset in Darwin, Australia. It's 100% leased to state and federal government. It's got a 7.7-year WALE. Government always pay their rent in a recession, so we like that. And the leases are pegged to Darwin CPI, which traditionally runs slightly higher than national average in Australia because of the cost of transportation to get to the territory, whether that be ship or road or rail. So while we're in due diligence, inflation for the June quarter came out and the rents went up 6.6%. That's about $150,000, which we hadn't paid for. But we were forecasting that to occur from our due diligence. The real value to that is that increase is about $1.8 million. So out of the $15 million in equity we raised for this particular asset, they've already made 10% on day one. We haven't even settled on the property. And that's an example of how that hedge against inflation can work. So we've got secure long-term tenants, we've got a long lease, we don't think they can go anywhere, and we're already making money on the upside because of inflation because we're using it to work for us instead. The capital raise on this fund was $15 million, and I would like to say that we think we got it right because the raise was done in a day from our existing investor base. So, I think if you get the model right, if you get the product right, then the investors respond to that well and speak with their money. So, as the panel said, cash is king. That's how we're going to protect against inflation and continue to deliver value for our investors. My time's up. Thank you very much for your attention. If you'd like to talk about commercial property or opportunities that are coming up, then please come and see Aviator Capital out in the main area. Thank you.
Thank you very much, Andy. Up next, we've got Dean Fraser, founder and CEO of Brickfloor.
Welcome everybody, my name is Dean Fraser, I'm the founder and CEO of Brickfloor. The opportunity today is to invest into the world's first smart residential property fund manager based in Australia. Owning property in Australia is a great Australian dream, like it is for many Singaporeans. It brings with you financial security. In Australia, the largest wealth creator for any one person on average is typically their home, representing 51% of their net equity. A home also brings emotional security. Your home is your castle. Australians have over $9 trillion of capital invested into the residential property market. To give you some context, that's 3 times larger than all companies listed on the ASX, or about 9 times greater than all companies listed on the Singapore Exchange. But property ownership in Australia, like around the world, can also be an absolute nightmare. If you're saving for a first home deposit, it takes over 9 years to save for your first home, which is ridiculous. If you're looking to sell your home, selling a home is one of life's most stressful events, up there with death and divorce. And if you're looking to upsize or downsize, the decision around whether you sell your current home first and then do you buy your next one, or do you buy first and then sell, is a perennial dilemma. Brickfloor has created 2 unique market award-winning products that solve home selling and saving stress, and which create a high-performing residential property fund at the same time. We've built a home deposit saver app that allows a millennial or a Zoomer or a young person to get on the property ladder much faster by investing into a portfolio of great Aussie homes. We've also built a market price guarantee product and launched that into market. It's an upfront commitment on your home as a home seller that's guaranteed for the length of your sale campaign, giving you certainty and peace of mind when you're selling your home. The market price guarantee product provides homes or properties into our smart property fund, and the home deposit saver app, as well as other investors, provide capital or funds into that smart property fund, building a really quite unique ecosystem. The home deposit saver app, the positioning for that is about getting on the property ladder in 9 minutes, not 9 years. The millennial can invest into a portfolio of great Aussie homes. There are no minimums, and they can access their funds as and when they want to. There are 5 million millennials in Australia struggling to get onto the property ladder. 80% of those, or 4 million, are actively saving for their first home deposit and have on average $33,000 of cash at bank earmarked for their first home deposit. So that's $130 billion of capital proactively seeking early home exposure that we're looking to facilitate through our home deposit saver app. Our market price guarantee is a market price for your home before you even list. Our offer is based on 50 data points of smart information. Our offers are anchored to the bottom end of a valuation range for the home seller's home. So we're buying homes into our smart residential property fund at conservative prices. We typically buy 1 in 3 homes at those conservative prices, with the other 2 out of 3 homes selling to a third party for above what we've guaranteed. We charge a 2% fee on the amount that we've guaranteed to the home seller. That flows into the property fund when the property fund buys the home. When the home sells to a third party for above what we've guaranteed, then that 2% fee is split between the smart property fund and the Brickfloor PropTech fund manager. We've had significant market traction since launching into market in February 2019. We put out over $170 million worth of offers into market. We converted 23% of serious sellers into customers, so we know we're delivering value for home seller customers through providing peace of mind. We make $24,000 revenue per customer, so we have really strong unit economics, and we know that it costs us less than $1,000 to acquire that customer, so our gross margin or our contribution per customer is 23,000 Aussie dollars, and now we're looking to scale that revenue model into the market with some really big channel partners that I'll discuss. We've received 5 National Property Technology Awards in Australia, Best PropTech Platform of the Year last year, Most Innovative PropTech of the Year, both this year and last year. So really strong national recognition in Australia. And we have some huge channel partner engagement with Westpac, one of the big 4 banks in Australia, REA, the biggest property portal in Australia, Stockland and Connective. We're currently looking to launch a new home loan category in market in Australia, where we'll combine our market price guarantee product with a competitive home loan that Westpac will provide, effectively a buy now, sell later home loan powered by Brickfloor. What we discovered in market was that 90% of the market would prefer to buy first if it was safe to do so, and we make it safe through our market price guarantee product. Only 25% of the market will actually take the risk and buy first in Australia. They go through a really poor experience where they're stressed around whether their current home will sell for the right price. We remove that stress for that 25% of the market, and the other 65% of the market, we enable them to buy first and to meet their goals. The opportunity with Westpac also will let us acquire customers for nil cost to acquire. They'll be providing us with customers for no cost to Brickfloor. The Brickfloor Smart Property Fund has outperformed the general property market in Australia by 20%. So the market in Australia has had a really good run over the last couple of years, but we've even had a better run than market to the tune of 20%, so delivering real alpha. We call ourselves a smart property fund because we buy homes at smart prices, so we're picking up homes into our property fund at reserve prices, effectively a price that works for the home seller, but also which works really well for our investors into our smart property fund. We're buying great quality homes in great areas, likely to generate a stronger capital growth than the norm. We use smart data, 50 data points of information, to value and make an offer on a home seller's home. We have a patent around a whole entire business model, and uniquely we have 3 streams of income flowing into that fund: rental returns and capital growth, which most property investors would receive, but also the 2% fee that we charge to the home seller as a kicker and comes into the revenue model of that property fund. We have smart leverage in our property fund, and we also have an impact focus through our fund where we wish to allocate 20% of the homes in our fund to affordable rentals for those in need. But the opportunity today is not about investing into the smart property fund, it's about investing into Brickfloor, the award-winning prop tech business in Australia. It has 5 revenue streams very uniquely: management fees of 1.25% of assets under management, performance fee, we charge 20% of any excess returns above the core logic index. The 2% market price guarantee fee that I mentioned flows into the fund manager when the home is sold to a third party. And the app platform fees, we charge $30 per annum per user. So on 500,000 users, which we think is very achievable, we're generating an extra $15 million of revenue into the fund manager business model. There's also a really big opportunity to charge loan origination fees for some of these banking partners we're working with. We're securing effectively the customer into the top of the funnel through our product innovation, the buy now sell later home loan product, which is made possible because of the market price guarantees. So we think there's a great opportunity to charge the typical 60 basis points up front and 20 basis points trailing commission fees for loan origination. The Brickfloor Fund Manager is a $50 million per annum revenue opportunity with 70% EBIT margins. Our 5-year targets are $2.6 billion of funds under management, i.e. properties owned. That represents 1,800 properties owned in our fund, a $350 million business valuation based on 70% EBIT on $50 million of revenue and a 10x multiple. And we're looking to deliver 10 times money multiple for investors in our Series B raising. The $2.6 billion of funds under management is actually quite small relative to the $130 billion of millennial capital proactively seeking early home exposure in the market. So it's basically 2% of that. We think the model could be much, much bigger in Australia. We can see a pathway, it sounds huge, and it is, to a $400 million revenue opportunity through our SOM, which would effectively be $23 billion of properties into our smart property fund, which is achievable given the size of the market in Australia, where roughly 450,000 homes sell every year. Very privileged to work with a great leadership team. Matthew Turner, our head of property, ex-Jones Lang LaSalle and ex-NAB. Troy McKenna, our CMO, ex-Mars, ex-Asahi. Matthew Quinn was a Stockland CEO for 13 years in Australia, so very highly regarded. Saul Eastlake, ex-ANZ Bank chief economist, very well known in Australia. And Ken Atchison, a prolific asset consultant in Melbourne. Almost done. We're raising $5 million in our Series B capital raising at a $30 to $40 million pre-money valuation, subject to investor feedback. We've raised $6 million previously in a Series A back in November 18 at a $21 million valuation. That was supported by some major investors, including a Big Four bank. We're targeting 10 times money return for investors based on our 5-year projections, and we're looking to use the capital basically to expand and accelerate headcount growth, as well as some marketing and product development. So that's it. Brickfloor raising $5 million, award-winning prop tech, proven market traction, unique and patented model, large-scale partners, significant social impact, and 10 times money potential. Thank you very much.
Thank you very much, Dean. Up next, we've got Duncan Anderson, Executive Director and CTO of Open.
Thank you. Can you hear me fine? Open Negotiation is a digital offer management solution for the real estate sector. What does that mean? If you think through the life cycle of buying a home, a buyer's journey would start with finding a property. They would typically look at an online portal to find that property. They would identify a property they like, they go visit a home open, and they meet an agent. And at that particular point, they become quite serious about their buying journey. I'm going to walk through a couple of slides here that are in the slide deck. They are not the entire slide deck. The slide deck is on the Chris platform. You can read this afterwards. So this will be nice, short, sharp, crisp, hopefully, crisp being the operative word. So that buyer going through the home open journey, or that home buying journey, goes to the home open and they decide to place an offer. Up until that point, everything they've done except the visit to that home is digital. So at this particular juncture, most buyers actually remove themselves from the digital buying experience and they go into a real, tangible experience, including, if they're interested, they place an offer, they write it down on a piece of paper. Once that offer is presented and they are selected as the buyer, that process goes back into a digital environment where the transaction management process works, including all the way through to settlement. So interestingly, there is a piece of this puzzle where Open fits, and it's that offer management space, where we digitize that offer management process. And by doing so, we create a range of opportunities to solve some key problems. So what is the core problem that we were trying to solve? Essentially, it boils down to most properties globally are sold using a practice called offer and acceptance or private treaty. It's called different things around the world, but essentially it is, I write down on a piece of paper what my offer is. I tell the vendor what my terms are, including the price, and I submit it. The reason why that particular method is predominant globally is because it's discreet. You're very private. You're typically making these offers in the comfort of your own lounge room. You've got your spouse next to you. You're talking to your advisor. It's also something that's very flexible. If I want 90-day settlement versus 21-day settlement, if I'm subject to finance, if I would like that chandelier or the kids' playset in the backyard, I have the ability as a buyer to define what those terms are. Its problem is lack of transparency. And typically what would happen is I'm a buyer, I walk in to meet an agent, and I say to the agent, how much do I need to pay to buy this property? The agent will typically tell you, look, price range between X and Y, I've got 3 other offers out here, can't tell you what they are, put your best price forward. The experience for most buyers at that point is, I don't believe the agent, I don't know they've got 3 other offers, and I put a price in. 2 things happen. Either I win the property, I immediately think, did I pay too much? Or worse, someone else wins the property and I find out what price it's sold for and I think, I would have paid that and more. So that lack of transparency has created an inefficient market in property, and that's what Open is looking to solve. And we do that by digitising the offer and publishing each buyer's offer online. So if you look at the screen in front of you, you'll see a bit of an example where an offer is placed. It's pretty hard to read there, but you'll see, all you see is a little paddle number and a dollar value. But the offer is placed, other buyers come in, they place offers until finally the property sells. So along that pathway, each buyer has had complete visibility over what price they need to pay to win, and they have complete control over the decision they need to make based on solid information. Likewise, a seller has complete control over the decision they need to make based on information not the agent is telling them, but the market is telling them. So why is this different to, say, a backyard auction, which is another form of selling real estate? Backyard auctions are fairly predominant in 2 cities in Australia, Sydney and Melbourne. They're not widely used around the world other than there. But a backyard auction typically is run in a process that doesn't have bespoke terms. So they're typically, here's a set of terms, it's cash unconditional, and the highest price always wins. If you're a buyer and you're going through that experience, it's typically uncomfortable. I don't like being in public where everyone can see exactly what price I'm prepared to offer for a property. That's why it's not popular globally. Open has essentially taken the best bits of auction, the transparency. It's kept agents central to the process. And so what that means is because the agents vet, they qualify every single buyer, all buyers operating through the platform can be confident that the other offers being placed on that platform are made by other legitimate buyers. It turns out that's the secret source of what Open has developed and the core reason why we're offered a patent or issued a patent in the United States for this process. Not only do we solve transparency, we really pitch this on the efficiency it delivers. So if you're an agent and you are dealing with 20 offers, this system will automatically collate those offers and present them back to the vendor for automatic choice. And lastly, we have a massive data opportunity, because not only are we capturing the level of data that tells you what a property sold for, we have a depth of market analytical capability here that understands what is the underlying support for that median price. How many buyers are there out there? What price point were they prepared to pull out? And that particular piece of data is highly valuable to property developers that want to understand what unmet demand looks like at different price points, to risk modelers in the banking sector, and a whole host of other individuals. So I'm going to go to this one here. There. So Open launched in 2017, and we have grown fairly rapidly. As you can see, this is just a July 21 to July 22 comparison. In the first 4 years of operation, we'd sold $2.72 billion worth of property through the platform in Australia. Just in the last year, that number has grown to $5.39 billion. So we are fairly advanced. We are dealing with about 4,000 agents across Australia. We have 100,000 users that have participated on the platform. Sorry, go back one. Little snapshot of our corporate environment. What you'll notice here is that, first of all, our ticker symbol, we are listed on the Australian Stock Exchange. We listed July last year. Ticker symbol is OPN. We listed at 20 cents. We're currently around about 17 cents. So despite the tech challenges in the global market, we've held up pretty strongly. We are very, very confident that the market has not yet factored in our global expansion and the work we're doing in North America. I'll explain that in a little bit. The other interesting point about this particular data set is that we have a lot of very, very sticky shareholders, including management and board, who are under escrow until July next year. And we have institutional investors that aren't selling. So we're a lightly traded stock. Not many people know about us. We're based in Perth, where you might not realise this, but we were the world's largest prison for 2 years. We couldn't travel anywhere. This is our very first outing to tell the world what we're doing. It's great. Our board is made up of very experienced governance individuals. So Wayne Zekulek, a lot of experience, Deutsche Bank on several boards as our chairman. Peter Gibbons is a founder, investment banking background. You can read our bios later, but governance is a key skill set within that group. Okay, we are expanding into North America. You've seen our growth in Australia. What's pulling us into North America is quite incredible. We didn't seek to enter that market. That market came and brought us in, and we were brought in by a group called Reach, an accelerator program. They are owned by Second Century Ventures, who is the venture arm of the National Association of Realtors in the US. Why they brought us into Canada and the United States has a lot to do with factors that are occurring there that are really driving the industry towards transparency. So Department of Justice in the US engaged in legal activity against the NAR and several large brokerage groups and MLSs. And in Canada, a massive movement has built through consumers demanding transparency to the political realm, where the budget handed down by Justin Trudeau a couple of months ago included a constraint or a restriction on the practice of what they call blind bidding. It's that opaqueness that you find in traditional real estate. So it's those events that caused the Canadian Real Estate Association to partner with Open, to pilot, integrate, and eventually we will roll out with them in Canada. Now, North America is massive. The opportunity is huge relative to Australia. In Australia, we have about 35,000 to 40,000 agents. In all of the United States, they have about 1.5 million. There's another 150-odd thousand in Canada. In the United States, they sell about 6.5 million properties a year. We sell around about 500,000 in Australia. So that opportunity is massive. We see a window of opportunity in front of us. We're going to take it. I believe my time is up. If you've got any questions, I'm available afterwards. Thank you.
Thank you, Duncan. Up next, we've got Derwin Seller from My Property Solutions, Sydney.
Hi everybody, my name's Derwin Seller and I'm the founder of My Property Solutions in Sydney. We're an established real estate business that focuses our activities in property management, and late in 2019 we decided to change a suburban real estate agency into something more appropriate for rapid scale improvement. Through that process we included a restructure of our personnel, our location and the technology in preparation for growth. We also innovated and formed a new business model. That business model needed to be able to consistently deliver service to our property owners and keep that consistency as the business grew. We also felt the business model needed to be designed around changes that were taking place through COVID-19, particularly in the Sydney rental market, and it needed to address some industry and legacy challenges that we face in real estate. The first of those being consistent recruitment. Property management's different to sales. It's very legalistic, it's very systems-based, so it requires a higher level of expertise, and that expertise is best trained into people rather than bought in and hopefully they're good at it. So we developed a system around that. We had to think about the legislative change that goes on in our market in particular, where governments continually introduce new rules. Most of those rules are favourable to tenancy, so we have to look at that and make sure our owners aren't suffering. We also had to think about the way rent is changing and the advantageous and the development of short-term rental accommodation, particularly in the city. Obviously, technology plays a role, as real estate, a traditional industry admittedly, but it is changing and technology offers productivity improvements there. I'd like to talk to you about our team because at the end of the day, we're delivering service and we need to have good people on board. Our CEO has been with the business since its inception at just over 15 years. Arisi and I have worked together under the restructure process to bring on board new key members to our team to help us expand our business. Sky Nichols was brought back in after working for us for a couple of years past and has now joined our team to head up our property management and short-term rental accommodation division. Onella Falvo, who's with us here today and is actually at the stand, or actually here, and not at the stand. She looks after our business development and also our organic growth by approaching our existing property owners and asking them to develop more business with us. Tristan James joined our business because we recognised the need to go heavily into the social media area. I myself have a background of over 20 years in real estate, and that does expand across retail, commercial, as well as residential property. And during that period, I've also taken part in the acquisition and sale of residential and real estate businesses. And that's the market I'd like to talk to you about first. We see an opportunity to grow our business by adding scale. We have excess capacity, and Rent Rolls, which is basically a licensed agent able to sell his parcel of rental property to another licensed agent, are coming on stream because markets have changed in terms of sales, and agents are now concentrating on, do I continue? It's not so easy to make a living in real estate as when markets are booming, or do I sell and move on? Rent rolls are an important income addition because they can be purchased without additional fixed costs. So we've got an existing office, we have existing infrastructure, we can simply add income to that infrastructure and grow our bottom line. There's a second market opportunity, and that's in short-term rental accommodation, or STRA as we call it in Sydney. And as you can see by the graphic, that's a huge market. The world's biggest hotel operators aren't at this stage at the size of Airbnb. And that simply means that short-term rental accommodation is here to stay, and this creates opportunity for property owners in Sydney to be able to hybrid their property. In other words, have it rented short-term rental for a while and then traditional rental to meet new legislative requirements. We want to work with investors to scale up the business. As we said, we've already identified 2 scale-up opportunities, and we've addressed the legacy challenges that limit the ability to scale the business into the future by having consistent recruitment. We're an existing business, so our current cash flows cover all our existing fixed costs, allowing investor capital to be utilised only to purchase new income. We're offering investors a 7% per annum return, paid monthly in arrears, with a 24-month investment period under a redeemable preference share. Further to that, investors have the opportunity at the end of the 2-year period to convert that investment to an apartment at wholesale price, giving them an option to enter the Australian property market at a price that's fixed today, and they could thereby have that capital gain in their pocket at the end of their investment period with MPSS. We're looking to raise $2 million to secure targeted acquisitions that we've entered contract into, and we expect to bring those acquisitions online in the next 3 months. So some of you are wondering, well, what does he mean by an apartment at wholesale price? We're talking about a development which will have a landmark position in a capital city with harbour and city views. It'll contain a 5-star hotel, and it'll also have a signature restaurant, alfresco dining, and a local neighbourhood supermarket contained within it, making it an ideal property to rent into the future. This is an example of a typical floor plan in that ability to convert. An apartment is over 130 square metres in size, that does include a car space, and is already fitted with an integrated kitchen, washing machine, and all the requirements needed to have it rented into the market. And we believe the net rent return will exceed 5% per annum, which is well above what is traditionally earned, which is around about 1 or 2% per annum. So our process for investment is very straightforward. Investors place their money in, they receive the redeemable preference share, they get their interest paid monthly in arrears. We collect more than $500,000 a month in rent, so we're able to pay their return before we pay ourselves. They redeem their preference share at the end of 2 years, get their capital back, or alternatively, if they're happy with what we're doing and they can see the value in the apartment that they've got at fixed purchase price, they can convert that right and own that apartment outright, depending on the initial amount of investment. I'm getting close to the end of my time, but I hope I've presented to you an opportunity that's fairly simple to understand, and at the end of the day, you get a chance to experience time with us, and if that time is productive, I think you might want to continue, and if it's not, we wish you all the best, and we're happy to redeem your share. So thank you for your time, and I look forward to saying hello to you at V&C at our stand next door. Cheers.
Thank you, Delwyn. Up next, we've got Andrew Cox, CEO of Sensor Global.
Thank you, everyone, and good to see some familiar faces from out the stand from today. So, excuse my voice is letting me go a bit, but I'll press on. I'm Andrew Cox, CEO of Sensor Global. Today, I'm going to take you through some. That's not my slides, but that should be fine in a minute. We're going to take you through a very simple journey of a compliance issue that we're solving in the residential property management sector across Australia, across New Zealand, Australia, United States, and can we have some slides, please? That'd be great. And we might reset the clock as well. I could tell a good joke. Okay, so Australia, clicker. That is my fault. I apologise. Okay, let's start from the beginning. Thank you. Right, Andrew Cox, CEO of Sensor Global. We've got a very, very simple problem we're going to solve. I'm going to show you just a few slides today, about 8, and I won't put too many graphs up on the screen. The simple problem in the residential property management sector relating to compliance, and in specifically smoke alarm compliance, property managers are responsible for this all year. There's legislation that requires these alarms to be inspected generally once a year. That's normal. So which means for 364 days of each year, those alarms are invisible to the property manager. It's a frustrating and time-consuming problem for property managers across the world to solve. They've got to organise keys, they've got to organise access, it's frustration for the tenants, there's COVID restrictions on getting into properties, but they need to remain compliant. Unfortunately, over 50% of deaths in homes relating to fire are in homes that didn't have a working smoke alarm in them. Okay, so we're going to solve this problem. These are some words from property managers who are our customer set and our target market. And they're really interesting. I can't honestly, I say, if every property I manage is compliant. These are real words from property managers. Tenants take them off the roof. These are smoke alarms, and hide them and get rid of them. And the property is non-compliant at that point. And it's such a waste of time having to manually upload stuff into a system. These are just some of the words. The solution is very, very simple. We've designed a platform of software and IoT devices that provides a line of sight into the property for the property manager that they've never had before. So when a smoke alarm goes off, as an example, in a property, if it's working, hopefully people hear it, and that's how it goes. But you only see that thing once a year as a property manager with an inspection, a physical inspection. So our system provides an IoT-connected infrastructure with a software platform, a cloud software platform for the property manager to view and have a line of sight into that property 24/7, 365 days a year. It's a significant difference to what the current status quo is. What this allows us to do is automatically and remotely test the smoke alarms. So we don't have to roll a truck with a person in it out to the property to push a button to test the alarm and charge the owner $100 or so a year for that service, which is actually quite poor when you think about it. It's just once a year. It also provides a full audit trail for the property manager to show that they're compliant, which naturally will have some ongoing benefits in terms of insurance and benefits there. Oh, and we'll save a whole bunch of lives too. How about that? Okay, with a working smoke alarm in a property, lives get saved. It's that simple. What we've built is this, and you see the words at the top, patent pending ecosystem. So we've got a patent lodged for this ecosystem of IoT devices, including smoke alarms, could be water leak detectors, gas detectors, etc., a whole range of devices connected to the property, which links across to the core software with a sensor SaaS platform. So we're a SaaS business. We're offering a subscription service to our customers to pay us for that connection each year and the vision into the property. That connects to the property, our software here. You'll see you've got connection to the property manager, the tenant, the electrician, and the owner of the property. So we've got a communication workflow that works for all parties in this system. It connects into the hub at the property. So that's a 24/7 pulse on the property. That software then connects back into the core system that the property managers use, such as their trust accounting system or client relationship system. So we bring the data across from there by API, so we connect to those. We connect the property manager to the property, and it flows back through each way. A very, very simple problem, very, very simple solution to a problem which exists today and is hugely time-consuming, and has a big legal risk for those property managers. Our market is over 50 million rental properties across Australia, UK, and the United States. The annual cost to the customer today, the average landlord will pay about $100 for a static once-a-year manual inspection, which is the existing sort of model in Australia, around $100 for that landlord. We'll reduce that to $52 because we're not going there in the first place, and we'll provide a better service connected 24/7. A pretty straightforward difference. Milestones, where are we? The software platform is fully developed, and thank you for a number of you for coming out today and having a look through our system out in the foyer there. Our key channel partners, we have agreements signed with MRI Software Australia and Rent Manager in the United States. They're our first two core paths to market. The product and connection testing, phase 1 and phase 2 is fully complete, and if you're at our stand today, you would have seen they're there. I think we set off the alarms at one point today. And the IoT smoke alarms in Australia in the final end of the certification for CSIRO. We're pre-market. We're hitting the market in December this year, and we're ready to go. By the end of FY 2026, these are the core numbers you've come to hear, we're looking at 5 million connections. That's 5 million hubs sitting in houses connected to our network across Australia, the United States, and the UK. We're targeting a 47% net return on the SaaS revenue, which provides a $241 million EBIT. This is in about just over 4 years' time. This is a massive scale opportunity in a huge market that's quite easy to get to. We have experience in this market in past software businesses selling to the same sector. Interestingly, we don't employ any field technicians, and we don't have a core monitoring centre to do all this. We're empowering the property manager to get control and manage all of this by exception. It's a very simple solution, as I mentioned. What are we raising? We're raising $2.65 million for a 21.72% share of our business. That's on a pre-money valuation of $9.5 million. That's my simple message. I hope we've introduced you to the world, to a simple solution for the world of compliance for property management, for smoke alarms and other IoT devices. Thank you very much.
Thank you, Andrew. Up next, and last before an afternoon break, is Silas Pohl of Wavetech Group.
Perfect. So hi there, everyone. My name is Silas, and I'm a board member and chief financial officer of Wavetech, which is a US-based next-generation battery technology company, but we are not a battery maker. So what do? So we upgrade, automate, and monitor battery-based backup systems. How do we do that? So we double the battery lifespan and triple the usable capacity over the prolonged lifespan. And by doing that, helping customers to increase cost efficiency, visibility, and security. So you see a few facts here about the company, but let me state one that's not on there, which is we currently own more than 85 patents that are approved. So when you think about why can we do what we are doing, then you probably remember the time when the Atlanta airport was down, where at the end that was because of insufficient battery backup, and the costs were immense, huge, right? So Delta alone had an additional $50 million in fuel cost. With our technology, that wouldn't have happened. And that nicely shows the problems that battery-powered backup systems have, right? They are too weak, they are not keeping up to the expectations, they are not reliable, they are also not efficient, but you also have hardly any real-time information about the true operating conditions and the status. And almost all of that is done manually and not really automated. So it's high and increasing cost and, of course, a reduced margin. So how do we solve that? So we upgrade the system by our patented technology, which is this one that doubles the battery lifespan and triples the usable capacity. And then we have a software system where we monitor everything in real time, from the battery to some other network statuses. And then we automate a lot of functions within the network. So that has a huge impact financially for a customer, but also environmentally. Let me come back to the financial aspect, because later on we have a couple of figures that show that. But on the environmental aspect, we're actually helping customers to reduce 2/3 of the related CO2 emissions there. When you think about the market, it's an immense market opportunities. We are actually surrounded by batteries. I'm not sure how many batteries are here in this room, but it's definitely far more than we have people in here. If you take the elevator, you can be sure there's a battery backup somewhere. If it's not, if the grid goes down, then good luck, but typically there is a battery backup. If you want to call someone without batteries, hardly possible, because the entire infrastructure that's transmitting the signals is based on batteries. So currently, we focus in that environment on telecommunications, data centers, and UPS systems and utilities. But then as a next step, we also focus on large-scale energy storage systems, and then ultimately also on EVs. So how are we different to the competition? Well, when it comes to this, we are actually completely unique, because there's no one that has a similar technology to what we have. When it comes to this automating and monitoring part, there are a lot of other companies that can do this. And they are similar to what we do. Where we differ is when it comes to the understanding of battery. Then on top, our IP is globally patented. We have a world-class science team, and we're also sitting on a huge of innovation for future products that we start bringing to the markets by end of this year. So how do we make money in that environment? Well, our preferred scenario is a business model that's based on subscriptions. So typically what we do is we look into each customer individually, calculate the saving potential, and then we use this as a base for our subscription. And that subscription we put in a long-term contract, which is typically at least 6 years, with some nice recurring revenues. Just to stress that, that's not a performance-based contract I'm talking about here. So what are some of the savings? Well, we save customers from day one 50% of all the battery cost, 50% of all the diesel cost for the generator, up to 100% of the cooling cost, then up to 50 and 75% of the planned and unplanned maintenance cost, and about 20% of the overall electricity cost. So you see some of our customers here. Let me just focus on a few. Maxis Communications, that's our first tier 1 telecommunication operator that we got as customer. Extremely relevant and important to us because every tier 1 customer in this world, the first question that they ask is, okay, who else in the tier 1 world is using that? Then NextGen Security, that's our first customer in the utility segment. Then we are currently in the process, we signed a couple of MOUs with, for example, the world market leader for data centers and UPS systems, or one of the biggest battery makers in Latin America. So here you see how it looks with the small to medium-sized customers. So that's based on real information, real data. So 12,000 transmission sites, that's not really that big. But if you look into that, if you would do the entire network here, we could save them on a yearly basis around about 20 million, and over 6 years, 120 million. Now comes the interesting part. This customer also has 460 off-grid sites. There the savings are even better, right? It's quite similar. So it's 80 million over 6 years. And that's kind of the initial focus area we are focusing on. So you see brief overview about the financials. 2020 was kind of the first commercial year we had with a bit more than 3 million US in revenues. Last year, a bit more than 10 million US dollar in revenues. This year, we are going for 16 million in revenues, and then next year for 30 million in revenues. You also see that we actually invested a lot into new product development. So here you see a couple of our team members. So we have very successful entrepreneurs in our team. We have world-class scientists, and we also have some financial experts. So a lot of them have startup experience, very successful exits, some in the billion-dollar range. So we are currently raising around about 10 million US dollar. That's in the form of a convertible note that comes with a 20% discount and a cap to the next round. So out of this 10 million, we already raised 8 million, so it's kind of 2 million left, but we can always raise more than that. So 5 million of that goes into future product development and 5 million in growing the organization. What's interesting here is you see this 25 million mentioned there. So we are currently in the process of negotiating a term sheet, and hopefully we'll sign it over the next 2 weeks with an institutional investor that then comes in at a valuation which is substantially higher than the cap that the current convertible note has. So we believe that's a very interesting opportunity. And then target is putting the company to the stock exchange, preferably in the US, and going from there and making all of our shareholders happy. Well, thanks a lot. I'm here, also my colleague is here. We are also there for questions in case you cannot find us. We are the cool guys without the banner. Thanks a lot.
Thank you, Silas. We're running a little bit behind schedule, but everyone can run out and grab some afternoon tea, coffee, etc., and we'll head back in shortly. We'll ring the bell as usual. Thanks. Hi everyone, thank you for rejoining us. I expect we'll have people dribble in as we go through this session. So look, last panel of the day. I'm sure you're all keen to wrap things up and get on with your evening. So we've got investment trends in VC as a final panel. Moderating this session is Jacqueline Yee, CEO of Fund Beam Exchange. On the panel we have Dr. Joseph Makanu from Verge. He's the managing partner and managing director. We've got Jeff Lin of iGlobe Partners, senior principal. Tobias Bauer of Blockchain Founders Fund. And Magnus Grimeland of Antler. He's the founder and CEO. So thank you very much, and I hope you enjoy the panel session.
Can you hear me? Good. Hi, good afternoon, everyone. This is a very exciting panel. It's a great number of speakers, esteemed speakers. So venture capital, investment trends. So we'll start off with a close look into 2022, and then we'll end the session with blue sky gazing, shall we? So let's start. Where do you see the greatest opportunities this year? How do you see it being different to the last 3 to 5 years? What's the greatest adoption, areas requiring education of, say, the investors and communities? Perhaps we could start with Toby on blockchain and then move along to Joseph.
Yeah, absolutely. So pleasure to be here today and talk a little about investment trends in VC. We are blockchain focused fund, and as I'm sure a lot of you guys know, the space has been very crowded and a lot of funds wanted to go into the blockchain and the crypto space, especially since the last 6 to 8, maybe a year. And now the space has been a bit more challenged. Prices went down, and now a lot of people got cold feet and went out. But I think right now it's still a very interesting space to be in. I mean, even if we look at the blockchain and the crypto space, there's 2 sides to it, right? There's a blockchain side and then there's a crypto side, and a lot of people are confusing it and think that's the same thing. Where we see a lot of adoption in blockchain across corporates, a lot of VCs have been investing in it. The crypto side is still, I would say, a bit more fragmented. But nevertheless, we have seen a lot of adoption recently across gaming, the whole digital landscape, what we call metaverses, and of course also in the financial space. But we have been very active in the space. We've done 40 investments this year alone. Across all around the world, mostly in very, very early stages. And it's amazing to see that also a lot of people on the panel here are exploring the space or have been very active in the space. So I think in general, since the start, we've seen great adoption. Now it's on a little bit of a downturn, but I think now it's the time to get in because valuations have been normalizing. It's getting a lot easier to get access into great deals. And most of the deals we've looked at a 40 million valuation, 30 million valuation, come back to us now at a 4 to 5, 6, which is amazing entry. So I think it's definitely an interesting part of exploring the space in this more or less bear market, as we call it, rather than jumping in a bull market and putting everything on one card.
Thank you, Toby. Jeff.
Sure. Use the mic. Yeah. I kind of echo that. It's kind of the right time for those actually funds with more dry powder actually to take advantage of adjustment of valuation, either in the public or private market. To invest, right? So if we think about it, we are the investor of a company called Unity Software. That was back in 2010, and the company at one time the share price was $200, and now it's down to the range of 40, 50. You would ask me, actually, is it a good time to buy Unity? I would say yes. And Toby probably know what I'm talking about. So because of that exposure, actually, we have, over the past 10 years, been looking at Digital Twin and looking at the space of metaverse and this kind of investment. I would say, actually, there's still a lot of potential in there. So Jacqueline was asking me, actually, how different is this year, right? How different is this year? So I'm looking at, if you think about it, right, this year was kind of remind us about global climate change. If you are in Europe or China, you can see that in many places, the people are experiencing unprecedented unprecedented kind of extreme weather conditions. There's going to be food issues down the road, we believe, right? I mean, if you think about it, inflation is all-time high. There's a lot of challenges there. So I would say probably, I would say probably people now, those startups actually which are looking at solutions to help to address the future kind of the food supply or sustainability issues, probably they will have more investors willing to listen to them, they're pitching now. And reason why myself actually I can relate to this was because as a fund, apart from investment in the tech space, since 2014 we've been starting to invest in synthetic biology in the US, right? So because of that background, right? So we over the years increasingly appreciate those actually new technologies which can help in a scalable manner to help to manufacture alternative proteins or other kind of nutritions in a very effective way. And this is an area which I believe we probably is one potential answer to some of these problems actually we are facing now. And so the other issues actually I also feel is going to be even more interesting down the road will be healthcare related. And all this actually we believe no matter actually whether it's token or crypto or whatever. I mean, a lot of people are talking about NFT and all these kind of things, but as a VC, traditional VCs, right, you can always focus on those opportunities actually which can help solve the real problems of the world. I mean, it could be go back to address the very basic needs of humans, right? So that's why I see. Yeah, so over to you, Jacqueline.
Thank you, Jeff. Magnus, what about you as you build communities at Antler and you build really strong companies there? What are you seeing as the opportunities for the rest of this year, and how has that sort of changed? Yeah.
Yeah, thank you. Thanks a lot for the invitation and great to be here. Antler, we're the world's largest early stage investor. So we invest in founders just as they're getting started. So we're like a day -1 investor. We invest in teams and really not in companies. You know, that has been a good strategy in the volatile market because we come into great people as they're just raising their first round. So if we find high quality founders that are building a great company, they would typically only raise their next round at a higher valuation. And so to that extent, you know, we're doing pretty well this year. Our performance is actually up. We have decided to make this a year where we're going to continue to invest into great new teams, because if you look historically, the best cohorts of venture capital are created at the bottom and not at the top, right? So if you look at the dot-com boom, if you invested in like 98, 99, early 2000, you would have lost a lot of money. If you invested in 2001, 2002, 2003, you would have earned a lot of money. Same with the global financial crisis. If you invested in, you know, 2006, 2007, 2008, it would take quite a bit of time before the valuations were up again above water. If you invested in late 2008, 2009, 2010, it's probably some of the best venture capital cohorts ever. So, you know, if I look at 2022, the way I think about it is, it's very easy to remain too long in the thinking box, right? So there are investors I've been talking to who in Q3 2021 last year were like, oh, we're so busy deploying, you know, really don't have time to follow up on all the meetings. It's just crazy. So we're in this like major deployment mode. And if you talk to them now in Q2, or now it's Q3 2022, they're like, hey, we're just waiting to see what's going to happen in the markets. And you all saw, for example, a lot of you probably saw the SoftBank presentation recently with their, you know, 50 billion or so quarterly loss. And there are a lot of people who have lost a lot of money in the private spaces the last couple of years, but it's typically the ones who've deployed a lot of capital at really high valuations at the end of the cycle, and then they stop investing now, right? Which is the opposite of what one should do. So that, I think, is point number one, in my opinion. So now is the time to invest in like great early stage teams. Second point is ensure that you look a little bit closer at what you're investing into, right? So in the private markets, it takes a little bit of time for valuations to get adjusted. So if you're investing into a fund, one simple question you can ask is like, if the fund has already started deploying capital, is ask like, what's the multiples of your highest value assets, right? Revenue multiples, EBITDA multiples, probably revenue multiples if you're investing in tech because they're probably not EBITDA positive. And if the revenue multiple on the existing portfolio is like 50x or 100x, then that fund is probably going to see an adjustment in value, meaning if you put $1 in today, it's going to be worth a little bit less in the future. But if people have not deployed that much capital in the fund yet, or they invested at lower valuations, for example, if you look at Antler's top 30 assets, it has a revenue multiple of 5x. Then that's probably going to go up, right? So that's one thing I look at when investing into funds. And the same when you invest into companies, right? Are you investing into the valuation that the market believed was the right valuation in 2021, or are you investing into the corrected valuation? So I think these are just kind of some things to be aware of as investors. Now, if you invest in the really early stages where we are investing, valuations hasn't moved all that much because we always invested at attractive valuation, but we took a lot more risk, right? So it becomes a lot more about really identifying what are the best teams and are they working on something that will get real product market fit. So we haven't really changed our investment strategy all that much. But I think if you're in the later stages, these are kind of a couple of things to be aware of. So that's quickly my opinion.
Thanks, Magnus. So my name is Samuel. I'm from TMB Aura. We are a Southeast Asia-focused venture capital fund. We invest in the Series A to B stage. thesis-led investors and high conviction, and we aspire to be the best second check in the market. So 2022, what a year, right? So as you guys know, right, due to the current global macro climate, there's been a shift in sentiment amongst investors, as I'm sure everyone can agree, with appetite shifting from growth at all cost business models to business models that are more sustainable growth and focus on unit economics. So I do expect the remainder of the year to remain that way, right? So on top of valuations adjusting downwards, right, there's also a tactical shift among investors to switch the mindset away from the high burn model to something that is more sustainable. Having said that, right, over the next 5 years, I think the general strategy among Southeast Asian investors would remain the same, in that the circular trends of Southeast Asia should remain intact. You have a young and tech-savvy population, more than 500 million in number of population, and more than 50% under 30 years of age. You have an increasing consumer spending power, and you have high digital, social media, and e-commerce penetration. So all this will not go away just because of all the doom and gloom that's going on in the West right now. So yeah, the business models that continue to address large pain points and leverage on these tailwinds should remain attractive opportunities.
Thank you, Sam.
Oh boy, last word. Everyone can hear me okay? All right, so I'm Joseph. I run Verge Health Tech Fund. It's a global seed stage impact health tech fund, probably the only one in the world that does this, or else I would have sent my CV elsewhere instead of starting my fund. So I have a very narrow lens in which I view the world, which is, what makes people sick, what kills them, and what are technology solutions that can hopefully alleviate some of this. However, I am going to venture out of my lane and comment on what I've seen in the world. And in terms of venture trends, if we listen to the summation of all the opinions here, is it depends. It depends on stage, it depends on sector, it depends on geography, and it also depends on who your backers are. So I think the one overall theme we've learned this year is that we don't know how to measure risk. We don't. We also can't predict the future, because who would have seen the downstream effects of what is happening in Eastern Europe? Who could have seen the downstream effects of what is happening with resource shortages? We still don't know what is going to happen with the energy shortages, fertilizer shortages, food shortages, and how that's going to, impact some markets disproportionately versus the others. So I'm going to stick my head in the sand and, continue, doing what we do, because we have no other choice. But the only thing we can think about is, what are the stressors out there, and how is your portfolio going to respond to it, and what are the different scenarios by which they can account for that. Now, being a seed stage investor, we've been rather insulated from a lot of the snap to absolute value from relative value that we've been previously enjoying for the past 15 years. So, we're seeing, it's business as usual. And, if it wasn't COVID or war or supply chain shortages or component shortages or the pausing of clinical trials that killed these companies, then, maybe something else will kill them too. But, they're continuing as normal because we're so early. We're kind of ahead of that area where, valuation starts to fluctuate as a function of interest rates and liquidity. I don't know whether this is going to continue for the rest of 2022 or 2023, or whether the illiquidity and tightness of capital will ricochet and filter down to our stage. Don't know. It may be that there are going to be other sources of capital that is outside of maybe venture that is going to fill the gap. What I'm starting to see is counter-cyclical investors starting to get interested in the venture space. So you see endowments have totally over-allocated into venture, but suddenly I have like oil wealth getting interested, or people that just really benefited from the commodity boom recently and have a lot of powder looking to put it somewhere that is, again, a bit diversified from what they do. So that's a whole bunch of nothing burger comments on, again, it's an elaboration of it depends. So that's really it. And I can't predict the future, but what I can do is think about what are all the bad things that can happen and how do we protect against that? And similarly, what are some of the good things and how do we capitalize on that in the context of health and tech?
Thank you, Joseph. So I just want to summarize all those answers a little bit. And just to give you a background of why I say this, I'm actually CEO of Fund Beam Exchange. We're a private markets, tech-enabled exchange that lists private companies' securities. And what we're seeing actually is private companies staying private longer, and also valuation shifting. And depending on sector, as what Joseph is saying, correlation and uncorrelated markets are shifting. So it's all been very interesting. The investor play, as Magnus is saying, comes into play. That's been reinforced by Jeff and also Samuel. So who you choose as your investor, how long they stay, is important. Liquidity as well. So we're looking at, as Joseph is saying, diversifying the portfolio. So that's what the exchange tries to do, create multiple liquidity events. And the same with Toby, automation, and the differentiation between blockchain and crypto is particularly important. The framework and infrastructure for blockchain and crypto are two separate matters. And this leads me on to the next question for the panel. Is there now, with recognition by institutional investors in the uncorrelated returns, possible to hedge a portfolio, a diversified portfolio, a paradigm shift? Is it still a 60-40 split? Would you say, what would you say then is the X factor for, let's say, investors out there to invest in the earlier stage private companies? Perhaps we can start with you, Magnus.
Yeah, so I think first of all, any portfolio out there, whether it's institutional or family, should have high exposure to innovation and venture capital for three major reasons. So one, if you back the right funds and the right companies, it's by far the highest return asset class in the world. So that's number one. Number two, if you are in a position to deploy capital, I think everyone has an obligation to make the world a better place. And I think the world's largest problems are going to be solved by people innovating and not by investing into, more property. And then the third is by investing into innovation and venture capital, you gain wisdom and insights into all of the other type of investing, right? You will gain insights into, co-investment opportunities, into how existing portfolio positions, whether it's in private equity or real estate or public markets or minerals or commodities, how those will get disrupted and change. So there's those like really good angles of, hey, high returns, positive impact on the world, and the ability to kind of inform the rest of your investing. So I think it's insanely important to have that as a large part of the portfolio. And I think depending on what your strategy is and what stage you are in the fund or your life and what you want to use the proceeds for, the percentage allocation will change. But like a minimum of like 15%, I think is definitely what one should aim for. And I think if one is in the investment game for the long term, then it should be an even higher percentage, in the 50-60%. Now, how do you think within kind of venture capital, how do you think about building a strong portfolio? I think everyone should make up their own mind on this. The way we look at it is you want to maintain the alpha while removing as much risk as possible. And if you do kind of portfolio analysis on this, it's actually not kind of, the earlier you go, the larger of a spread you need in your portfolio. So obviously when you're later stage, you have more security on whether the company will succeed, but you're also taking a lot of alpha off the market, right? Like you're coming in at a higher valuation. The earlier stage you go, the risk increases, but the potential upside on any single individual investment increases rapidly. So if you do just portfolio analysis on really early stage venture capital, you actually probably want like 90 to 100 companies in your portfolio to get that optimized risk versus return profile. So that could be going into multiple funds, or you can do multiple direct investments, or it could be in funds that have kind of larger portfolios. If you go much larger than that, then you actually take away a lot of the alpha, and if you go lower than that, you end up potentially kind of backing portfolios that might completely go to zero. So that's kind of quickly my opinion on that.
Thank you, Magnus. I want to hop over to Toby. So I'd like to ask you, how do you see the blockchain and the emerging tech dovetailing into the developments in the space for blockchain and digital assets? So when I say developments, I mean the regulatory framework, the harmonization. So how has that facilitated the X factor, and where do you see the exciting bits are for applications in real world assets?
Yeah, I mean, I think first of all, we see a lot of investors going into the space. I mean, there's a lot of family offices who look into the space, which is fantastic to see that it's not just the crypto OGs who are investing in the space, but there's a lot of institutional players looking into even corporates. Some of our LPs, even on the new fund, are corporates, banks who are exploring the space. And I think it's a broad mix of capital, which is great. Now, I think as an individual investor or as a especially family office, you have two reasons to, or like two ideas to go into the space, right? So you either invest in a fund and let them do the deal sourcing, and then you have exposure into one big pool of it, or you build your own network and your own team and essentially invest in individual companies. Now there's about 20,000 something decentralized applications in the market. So the second way is obviously a lot more effort related. And then the second thing, which is quite interesting in the blockchain space, you have more assets than just equity, right? I mean, you can invest in tokens, you can invest in non-fungible tokens, meaning NFTs, and you can also invest in equity. And so basically, there's a couple of challenges you have to look at if you build your portfolio into the blockchain space. Now, what I think makes a lot of sense is there's two things you can go about it. So first is when you look at a token exposure, I would always try to get token exposure at zero cost basis. So what is quite common in the space that investors invest in your equity, and for that, in return, either from an advisory perspective or because you've been invested in the equity, you get token into your portfolio as well, which then has one benefit because you're in for the long term, but at the same time, you have earlier liquidity than most of the equity-focused funds would have, right? Because tokens are typically locked up over a certain period of time, and then you probably can have liquidity after 1 or 2 years of investment focus. That's more or less how we get our token exposure at all the time. So because we don't feel comfortable putting a lot of our assets into pure tokens, of course, this can go 100 or 1,000x, but it can also go to zero very, very fast, as we have seen. Now, at the same time, what we see is happening is that people want to build interest and build exposure in the space. So a lot of family offices, institutional investors, they invest in funds, and then they co-invest alongside the fund. Right? So they say, okay, they've done 100 deals in the fund, as Magnus elaborated, and then we see 10 deals we find exciting, and then we go directly with them on the cap table. There's obviously certain measures. Some VCs are more flexible on this. Sometimes you have to pay an additional fee for being in sort of the co-investment opportunities. But if you respect sort of different asset classes and you manage your risk return and you try to balance between direct investments and fund investments, I think you can get a pretty reasonable exposure into the crypto space from a private market perspective. Of course, you can invest in listed tokens as well, which is a different story, which I'm not going to cover now too much. But just from a pure VC perspective, where we invest in hopefully sustainable companies, I think that's probably an interesting solution to explore if you, let's say, put 10, 15% of your available capital into the space to just get started and to explore it. And generally, what we have seen that this is a very risk-adjusted return, which is generally a little bit, or can be higher than the market average, but also the downside is relatively limited because most of the time you're still on the equity side of companies which are building interesting products.
Thank you very much, Toby. Now, in the interest of time, we'll do a quick fire round. Blue sky gazing, what are you most excited about in the next 1, 10, 20 years? And what advice do you have for founders out in the audience and out there listening in regards to what we've spoken about today? Perhaps we could start with you, Joseph. We move down.
Oh, what's exciting about next year, 5, 10 years? So if we make it to next year, I'm excited. 5 years, cure for cancer, 10 years biological immortality. What advice would I give to founders out there is be real, man. Like every deck starts looking the same after you see 100 decks a day. So be real, stand out. Like show some photos, show some videos, show some like people testimonial being excited and show a demo, you know? Sorry, that was more than quick fire. Next.
Yeah, for me, it has to be the integration of Web3 technologies and the Web3 market with the real economy. So basically, right now, all the use you see in DeFi, you can't really call them real use because it's not integrated with the real economy yet. So I would love to see a world where, just like treasury bonds finance the world economy, right? So major proof-of-stake assets could serve as some sort of internet bonds to power our new digital economy that we are building today. In terms of advice for founders, right? Over the next 12 months, create optionalities for increasing cash flows in your business, delay capex if possible, raise additional capital, survive till the next 24 months. Yeah.
Thank you.
So also very excited about Web3, so I want to go in there, and I also invested in Tobias's fund, so share that mission. The number one thing that I'm super excited about is though the healthcare space, and Verge obviously is investing in that. I think 70-80% of all healthcare spend in the world is spent on treatment, where about 70-80% of that again is treating diseases that, if discovered early or with simple changes in lifestyle, could have been avoided. And while we're seeing more and more money being spent on healthcare, the ROI on each additional dollar spent is going down drastically. And you have billions of people with, not even access to basic healthcare. So you have this like very, very solvable problem where technology is playing a very important part. It's just very complex, and that's super, super excited about working on solving a whole verge of topics in that area.
Jeff.
Yeah. Okay. Yeah. 20 years is really very long time horizon, right? So we don't really have a crystal ball to say 10 years down the road what kind of fund we're going to raise. But I would say actually, at least for the immediate next 10 years, something for sure is actually, we believe that, I already mentioned there's a lot of big problems to be solved, and anyway, we had to answer lies with we call it the innovation centers of the world. Singapore is increasingly one of them, but as iGroup partners, over the past 20 years, we've been doing is actually, we get the money from Southeast Asia, and we invest in both Southeast Asia and also in the US, in areas like Boston, in like San Francisco Bay areas. Very often, actually, we back those actually companies actually with inventions. You can license out from MIT, Harvard, or from Stanford University, UC Berkeley, and so on. I would say actually something we never go for too long is actually there's a higher chance of betting on actually the right research team and the right founders over there because the ecosystem is there, right? So I would say actually I also want to actually further add on what you just mentioned. How do we offer a product to the investors in this region which allow them to have less correlations with what they already have, right? So this is actually one of the differentiation we have. Because we have been doing this for the past 20 years, we believe that as long as we go there often enough and to really work with the local kind of ecosystem players, we'll be able to identify another Twist Bioscience, another Ginkgo Bioworks, another Inscripta, or another Metapod, this kind of companies, because a lot of brilliant ideas really come from that part of the world. Recently, we also, so just like what, I know Intel also built up a lot of presence in Europe also, right? So as you know that we have been investing in the UK for quite a while. And one of the recent kind of hub we quite frequently patronize is Oxford University. Actually, they really have a lot of outstanding research when it comes to therapeutics, right? So this is another increasing area we're also finding ourselves actually getting more exposure into. So more or less, this is what we see and what we believe in. Thanks.
Thank you, Jeff. Toby.
I keep it short, the time is up, but I just want to make one thing very clear. Even though we're all excited about the Web3 space, a token alone is not going to make a company successful, right? I mean, we still need to look at founders, product market fit, what problem are we actually solving, and it's as any other business in the world as well, right? If you're not solving a problem, if you're not having a proper product, which is exciting for customers in either B2B or B2C, it's not going to be sustainable in the long term. And every investor should be very aware of this. The token is just one part of the equation, which obviously adds benefits, but it's not the whole part of the equation.
Thank you, Toby. So I'll just wrap up quickly before handing you over to our lovely Steve. So I think what we've been hearing is diversify your portfolio, extend your cash flow runway, founders be real, investors are not dumb. So find your USP and be resilient. I think that wraps it up. Thank you very much. Round of applause for a great panel.
Thank you. Thanks a lot.
Thanks.
Thank you very much, everyone. And thank you, Jacqueline, for moderating that fantastic session. So just as a closing note, I'd like to say thank you very much, everyone, for joining. One of the things that makes me proud to do what we do is I love that the founders work 24/7 to build their businesses. Today, we're being joined by founders who have flown from the UK, well, you can take your selfie, guys, don't let me interrupt that. Flown from the UK, from Singapore, not flown from Singapore, flown from Australia and the UK to be here. And also, I note that other attendees have also flown in for this event. That's what makes this space special, is the way in which people actually come together. So Thank you very much, everyone, for coming. For those that are joining us tonight, just to let you know, the venue only opens, we can only go in at 6:30 tonight from at the venue. So basically just hang around and then we'll see you sort of later on tonight. Thank you very much again, everyone, for coming. Thank you very much for the companies that presented. Thank you to the panelists, to the speakers that all presented throughout today. I hope you enjoyed Venture and Capital. We've been so happy to host this again after 3 years of not being able to. Enjoy the rest of your night. Thank you.